What's up, everybody? Thanks so much for tuning in, and welcome to yet another episode of the Chat with Traders podcast. This week, we're at episode 43, and my guest is John Borman. John has been immersed in the world of trading for over 30 years now, and has spent the majority of his time in the institutional space. He's been on the buy side, the sell side, run a trading desk, been an assistant to a portfolio manager, and has also been a prop trader. But nowadays, John trades independently and does also manage assets for others. His approach to trading is probably best described as a long-only trend-following strategy, which we discuss extensively during this episode. Some of the topics we hit on include why the simplicity of trend following can be both a gift and a curse, why John trades the long side only, and how this affects him in a full-fledged bear market. Plus, a few pointers on position sizing, and John also shares his best tips for long-term survival. I mean, John really was an awesome guest and did share a lot of great wisdom throughout this episode, so I feel like you're really going to enjoy our discussion. But just before we get into it, I've got something really exciting to share with you, and that's a new giveaway which is kicked off just this week. Here's what I'm giving away. A free 90-minute one-on-one mentoring session with one of the Chat with Traders coaches, and there will be 3 winners, seeing as there are 3 coaches, who I introduced you to the other week. They are Chris Sayce, Zach Hurwitz, and Brad Jelinek. Each really great traders who take this business very seriously, and they've also previously featured on the podcast too. This giveaway is your opportunity to leverage their many years of real market experience with a one-on-one conversation purely focused on how you can become a better trader. So if you'd like to seize this opportunity and enter for a chance to win, just go to chatwithtraders.com/win. That's WIN and enter your email address. And the cool part about this is, once you enter, you'll instantly receive a unique URL. Share this URL as much as possible, because for every person who enters after clicking your unique URL, you'll receive an additional 9 entries. And of course, that'll dramatically boost your chances of winning. So just in case you missed it, go to chatwithtraders.com/win. That's WIN to enter now. The giveaway will close on the 7th of November this year, of course, being 2015, just for anyone who's listening at a later date. All right, guys, let's get into it. I'm your host, Aaron Fifield, and here is this week's guest, John Borman. Hey, John, welcome to the podcast. How are you?
Very good. Thank you. Thanks for having me.
No, thank you so much for agreeing to an interview. I mean, it's awesome to be speaking with you, and I already know this is going to be a great discussion. So we're going to discuss your many years on the institutional side of trading, and then the meat of this episode will be focused on your views and beliefs around trend following, which I'm really looking forward to hearing your insight on this. So to get this underway, I'd like to start at day one, right at the very beginning. So John, share with us how you first got involved in markets. And I know you were quite young at the time, so how did this journey of yours kick off?
Well, I guess it's 30 years ago now. So this is like in the mid-'80s as a teenager. And it was the combination of when I was at college, there was this assignment where it was a diploma in business studies, and there was this assignment where you had to manage a portfolio for 6 months. And it kind of fired me with a love for it because I did quite well at it. And you also have to remember that this was in the UK, and at the time, under Mrs. Thatcher's Conservative government, there was a real big push of share ownership. Lots of nationalized industries were being privatized. So I think British Gas, British Telecom, all these new issues where the public bought into them. Everyone got their 100 shares at a pound each, and then got to sell them, 40% higher on the first day or something ridiculous like that. So it's probably not a good thing, because it makes you think that it's easy. And that was definitely a good market in the mid-'80s up until '87. So that was kind of my first experience of things, trading for myself. And having done well in that thing at college, I wanted to then open up an account of my own with a broker, which I did, and obviously I was still ridiculously young and naive, and made all the mistakes that novice traders do. And actually, I kept trading until I got my first job when I finished college. I started working at Schroders, which is a big asset manager in the UK, in the back office, and that was in '87. And I continued to, on the side, trade for myself. And of course, I was right in the thick of it, trading in and through the crash, and that pretty much wiped me out, and got almost scared of it, I guess, and kind of then backed off and didn't trade probably for another couple of years after that, and just got on with doing my job there, which initially, as I said, was in the back office, but then I later moved up to become in the asset management arm. I became an assistant to a portfolio manager, and that then really introduced me more to that institutional side with them of how they deal with things.
Okay, excellent. Now, one of the things you mentioned right at the very beginning there, which piqued my interest, was you said that you made a lot of mistakes early on. So, would you mind sharing maybe just a couple of those mistakes?
Well, I mean, they really all stem from just not having a plan, really. I mean, you're just kind of um, flying by the seat of your pants, just not really truly having a methodology, having researched it. And what that probably all stems from is just being well, not being patient enough to be able to actually study this and truly learn. And instead, you end up learning by making mistakes, the hardest way of all, by losing money. Um, so it would be, I'm sure I used to buy into the whole buy low, sell high mentality, trying to time the market. Just so much of what I don't do now, So, and I often find that on social media now, when I'm talking about things to not do, sometimes it's me talking to myself. It's almost like you're reinforcing your process, reminding yourself at the same time as others that that I've discovered the hard way what works for me.
Absolutely. Okay. So, now just going back to your career in the early days there. So, how did you first get your foot in the door at the back your job at the back office there? Like, how did you get into that job? I mean, was it fairly easy for you to pick that up, or tell us a little bit about that?
I mean, it's a very different era, and as I said, that was a time of great expansion and growth within that industry. So there were a lot of there are a lot of people hiring. I mean, I put out applications to a lot of people. I think I sent out like 50 different letters to people, and I probably got like 3 replies, and 2 of them offered an interview, and I had both those interviews on the same day, and this one offered me the job on the spot. Now, looking back, it's a very low paid job, and it's in the back office. But you know what? It meant you're in, and it then took me a while to realize exactly where I was within that organization, and I'm seeing all these trades coming through, which I'm then helping to settle and to do the admin for those. And then I suddenly realized, well, I want to be on the other side of this transaction. I want to be the one either trading this or deciding the allocation, and so I looked into that. So I guess it made me realize I had an opportunity within that organization if I wanted to take it, and I was quite ambitious at the time, and so I would look at these other jobs internally, and they would require these other qualifications that I didn't have, or rather skills that you needed, which now in this day and age will seem ridiculously basic, but it was even just having knowledge of spreadsheets and things like that. And I think in those days it was like Lotus 123 and things like that. So I had to just go away and teach myself those things, and went and got went to night school and got something in economics, and taught myself these other computer skills and things like that, so that I could then apply for one of these jobs and meet their minimum criteria, which I did. And that, I mean, that was a big break for me, because then I really got to see that side of the business. I mean, I was talking to, you'd occasionally talk to clients, you'd be preparing client presentations, the performance reports, doing portfolio allocations. And it was that side of it that I enjoyed the most. And I think I showed a particular aptitude for the trading side. And eventually they moved me up to the trading desk, where I was then handling all the Far East business for that asset management arm. And I'm 22 years old at this time. So that was quite a responsibility and quite an achievement for me. So I was, you're handling some pretty decent sized orders. Sometimes we'd put them out to be executed overnight, but I also started to trade some of them during the day with market makers during London hours, where we would, I'd get them to make a price. So then that was my way of handling some of the business there, using my discretion to decide that we might be better off trying to deal this here rather than leave it in the market overnight.
Okay, excellent. So later in your career, I'm not sure how much further along this was, but I understand that you helped to actually set up a trading desk in London there for the firm you were working for at the time.
Yeah, that was the next thing. After, I mean, I'd been at Schroders for 8 years, and then there was a position at what was then Kemper, which later became Zurich and Scudder, and then I think it was bought out by Deutsche. It went through lots of name changes, but that was in '95, and I was hired to set up a trading desk in London to transfer all their international trading from Chicago to London. And so then that was everything but US markets for them, and all the FX as well. So I had again, that was kind of broader experience, because it was the real nuts and bolts of all the other admin and compliance elements that go behind a trading desk as well. So I really had to get to grips with that side of it, and I did that for another 4 years. So that was my entire buy side thing there, the institutional side, seeing how those kind of PMs allocate things, how they trade. And because sometimes they had their own ideas about trading, there were others who were very happy to just hand it to the desk and say, here, look, this is what I need. Go ahead and execute it where you think it can be done best. Or, they would give you that discretion. But there were others who would have a fixed price in mind. Oh, I only want to buy it with this limit, things like that, which I didn't think worked particularly well for them. In fact, it would be a source of great frustration to me. You either, do you want to buy this thing or not? And limit orders, limit performance. They'd have these orders where it's just slipping away from you every single day, and then weeks and weeks later, you've barely executed 10% of this order, and the stock's gone up 5 or 10%, which was ridiculous. But you'd have other PMs who they just knew they want to buy this thing, get me in. Okay, done. And they don't mind if you're then the one initially being aggressive, so that we get positioned, and then let other people worry about where it's going from there. And that was that in some ways that kind of shaped how I looked at things later on, because I actually saw the benefit of that. Now I would now characterize that as, when you get your signal, just take it, just instantly acting on it, not seeing something, thinking, oh, that looks great, I really want that, but I'll wait for a pullback, and then the pullback never comes. So in working for many different portfolio managers, you really, you get to see what not to do as much as you do, to learn some good things as well. And I've been fortunate that I have worked for and with a lot of very good managers, so I've definitely learned some good lessons from them.
Just so we're clear on that, so what your kind of role there was that the portfolio manager has the idea of what stock they want to buy and sometimes what price, and then it was your job to actually execute that order and get them into the market. Is that right?
Yeah, it's different at different firms. Sometimes they would have a committee that would decide roughly where they wanted their commission business to go to, and then the desk over the course of the year had to try to meet those targets that, roughly we want 10% of our business to go to Kleinwort, and we want 12 to go to Lehman, and we want 8 to go to Morgan Stanley. And you just have to roughly try to then give it to those people as and when it made sense. But very often, especially when we're dealing in live markets in Europe, rather than putting out business overnight for Asia, you're dealing with live bids and offers and natural business, trying to go where it should go, where the natural supply is. So we would then say to them that, sometimes these figures are going to be different, because I know you would really love to reward your buddy with this order because that's where the research came from, but sometimes it wasn't always that simple, because they might not be the axe in the name. It might be that there's someone else who was working a pretty decent order in that name that day, and that's where that, on this particular day, this is where that order should go. So, that was really our role was kind of making sure we get best execution, but also in the long run trying to fulfill their needs of what their research budgets and things were.
Okay, and when did your experience as like an actual prop trader come in? Was that a little bit later, or was this kind of around the same time?
Yeah, that was a little later. Then after I'd finished at Kemper in '99, I then went to the sell side and worked for Lehman, and I was initially as a sales trader. So I'm sales trading pan-European equities to hedge funds and institutions, which themselves were mostly in the US. So my clients would be people like Templeton, or like Lone Pine hedge fund, people like that, or Chilton. And I did that for, that was probably for 3 or 4 years. And throughout that .com bear market, which has made it pretty difficult. But then one of the parts of my job there was that at the time it was a new thing called alpha capture, where the Marshall Wace was the client who developed this internal platform where they would monitor the ideas of brokers. It would be a way for them to assess the signal, if you like, the effectiveness of the ideas that they were getting from the broker community. And the better you did in that, the more you got rewarded for it in order flow commissions. And with a couple of other salesmen on the team as well, we did very well at that. And so that's what introduced me to that whole concept. I actually expand on that in my blog. It's why I've called my blog Alpha Capture. It was something that was quite a big break for me at the time, getting that, being able to work with that client and see what they do. And it was just something that I prospered at. And so it then became, well, if you're going to do that, you should do that with our money. So then it was invited to join the prop desk there, and I had a fairly privileged mandate at the time as a generalist, so that rather than being tied to any one sector or market, I was able to trade long, short, equity futures, and pan-European equities. And it wasn't a huge book, but it was good enough, and it was a great setup. That to me at the time, that was like, wow, this is my perfect job. Now it's like I'm managing money, and I'll get paid on my results. You can't ask for more than that. And the only problem was, at the time, the firm was going through a lot of restructuring in that area, and I had like 3 different bosses in an 18-month period, and they didn't really know where to place me or how to characterize what it is I did, because most of the other people in that place were more fundamental based, and I was really technical. I might have what might have been some fundamental factors to something, but I never quantified the trade in that way. And so eventually, when the desk moved off the floor into a separate area, so it almost became like an in-house kind of fund. Like that was the trend at the time, because then they had to move off the floor and separate these things, because the regulations were coming in, making them do that. Because prior to that, we'd be sitting right behind the market makers, which now would be unthinkable that you could be privy to the kind of information that was going on the floor. So I was let go from there in 2004, and that really is there's then a 1 to 2 year period which really forms everything that's followed. That was really the formation of a lot of my ideas, and how I now look at markets really came about in that period.
Okay, and I'd like to ask you about that period, because I'm interested to know why you chose not to seek out another job doing something similar with another firm, and instead you transitioned more to trading independently. I mean, what was your reasoning for this?
Well, I mean, honestly, I did try to get initially. I did try to get another position, and it was actually quite a difficult market at the time. I was trying to then. I was mainly trying to talk to hedge funds about getting a position within a hedge fund, because I always felt at the time on my resume that's like the one thing I hadn't had. I'd been buy side, sell side, run a desk, assistant to a PM, and a prop trader, and it was like, yeah, it would now be good to continue that money management side and go to a hedge fund. But I had several interviews at different places, but there was just nothing coming through for me. And after about 6 months or so, we just talking with my wife and the family, we just decided that we were going to move to the US, give it a couple of years. If it doesn't work, we can always move back. But we'd always, my wife's American, so we had links back here and would travel over to the US a lot. And we'd always considered that we'd end up living and retiring there eventually. And so with this opportunity, we just thought, well, why not now? Let's just go for it now and see if we can make a go of it there and give it a couple of years. We're still here. I've been here 10 years now. So when I first got here, that was really, that's when I did a lot of reading and researching of what it is I really believe about markets. And some of the book that really helped me with that was reading Van Tharp, Trade Your Way to Financial Freedom, which is an awful title for that book, because I always think that gives the wrong impression about what it is. It's not some get-rich-quick thing. But it actually really went through, systematically goes through, makes you break down what is it you really believe about markets and why, and just strip everything down to the bare bones, and finding out what time frame it is you're best suited to, what trading methodology. That's what it did to me. And it really also emphasized the importance of position sizing, and it broke down the individual components of a system, made you realize how and why things work the way they do. And so that was a pivotal thing, because I then started researching some of these other methods, and trend following was one of the ones that leapt out. I always felt within his book it kind of lent towards trend following anyway, I think, about being one of the most consistently long-term successful methods out there. And so I read that, I read Covell's trend following, and I read all the Market Wizard books, and kind of getting a consensus of what is it these successful people do. What are the key things? Most of them, it was about the importance of position sizing. It was the risk management. It was the cutting losses. And so all of those things resonated with me, and it was how I then started to concentrate a lot more on trend following, and I started to look into developing different systems and finding something that could work for me.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Okay, so did you find that your institutional knowledge and all the knowledge you'd gained over the years up until this point, was that enough to kind of support you? Or it kind of sounds like you had to reinvent yourself. Is that a fair statement?
Yeah, I did, and actually looking back, I don't want to get to, we could go a little deep here, but looking back, it made me realize years later that losing my job back then in '04 from Lehman, actually, it probably really did affect me a lot more than I realized at the time. And I took it pretty heavily, and it really just made me examine everything that I had done, and I had been I'd lost a little bit of money for them towards the end anyway. I mean, as I said, with the changes, I think it was going to be inevitable anyway. That you know, I probably would have been let go because I didn't fit into that structure anymore. But I had been losing, and I'd been taking it quite hard. I'm one of these people that if you lose money, I can't just say, oh yeah, well, it doesn't matter, it's other people's money. No, to me it matters more. I'm actually very conscientious about that. And so, you know, I took it very seriously, the position that I was in there. And so I really wanted to examine what it was I was doing and try to get my ideas straight. And I had already started that process before I was let go. So it then just made me continue it. And it was, yeah, we were in a position that I had that option to be able to do that. And we were relatively comfortable that we, you know, I had the time to then develop things. I mean, that's one of the great things about that. It gives you time, gives you options. But the real thing is I just started taking everything off the chart one by one, things that I would use like divergences, stochastics. I mean, now I never use them. And these are all things that I used to use all the time and have them up on my trading. And then I'd kind of examine, well, why is it I really do that? Why did I first start using that? Has it been of any use to me? Why do I use 20 day? Why not 21? Why not 22? Why not 19? You know, really start to break down everything that you use and why you think it's useful to you. And after a while, you realize that there's not necessarily anything empirical, if you like, about these individual things. And it makes you realize not to take them, treat them religiously as, you know, when you realize that it isn't the be all and end all, well, then all of a sudden you take all of them less seriously. And it should really be that if you find they have use, it's that they have use collectively rather than this one thing says that, therefore I'm going to do this. I mean, more than anything, now I use price, and that's what came about from that whole exercise. I would take one by one, I took every indicator off my chart until I was left with nothing but price. And that was like the bell ringing, like, well, there you go. That is actually all you need. What do you really need to determine the trend and where this thing is going? If you had nothing else but price, if you could only have one thing, it has to be price.
I'm really keen to actually dig into some of those comments you just made there a little bit deeper shortly. But just before we do, just take us through those few years after you kind of, you know, like we kind of mentioned, you had to almost reinvent yourself and you started reading up on different material and that sort of thing. What were the next few years like? I mean, did you struggle to find your feet and start making money, or did you pick this up pretty quickly?
Yeah, it was. Well, I started experimenting with different systems, and I would put money behind different systems. So I started trading for myself, but it was mostly futures, actually. I kind of used some of the basic trend following models that you see people talk about, where they might just use, you know, it'd be like a new 50-day high and exit on a 25-day low or something like that. Some of the basic things you use to model portfolios. And you can add other things to that. You can add trend filters to it, that it doesn't just have to have, in that example, made a new 50-day high. It could also be that it's done that, but also the 50-day is above the 100 and things like that. So I experimented with lots of different models like that with different filters and different criteria, and that really is about finding your time frame that works best for you, as well as a kind of a diversified portfolio, just how many different contracts you're going to look at. And I think I probably had about 20 to 25 different markets at the time. And it was, I mean, I had successes, and then I had other times where when the pullbacks came, they were perhaps a little deeper and harsher than I would have liked, and then that made me re-examine just how much I'm risking in position size. You know, you get used to people talking about 1% or even more, and I realized for me that was even too much. If I really wanted this to be super comfortable, it would even have to be less than that. You know, it's one of those things. It's gauging. Am I checking the futures at night, in the middle of the night? Are you, you know, you having to get up and worry about it? You need to get your risk down to the sleeping point where you don't have to worry about it so much. You know, is there something else that you're getting out of it? Some other kind of excitement or something from trading? You know, those are normally kind of warning signs. I mean, there's a difference about being passionate about what you do and enjoying it, but if you really want some kind of excitement or ego gratification, the market is not a good place to find it. I mean, you'll get crushed eventually. So, you know, you need to have those kind of outlets outside of trading. So what happened is it got to the point where I realized I wasn't going to be in a position to make enough in terms of, say, making a living from it. And I believe for most people, that probably is the case. They actually need way more than they have. I mean, I started to calculate that for that to be really comfortable for me, and for, you know, to not need any other source of income, and to be totally, you'd need all these other things paid off. You'd need your house paid off. You'd need your kids' college paid for, and all those kind of things. And then you'd still need, to me, at least $1 million trading account. Now, how many people can do that? Have those things paid off and have a million to trade? Well, I couldn't. I certainly wasn't at that stage. But it made me realize, well, fine. I've kind of built the groundwork here. I've done all the groundwork here, and I've built a fantastic platform on which to expand. But until I'm ready to build on this, or to make it actually a client business, in the meantime, I need to go back to getting some other qualifications and having another source of income in the meantime. So then I went back to working on the sell side. I had a local friend here who ran his own brokerage business, which was fortunate. So I then worked for him for 4 years. So that was from 2008 to 2012. And so I got all my qualifications again for that. So I had to get my 7, my 63. I got my CMT. I got an 86, an 87. I became a research analyst. I started writing technical analysis research, and went back to a lot of my hedge fund contacts in the UK and started doing some of that alpha capture stuff again. And towards the end of that is when I started to use social media, or rather follow people on social media, because I couldn't use it as I was on the sell side. And I actually grew very frustrated that I see all these people out there with this platform, if you like, for their views and for their ideas. And I got very frustrated that I had no voice. And I'd been in this industry all this time, but now the the movers and shakers, if you like, the people that were making a name for themselves and doing well, were all the ones who were able to tap into that community, and I wasn't. And it got to the point where I thought, I'm just going to have to do this. I'm in my 40s. If I don't do it now, when am I going to do it? And having to just take a leap of faith and like, let's, what is it you're waiting for? Just do it. I mean, it sounds, I'm saying it like it was easy. Now I'm saying that because of what I've done since and how it's turned out, some kind of hindsight bias. But at the time, it was a big decision for me. It was a giant leap of faith. And like most times when I've had to do that, it ended up being absolutely the right thing to do. And so that kind of brings us almost up to date, because that's at the end of 2012, I quit my last job. And in January 2013, I just started blogging with no audience, with no idea of how it would turn out. And I just started talking about my approach and what I think, what I believe. And it resonated with a lot of people.
Wow. Okay. What a brilliant answer, John. That was really good. So let's switch gears now and get into more about your particular approach. So if you could take just a few minutes to give us an overview of your actual trading approach and some of the things you're looking for, and then we'll zoom into it a little bit further.
Okay. Well, let me start by then clarifying what the different areas I have now, because I have two businesses. I have Broadsword Capital, which is an RIA that manages the long-only trend-following strategy through separately managed accounts, and I have Alpha Capture, which is really a publishing company which sells subscriptions to trading signals on my blog, johnborman.com, but also on the Benzinga MarketFi site. And both are really, they're using a long-only trend following on US stocks is what I do. And I mean, I say to people, I really boil it down to I buy stocks in uptrends and manage risk. And this is all part of kind of, if you like, my conclusion and summary of all the things we'd talked about previously, of the Van Tharp things of finding what you really truly believe about the market. And so I will say to people, what do we know? Or what do we know about markets? We know they're not efficient. We know we can't predict them. We know you can just buy and hold and you'll get your annual average return of 7%, but we can't tolerate the 50% drawdowns or more that we need to withstand to achieve that. So my solution is I'm going to have a simple rules-based methodology that's designed to capture existing uptrends, but it avoids the worst of any severe downturn. And how do you do that? Well, you incorporate strict discipline, risk management. You exit trends when they're invalidated. You preserve capital so that you're in a position of strength when better conditions then return. So that's what I do. That's how I'd summarize it. I buy stocks in uptrends and manage risk. And I mean, and just one word on, a quick word on trend following. I know there are people that always have this argument about trend following doesn't work on stocks. And it really gets down to how you define trend following. And some people, if you're really strict about the definition of trend following, always has to be that it's diversified, it's that it's long and short. Well, yeah, we're going to lose those facets of it. That's not, you're not going to have the diversification from different asset classes. It's all one asset class. It's stocks. So yeah, they're all highly correlated. Long short, I don't short stocks. I'm long only. So you lose that side of it. But to me, it's much more important that it's about the it's about the key principles of trend following. To me, are really about the risk management. That's what's crucial to its viability. You're going to have more losing trades than winning ones, but your average win will be far larger than your average loss. So you're still going to be profitable overall. It's about that's the whole running winners, cutting losers things. So, and so what I look for, simple stuff. They're really simple screens, all-time highs, 52-week highs. They could be 50-day highs. They just need to be new highs on whatever time frame best suits you. You might be able to trade across multiple time frames. Not everyone can do that. Sometimes it's better to just have one and stick to it. I will use daily charts. I might use weekly. If I get a signal on the daily that also coincides with the weekly, even better. You know, the more things that you can pull together, the stronger the signal will be. And I might hold for weeks to months. I sometimes incorporate a fundamental element into my stock selection. You know, it might be some kind of theme behind something, but the entry and exit triggers will always be objective. They will always be price-based. And I have to do that. I mean, it's a highly concentrated portfolio. So in a strong trending market, I might only have, because of the way I position size, I might only have 12 to 15 holdings at any one time. But that's pretty much how I go about it.
Okay, so in there you said that there may be like a fundamental theme underlying your decision to buy into a trend. Are you able to share an example of what this may be?
Well, it might be like, for example, the IBD list. The William O'Neill Investors Business Daily list of stocks that they have. You know, those are all stocks that have strong fundamentals, strong growth, and to use a simple example, it would be, you know, if I've got two stocks that made a new all-time high today, and there's one that I've never heard of, I don't even know what it does, and it might be fairly small and illiquid, or there'll be something like Ulta or Nike or something like that and it just happens to be an IBD stock. Well, I already know, without having to do much more work, if it's on that list, I already know that means it has really strong fundamentals. So I kind of like the fact that there's potentially that other kicker to it, if you like, that other fuel. What that might be what's fueling its advance. But at the end of the day, I'm only ever going to use price to determine my risk, my position size. That's going to determine my entry. It's going to determine my exit. I never make it that the fundamental element is the driver, the actual reason for the trade, because then if that's your entry rationale, well, that has to be part of your exit rationale. And the danger of that is then, you know, you suddenly have something going against you and you're down 10 or 20% and you're telling yourself, oh, but it's really good value, or but it's nothing's changed about the business. It's still the same great company, you know, and I don't trade companies. I trade stocks. I'm not trading their balance sheet. So yeah, it's good to know that that's sound and it's good and it's a good business. But at the end of the day, no matter how good it is, if the trend invalidates by price alone, then I'm out. And I might take a look at it again to see if it comes back on my screen. and I'll happily get in again. But I'm always going to be ruthless about managing risk, and I'll always take what price says about something than what an analyst or a balance sheet says about something.
Okay, now if you had to break it down to basics, what would you say are the advantages of trend following? And I mean, why does this approach really resonate with you? I guess what I'm trying to say is, why do you think it's a good fit for you, and what are the advantages that you see in trend following versus other approaches?
Well, it is absolutely that it suits me, and I think that's one of the most important things, that something suits your style and your personality. And I know sometimes people have problem reconciling that and saying, well, come on, how does something suit your personality? I wrote a blog post about this with my experience in this area, from having read Jason Williams' book, The Mental Edge in Trading, which does a fantastic job about talking about the importance of your psychological profile and how it might affect your trading. And by going through that exercise, and we can, I'll send you a link to it so that you can have it at the bottom of this thing, and people can go there and check it out, because it really is very insightful. That it showed me that I discovered what I was suited to. It had taken me long enough, but eventually you slowly start weeding out all the things that don't work for you, and you're left with only what does. And had I have just looked at this blueprint of my psychological profile and my personality years ago, I probably could have found out then, yes, you are suited to rules-based methodologies, and you have good discipline, you have low anxiety, low vulnerability, so you're going to be able to withstand it. That's kind of the thing it went through. So I already know I'm doing something that I'm suited to, which I think is very important. I mean, the pros and cons of trend following, sometimes they're one and the same. Because it's simple. It's good because it's simple, but that's also one of the cons. People will say, if it's so simple, why doesn't everyone do it? Well, because simple isn't easy. The things that make it work are the hardest things to do. It's every trade feels wrong. You're buying something when it's overbought. You're exiting when it's oversold. You've got to ignore noise. You're going to have losing streaks. You've got to maintain discipline, not just to take your exits, but to keep taking the entries, to take that next trade. That's why position sizing is so important, because that's what's going to keep you in the game. You'll have low trading costs. You should trade less often. You're using end-of-day signals, which means you have a lot less screen time. You don't need to be sitting there during the day watching every tick. But that also is then difficult, because it requires you to do nothing for long periods. And there are some people that really struggle with that. They have to be tinkering, they have to be doing something, and they feel compelled to act. And, so it's one of these things where the beauty of it is its simplicity, but it's precisely because of that it makes it so hard for many people to implement and to execute it.
Yeah, I'm glad you brought that up, actually, almost like the cons of trend following, or what about it that makes it hard for some traders to stick with. So yeah, I appreciate that. Thank you. Now, something I'd like to ask you about, you've touched on it already, but I'd like to go a little deeper. And I'm fairly certain this is your personal preference and not necessarily the school of thought for trend following, but Why do you choose to trade long only?
Well, the short answer is because I've never found a way to make money from shorting stocks consistently, and I don't think I'm alone in that. I mean, I've asked other people, well-known managers, when I was trying to get my thoughts together on these kind of subjects, and I'd kind of struggled to do it, and I've called a couple of people up and said, "Hey, look, I'm really struggling with this, and what I just can't seem to consistently find a way how to do it." And they effectively said, "Yeah, I haven't either." And and this is someone who's been managing money for 25, 30 years. And it's like, well, if thank you. It's like if they've told me that, then why the hell am I going to bother trying to find a way to make it work with the resources that they had at their disposal and their experience, and they've never found a way to do it. I mean, it's the price action is just it's different in downtrends compared to uptrends. Because we look at charts, you think it's people get used to thinking that following something in a downtrend is just the same as following in an uptrend, but it's not. They move very, very differently. You have short covering rips. Markets rise more. They rise slowly. They fall very quickly. And I'm sure people have seen that. We see that recently in the market action we've been having now. So it's the same with stocks, that they're vulnerable to. If it's a company that's in trouble, it might be they'll suddenly announce they're seeking strategic alternatives, and the thing just rips like 10, 20, 30%, or suddenly they become a takeover target. You can't back test properly, I don't think, shorting stocks, because you can't take into account what the borrow restrictions are, what the real costs were. I've noticed recently in this action in the last few weeks, when I've seen something on my trading platform and something's fallen heavily, and suddenly the little red indicator comes up alongside it that there's kind of there's restrictions on that stock, and there's limited borrow and things like this. Well, you never see any of that when you back test these things. It's very easy to look at the chart and say, oh, look at this, it broke support here. That would have been your signal to get short, and then you work out how much you would have made. You just don't know that you would have been able to do that. Because of the restrictions that might have been on at the time, but there's no way to get any of that historic data. It's also limited expectancy. The most a stock can decline is 100%. The amount it can rise is infinite. Well, I'd rather have that expectancy working for me than against me. I'd rather it the other way round. So I think it requires very specific knowledge of a company. The real reason why you're doing it. It could be it's a declining industry. It has some kind of obsolete product. There's some other fundamental trend going against it. Most of the most successful guys who do short. So it's not that they obviously do it well and they've made money out of it, and people like Jim Chanos and people like that. But I guess that's what I'm saying. Leave it to those kind of guys. It's what they do. It's a specialist thing. I think it's way too difficult for people who are used to trading the long side in a bull market, and they suddenly then think, oh, well, now it's a bear. Now I'll just start trading the short side, as if I'll just do the opposite of everything I did before. It just doesn't work that way.
Okay, that's a really interesting answer and perspective. So, do you feel that way about regardless of what time frame you're trading, whether you're trading maybe intraday or short-term swing trades, or whether you're in long-term trend following, do you feel that the same way about short trades on all those time frames?
Well, for stocks on a very short time frame, it might be possible for people to do that more easily, day trading, where you then don't have that overnight exposure and you don't run into those other problems. But you're still going to run into, it depends how much you're trying to trade, obviously, but you still run into the potential restrictions that are there. And I'm still not sure how you would be able to back test it. I just think there's more trouble than it's worth there. And for me, it just means when we go through those periods where we're mostly in a downtrend, it just means I have fewer and fewer positions until you're left with virtually nothing. And if we end up being in a fully fledged bear market, well, I'm going to be mostly in cash, sitting it out, waiting until I get opportunities on the long side again. And that, to me, I'd much rather just deal with it that way. It's just, it's really what works for me. And people have to find what works for them. And I'm sure there are people that do make money shorting stocks, but I think it's a really hard thing to do consistently.
Okay, no, that's really cool to get your insight, and I mean it's quite a unique perspective, I feel, from what a lot of traders are taught, especially when kind of getting into trading. Yeah, because I mean a lot of what you hear is just like, just do the opposite of when you go long, but you're saying it's quite different. So I mean it's really good to get your take on that. So when when the market is in an overall bear market, how are you treating that? Are you staying out altogether, or are you still looking for individual long trades on individual stocks?
Well, I will look for them, but it's unlikely that they'll be there. I mean, it may well then be that you get opportunities coming up on shorter time frames. Depending how long the downtrend that's preceded it. If we went into something like, imagine if we went into a bear market that, God forbid, went on like a year or 18 months, something like that. Well, the way you're going to come out of that kind of trend, you're probably going to have some kind of huge basing pattern over many months, some kind of saucer basing pattern, and then suddenly you'll start getting multi-month 50-day highs, even 52-week highs all of a sudden, because things had been range bound for so long. And then you'll be taking those. So it's not that you need to wait for all-time highs again before you get back in, but you'll then suddenly find you're getting some opportunities, and it may well be it's a false move, and you get stopped out of anything new that you took, and here we go to a new low again. But you just kind of dipped your toe in with 2 or 3 positions, and as long as you're doing it in a way where you're position sizing, where in the way I do, if you're only risking 0.5% each time you're doing something, well, you can still tolerate getting a few wrong until a true trend emerges again.
Now you mentioned 0.5% of capital risk per trade. Do you always have this fixed position size, or do you reduce to an even smaller size during times when you're underperforming or going into a drawdown type of scenario?
That's a good question, because there are elements of this which I am looking into, and I'm adaptable on it in potentially being even stricter than I currently am, or introducing something where it's more ATR based. But for the moment, for how I'm looking at things right now, it's pretty much, it's always 0.5%. And position sizing, to me, it's just one of the most important facets to any system. It's just it's the biggest variable in any system that you control. That's one of the things. That's a Van Tharp thing. I mean, beyond that book that I mentioned, he has since he's come up with another book, The Definitive Guide to Position Sizing. I mean, that is just the Bible on position sizing, and it's a huge book. It's an immense read, but it's just got everything that matters on the subject, I think. That was one of the things about breaking down the components of a system, and I believe it's only exits that determine whether something is a win or a loss. Until you've actually got out of something. It's only once you've got out that it then goes in the books as a win or a loss. The position size determines by how much. Entry just determines frequency, how often you're going to trade. So I kind of look at it that you can't control how price moves. So you can't control whether that trade's going to be a winner or a loser, but you can control how much it will impact you. And that's through your position size. And so that's what makes it so important.
All right. Well, let me ask you this. So, what if someone has a small account and it may not be feasible for them to just risk 0.5% of their capital, or maybe even 1%, once you factor in brokerage and that type of thing. Are there any pointers you could give to someone in this situation who perhaps needs to risk more than 0.5% of their account? They might just be trading, $5,000 or something along those lines.
Yeah, that's going to be tough. The reason why that becomes more troublesome, though, is that when you have an account that small, it then becomes more about the trading costs. That very often, all of a sudden, those costs become a much higher percentage of what it is you're trying to do, especially if you're trying to do it on a tiny amount. The answer really is that if you then want to reduce those things, you have wider stops, which then result in a smaller amount of capital per trade. If you're suddenly, your stop is like, I don't know, 20% away. So it will mean it's over a longer time frame. You might be using a weekly close. You might even be using talking to someone the other day who uses a monthly close on how they take positions. See, the irony is with small accounts, you should actually move to even longer time frames with wider stops so that you have smaller positions. But actually, most people, they go the other way, because they then think that they have to build up their capital, and they end up trading shorter time frames and trading more frequently. And I actually think it should be the other way around.
Okay, that's a great point you bring up. Now, just still on the trend following approach, I mean, I understand it's likely that you'll have a losing year from time to time, or if not a losing year, an extended period of time before you continue to make new equity highs. So if that's the case, I mean, how do you deal with this, and how do you control yourself from continuing to trade the strategy without changing it?
Yeah, this really is one of the most difficult aspects, and it's going to come down again to being suited to it and the personality thing. It's about sticking to the system. You got to keep taking the signals, keep position sizing correctly. And I know that it's so easy to say, and people will say, well, I know I'm supposed to do that, but how do I do it? No one tells me how to do it. And I got to be honest, I'm just not sure you can teach that. I think you have to learn it. by experiencing it. It's like telling someone who says they want to lose weight, well, eat less and exercise more. They know that. That you think they don't know that? They know that, but for some reason they don't want to do it, and they'll look for a different way to do it. And it's a similar thing with trading. It's there's the rule, just stick to the rule, but there's something else making them not do it. And unfortunately, they've got to find out what that is. They've got to find out what it is about themselves. If they can't follow their rules, only they can know why. That they have to find out the answers in them. They have to find out what it is. If they truly believe in what they're doing, they won't hesitate to stick to the system. And I've got to a point where I believe in what I'm doing, and I know it's right in the long run for me. So I don't look at these individual trades as I think in terms of 1,000 trades. This is just one of those trades, and it almost doesn't matter that it's whether it's a win or a loss. It's just one of the 1,000. You just keep taking them and keep treating them all in the exact same way. Because if you know and believe that you're trading a positive expectancy system, then you have to keep doing that in order to get the final result that you'll get. So this is why it's so important that as much as possible you try to develop rules of your own that suit you, rather than follow someone else blindly. Because as soon as it gets tough, if you're following someone else, you'll abandon it as soon as the system suddenly doesn't match your personality, but it's still easy for them to implement. You can't change your feelings, but you can change how you respond to them, and that's what people have to be able to answer for themselves.
Very well said. Another great answer there, John. Now, are there any resources just off the top of your head that you could recommend to any other traders who are keen to learn more about trend following?
Sure. Well, the obvious one, trendfollowing.com, is Michael Cavell's site, and his book is always a great place to start on the overall subject of trend following. I mentioned the couple of Van Tharp books, Trade Your Way to Financial Freedom, The Definitive Guide to Position Sizing. Andreas Klenow has written 2 fantastic books in the last, I think the first one was a couple of years ago, and he just wrote another one earlier this year, Following the Trend, which is mostly about a futures-based system and kind of how CTAs manage money. And then this year he wrote Stocks on the Move, which really although I know he is one of these people that doesn't like to call it trend following on stocks, and we've spoken about this and joked about this, but to me that is what he's doing in that book. It is trend following on stocks, but he just doesn't like to call it that. He might call it more like momentum or something. And if someone wants to find out more about the whole personality side, the mental edge in trading, Jason Williams, I think, is a fantastic, insightful book. I'm on my blog, johnborman.com. You can read everything I've ever written in the last couple of years. Everything's stayed up there. Always try to stay as transparent as possible on everything I do. And I'm also on the MarketFi platform, and StockTwits and Twitter at jborman.
Awesome. Well, I'll make sure to include all those resources you just mentioned there in the show notes for this interview at chatwithtraders.com/43. So thanks very much for sharing those. Bunch of really good resources there. So anyone who wants to learn more about trend following, definitely check those out. Chatwithtraders.com/43. Now, John, just to take us out, would you like to leave listeners with any tips for long-term survival And if you like, feel free to repeat and reinforce anything you've already mentioned.
Sure. I think it's about having a plan, and you really have to, and one that suits you, which we've talked about several times already. But in trading terms, it's about being clear about your objectives. I think it can be dangerous when people try to target returns. They'll say, well, okay, I want to make X per year, divide that by how many days, so I need to make this amount of dollars per day. I think when you have objectives and goals, you need to make them process oriented, not outcome oriented. Stick to the process and the outcome will follow. It's about having small incremental steps that you bring about big change.
Excellent. All right, John, good stuff there. Thank you very much for sharing this. Before we say goodbye, John, can you just share once again with listeners where they can go to find out more about you and connect with you? So maybe your website and your Twitter handle.
Yeah, my website, Alpha Capture, is johnborman.com, and I'm on StockTwits and Twitter at jborman. Always happy to connect and help people and answer any questions.
Awesome. All right. Really good stuff. And I'm pleased we were able to make this happen. And thank you very much for giving up the time to do this. Thanks again, John. Enjoy your day and let's stay in touch.
You're welcome. Thanks for having me.
What's up, guys? It's just me again. Thanks a lot for listening to that episode. I hope you really enjoyed it as much as I enjoyed speaking with John. He was a really interesting guy. And I mean, I'm sure we could have kept going for much longer than we did. But the funny thing is, we actually recorded that interview. It was 12 a.m. Saturday night for me, middle of the day for him, of course, being on the other side of the world. So if I was a little bit slow in parts, don't judge me too harshly. That's my excuse for it, okay? So just a real quick reminder about the giveaway that's kicked off this week. And we'll be running through till the 7th of November this year, being 2015. So the giveaway is your chance to win a free 90-minute one-on-one mentoring session with one of the Chat with Traders coaches, and there's going to be 3 winners, seeing as there will be 3 coaches. So just real quick, those coaches are Chris Sace, Zach Hurwitz, and Brad Jelinek. Each awesome traders who have previously featured on the podcast and past episodes. Really insightful guys, and I can promise you'll learn a lot from them. So if you'd like to enter into this, just go to chatwithtraders.com/win, that's WIN, and enter your email address. Once you do this, you'll receive a unique URL. Take that URL and share it as much as possible, because for everyone who clicks it and then enters into the giveaway, you're going to receive another 9 entries. So it's an easy way to rapidly put the odds in your favor and boost your chances of winning. So just in case you missed it, that's chatwithtraders.com/win, WIN. So go there, enter now, and best of luck to you. And if we don't speak in the meantime, let's catch up next week.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey there, what's up guys? Big thanks for tuning in to this week's episode, and as per usual, it's really great to have you listening. Now, let me introduce you to my guest for episode 44, Michelle Koenig, from Montana at the very top of the United States. Michelle is primarily a swing trader of technical chart patterns, but also takes an occasional intraday position when she spots an opportunity. During our discussion, we spoke about a whole range of really interesting topics. To start with, we covered Michelle's first few years when starting out, where she had some early success, then shortly after, lost almost everything. We spoke about how this happened, how she was affected, and how she bounced back. Plus, some of the other highlights would have to include insight to Michelle's scanning process and how she tracks a watch list, a reminder not to trip over dollars while trying to save dimes, and some words of wisdom to traders who are yet to break through. Now, I'd like to give a quick reminder about the Chat with Traders giveaway that's now in full swing. So if you haven't entered or heard about it already, this is your chance to win a free 90-minute one-on-one mentoring session with a pro trader. So if you'd like to enter, it's very simple. Just go to chatwithtraders.com/win. That's WIN. Plus you can get more info there as well. And if you have already entered, then take this as a friendly reminder to share the unique URL you received immediately after you entered. Because for everyone who enters the giveaway via your unique URL, you receive an additional 9 entries, instead of just the 1 entry you receive by default. So if you want a way to ramp up your chances of winning, then get busy and start sharing. Okay, so in case you didn't catch this, for more info and your chance to win a free mentoring session, go to chatwithtraders.com/win, WIN, and enter now. And just a heads up, entries will be closing 7th of November and there will be 3 winners. Now let's jump to this week's interview. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is my guest, Michelle Koenig of Trade on the Fly. Hey Michelle, what's up? How are you?
I'm great. How are you today, Aaron?
I am doing very well. Thank you so much for making the time today to do this interview. It's really good to be speaking with you.
Thank you for having me. I appreciate you inviting me to be on the show.
Awesome. No trouble at all. I mean, it's great to have this opportunity, and I'm really looking forward to hearing more about your swing trading approach, plus some insight to how you manage day trades also. But before we do that, we'd like to learn more about you, your journey, and where you've come from. So let's take this right back to when you very first began trading. So tell us, what was your introduction to trading and what were you doing prior to this?
So my introduction to trading, I came from a finance degree at Montana State University, and that's actually where my initial interest came from. Besides the classes that I had at the university, the biggest, I guess, catalyst for me was during my senior year, we had a lot of projects that we had to work on in groups with different members of my class. And one night, a group of us had gotten together to work on one of our projects, and we were all sitting around the table visiting about this and that and about the different jobs, the part-time jobs that we all had while we were in college. And there was one fellow there who was an older student at the university. And when it came to be his turn, we asked him, well, what do you do? And he said that he went down to his local broker's office every month or every quarter and would select a few stocks that he would buy. And if those stocks did well that month or that quarter, he didn't have to go out and wait tables or bartend like the rest of us. And I remember that has stuck with me and stuck with me after college and through the whole time before I started trading was, how could this guy buy a few stocks and make enough money to pay all of his bills and pay for school by buying and selling a few stocks. And I really liked the idea of that. I liked the idea of not being tied to an hourly amount that I was earning or a salary. And so that always stuck in my mind after I graduated from college. And I left and went to work in pharmaceutical sales and moved away from Montana for a period of time. And when I moved back to Montana, worked many different various jobs, part-time, and then got an opportunity to actually go to work just as an office manager for Edward Jones. And it was around the time that E-Trade and Ameritrade were kind of coming online. And so it was more realistic for people to, be able to think about trading on their own from their own computer, and more affordable. And when I left there, I actually went to work in software sales. So I was sitting in front of a computer all day long. And through the exposure that I had at Edward Jones, decided that I wanted to try and start trading part-time on my own while I was working in software sales. So that was my early introduction, I guess, to trading, and where the interest really came from was remembering that this guy had been able to be in college and not have to work these part-time jobs and make enough money through buying and selling stocks that he could pay his way. And I really kept going back to that in my mind, that I would like to be able to get to a point where I could be my own boss and not be capped by any salary or hourly rate in my earning capability.
Sure, okay, that's a really cool story. So while you were trading part-time, how were you learning? Were you reading books? Were you taking different sorts of courses? Or was it all from what you'd learned in your finance degree?
I didn't use any of my finance degree. It was kind of trial by fire. And when I initially started trading part-time, there was no plan. I would spend time on message boards and, just watching tickers on my screen blinking back and forth. And I didn't really have any, I didn't have a plan. I just started trading stocks randomly and, would try and find things maybe that were news related or earnings related, but I really had no clue when I started trading part-time as far as what I was doing. And, my account would go up a little, it would go down a little, but didn't really make any headway early on part-time. And when I spent more time, realizing I wasn't making any forward progress and had heard about technical analysis, decided that it was time to try and make some sort of a plan, start reading some books. And so I started getting books on technical analysis and started reading those books to try and figure out a plan for how I might be able to trade, or things that might be able to help guide me in my trades. When I started trading, things were much different than they are today. We didn't have chat rooms. We didn't have the social media and the access to information that many traders have these days. And I certainly didn't have a mentor. I was, sitting in front of the screen by myself trying to figure out what I was doing, and didn't really have any clue. So things were a lot different back then.
Okay. Yeah. And one of the things you mentioned there is how, of course it was a lot different back when you started. Do you think that it was, you said there was no chat rooms, there was no social media was less prevalent. Do you think that was maybe easier because there was less noise around, and some people now say that now there's just information overload? Like, how do you feel about comparing these two times?
When I think back, I guess, in hindsight always is 2020, but when I look back at my early days as a trader versus when I look at the ability that newer traders these days have to access mentors or different tools to help them in their trading, and then with the social media and the access to more information to help you make decisions, I wish that I had had a lot of those tools back then. I feel like my learning curve would have been a lot shorter, I think, if I had had access to that, people to bounce ideas off of, mentors to help guide me, people to ask questions. Because like I said, back then it was just, reading through books and trying to figure out. I didn't have anybody at that time to, verify, was I on the right track, or if I was having, a difficult time being able to bounce ideas off of somebody, or have somebody take a look at what I was doing to help me identify where I was making my mistakes, and how to get back on track. So things are noisier today, but in my viewpoint, I wish I had had a lot of the tools back then that people have access to today.
Sure. Okay. No, that's really well said, Michelle. So let's walk forward another few years in your trading journey. Like, how did you transition from trading part-time to going full-time?
So I traded part-time for about a year or year and a half, I think, before I started trading full-time. And when I made the transition, I was fortunate in that my husband, had a full-time gig. And I hear from a lot of traders today who are wanting to make the transition without having, something like that to back them up. So I was fortunate when I decided to make that transition that we had a steady form of income, that we weren't reliant on everything that I was making to pay my bills. So that was very helpful. The software company that I was working for lost all of its venture funding, and I decided at that point to try and make the leap from trading part-time into trading full-time for a living.
Okay, and when you did that, did you have some sort of consistency with your profits at the time, or were you still trying to find your feet?
I was definitely still trying to find my feet. I had spent enough time looking into technical analysis that I knew that charting and trend lines and technical indicators was the direction that I wanted to go. But again, still didn't really have a solid plan or understanding of how much thought I should have been putting into it. I just decided I was going to make the leap. And I had a lot of early success. Very early on, I was very more disciplined, I guess, in following, some of my technical indicators and my chart patterns. And I had, in less than 6 months, more than doubled my account. When I made the transition from trading part-time to going full-time, when I started full-time, I started trading with around $40,000. And I doubled that to a little bit over or right around $100,000 in less than 6 months. So I had some very early success very quickly. Unfortunately, along with that came a lot of overconfidence and a lack of discipline and thinking I was smarter than the market. And it has a very funny way of teaching us those painful lessons very quickly. And through, being sloppy, not following rules, not being disciplined, over trading, I gave all of that back and then some, and had to basically start over more than once early in my trading career.
Okay, and I'm keen to know, because you came very close to blowing up your account, 2 times, like you kind of mentioned there. What was it that motivated you to keep going? Was it that you'd seen that you could make a success? What was it that kept you going, like after you'd just lost, quite a substantial sum of money?
I think one of the things, several things, I guess. One thing was that like you said, I had some, I had a taste of what it could be like. And I really craved, I guess, the independence that trading gave me. I've always had a very entrepreneurial spirit, I guess. So I liked being my own boss. I liked not being set on a certain salary. I think also being very resilient. I'm very stubborn and I don't give up on things easily. And so just because I'd had a big setback, and it was very painful, it was very hard emotionally when that happened, but I still was not going to give up on this and felt like that I could make it trading and just needed to get, pick myself up and start moving forward again in it. So I think being resilient, having an entrepreneurial spirit, being very self-motivated helped me continue to move forward with the trading.
Excellent. Okay. Now, one thing I'd like to ask you about, and this is kind of talking about the beginning phase of a trader's development. I think it's fair to say there is a certain amount of confusion, as in what I'm doing, is this a sustainable approach? Do I have solid trading principles and that type of thing? So with that being said, at what point did you begin to find actual confidence and clarity in your trading style?
For me, I think when I started really treating it like a business, understanding that I needed to have a plan and a strategy and rules in place for moving forward, and understanding also that taking losses was part of trading. Part of some of me going backwards with my account was the inability to be willing to take a loss. And that comes, as trading is you're going to have losses, and the key is to keep those losses small and continue to move forward. Even with any trade plan or trade setup that you may be working, they don't always work out. And I see often that, new traders take it personally and they're not willing to take those losses. They turn, the trade into an investment and they start using the hope strategy. And I used to do a lot of that as well early in my trading. And so I think that making sure that you're focusing on what your plan is and treating it like a business. I don't think that anybody out there who's been in business for themselves or who would be thinking about being in business for themselves would think one day they would just wake up and say, oh, I'm going to open a business today. I mean, there's so much more to it. You have to have a business plan in place. If you need to, you're going to need to have a certain amount of working capital. If you need to go to the bank to get a loan, the bank is certainly going to require a lot of planning and strategy from you in order to get a loan from them. You're going to have to understand, who your customers are, and those sorts of things. And I think that starting to think about trading in more of a business sense helped me.
Okay, and just so we're clear, before we move on too much further, how long into your journey was this moment when you did start to become a lot more confident and you did start to see a lot more consistency in your results?
I would say it took me about 3 to 4 years to start becoming really consistent and having, the confidence coming from having a plan, understanding what my personality style, what the trade style was that was going to work for me. I spent the first couple of years with a lot of ups and downs, and 3 to 4 years into it, things started to smooth out with getting a plan in place, being able to follow the plan, being able to execute it. The other thing that also helped me a lot with that confidence, and moving, I guess, from feeling, like you're the up and down to being a consistent trader was getting the emotions out of it for me, or starting to work on getting the emotional side of trading out. And for me as a new trader, I remember, like that early success that I talked about. I mean, I just felt like I was on cloud nine. I was making all this money. Life was going to be great. I could see the writing on the wall. I was already making plans for the purchases that I was going to make, and it was a great feeling. And then going from that to the opposite end of the spectrum, where I had gone backwards in my account and lost everything that I had made, that was, equally in the opposite direction, just devastating, and being really down in the dumps and feeling horrible about myself and not having any confidence. And so that emotional roller coaster, it was really helpful for me in my trading as time went on. And I've been asked many times, how do you get the emotions out of trading? And I've thought about that a lot because I get asked that all the time. And I think, part of that certainly comes from having a plan and a strategy and understanding why you're getting into trades and how you're going to manage those trades, but also time in the seat. So as time went on, the big roller coaster became sort of more rolling hills to, kind of more like a washboard when you're driving down a bumpy dirt road. So that helped me a lot as well.
I like that. That's a really great answer, Michelle. So now let's talk more about your trading style and how you approach markets. So if you could, give us an overview of your trading style and shine some light on the type of time frames you're trading, your average holding time, and what markets you're most active in as well.
So I'm primarily a swing trader. I also day trade, but the majority of the money that I make does come from my swing trades. And because I'm a technical trader, I'm looking at chart patterns, and I use technical indicators to help guide me in those trades. So I'm looking for specific chart pattern setups. So maybe flags, maybe ascending triangles, maybe descending triangles. I also can trade within a range. So trading something that's, in a support and resistance area that's clearly marked on the daily chart is another way that I can do my swing trades. And the best type of market to swing trade in is obviously one that's trending either up or down, which we certainly don't have this year. We've had a very choppy market that's much different than what we've had in the last several years. So it's made it more difficult for swing trading this year. So tightening up the time frames, and I use the 60-minute charts a lot I start out with the daily chart whenever I am doing my scanning and looking at any individual setup. I'll start with the daily chart, looking for specific chart patterns, or for example, maybe a pullback to a technical level that would make sense. For example, maybe the 200-day moving average on a daily chart. And then I will drill down to my 60-minute chart next to take a look at that to see how it's setting up in that time frame and to help me identify an entry. Sometimes I'll go a little further with a 15-minute chart, but very often I can find a level that makes sense for me on the 60-minute chart. And I'm looking also with my 60-minute chart to see, for example, if it's a stock that's been pulling back, on the 60-minute chart, I like to use the 50-period exponential moving average a lot to help me identify the trend in that smaller time frame. And very often, certainly not all the time, but very often in those 60-minute charts, using the 50-period exponential moving average, I can look for trend changes above and below that moving average that will give me a nice shorter-term swing, maybe for, 4 or 5 days, maybe 10 days. But in this market this year, it's been more of a market to book the profits more quickly. So my holding times this year are certainly much shorter than what I would prefer to have, but it's the market that we have. And so we have to learn to adapt and adjust to what the market's giving us.
Okay, and just to head a little more on what markets or what kind of stocks you like to trade more, I understand that you sort of prefer the cheaper stocks or the smaller caps more so than the blue chip stocks. I mean, what's your reasoning for this? I mean, what are the key distinctions between the two? I mean, do they generally behave differently? And have you ever run into liquidity issues as well, as these often trade lower volume?
I would say that I don't have necessarily a set, market cap or type of stock that I like. I do like, some of the lower float stocks when they do set up correctly, because being that they have a lower float, they can make some nice moves very quickly in short order, which is certainly nice. But I'm not going to discriminate either against a higher market cap stock or, a higher price stock either. So, for example, in my scans, I mean, I can have a wide range. I'm not afraid to trade something that's $1, and I'm not afraid to trade, Netflix or Amazon or Google either. It's all related to the setup, and the move that I think that it will make. What I will say in the setups that I like, I do tend to steer clear of the slower moving stocks, just because even though I'm a swing trader and I have some patience, my patience is not great on the very slow moving stuff. So maybe the Microsofts of the world, those sorts of things that tend to move slower are not usually on my radar. I'm looking for stuff that has more volatility and is going to have the ability to make a move, in a shorter time frame. I don't want to have to wait months and months for the move to be made. I would rather see something be made, in a 3 to 7 or 8 or 9 or 10 day time frame.
Sure. Okay. No, that's really good to know. So, what are the advantages that you see of a swing trading approach? And then on the other hand, what are some of the challenges that come with a swing trading approach also?
So I think the advantages with a swing trading approach is that, at least for me, it tends to be a more relaxed style. I'm looking for, specific setups with certain criteria. And when I take those trades, I use set risk, and I'm trying to give that trade time to work. So I don't have the pressure of the trade has to work in this 15-minute time frame or sometime before the market closes today. I'm going to be able to give the trade some time, as long as this trade continues to act as I would expect it to act, to go ahead and work to try and advantage for a larger gain with the swings. And because I'm able to give it that time within my set risk, I can be more relaxed. I don't have to be staring at it tick by tick and worrying about, a 25-cent move or 50-cent move up or down intraday that might be harder for a day trader to sit through. The disadvantages of being a swing trader, or one of the things that's difficult for people with swing trading, is having the overnight risk. The risk that news comes out overnight that's not favorable for your position. And even though you have a stop set in place, that stock may gap above or below wherever your stop may be. And that risk is certainly out there. And one thing that I talk about, or, you can offer to people if they are hesitant with that, is to use ETFs, the exchange traded funds. Not that there still isn't risk with those, but your risk will be spread over the basket of stocks that the ETF holds, or over the sector or the commodity that the ETF tracks. So, and the other thing as well with that, with my swing trades, I never hold into earnings. I never hold through earnings anymore, and I never hold through any news-related event that I know is coming. There are going to be times, though, that you are caught in something that's unfavorable. And so you need to make sure that anything that you are swing trading, and holding overnight, that it's sized appropriately so that if there is something unfavorable, it's not devastating to your account.
Sure. Okay. Those are really great suggestions there, Michelle. So thank you very much for sharing those.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Are you able to share one or two of your favorite chart patterns or setups to trade? Like, what's an example of something that really piques your attention once you see it happen?
So I would say that on the daily charts, if I had to just pick two patterns that would be my favorites, I would say a flag pattern, whether it's bullish or bearish, I like the best. They're usually very clear, and the volume is going to confirm that pattern. They take a little bit of time to develop, but usually I find those patterns to be fairly reliable, and that when they do break out of that pattern, the move out of that pattern often is a very nice move that usually comes fairly quickly. The other pattern that I would say that I like very well off of the daily charts would be, triangles, either a symmetrical triangle or an ascending or descending triangle. Again, those patterns are very clear. The volume confirms within the patterns, and usually on the breakout of those patterns with volume, you'll get a nice move that will extend for a period of time. Now, I do also really like, and I've been asked this before, if you could only pick one pattern to trade ever, I really, really like using the 60-minute time frame with that 50-period exponential moving average, looking for what I call a trend change there. If the stock has been in a downtrend, usually with that particular moving average, what I'll be looking for is the moving average will start to flatten out. You'll see that the price will start sliding sideways, and the price might even start, perking above that 50-period exponential moving average, maybe back below it, back above it. But as the volume dries up and that moving average and price converge, and that price will get above the moving average and hold, usually that will be a trend change there that will often be sustainable for a nice move or for a period of time. And you can use it inversely as well. If a stock has been in a bullish mode and the price starts to falter and the moving average starts to top out and the price falls below it, you can use it to short as well. So if I only could pick one thing to use in my trading, it would actually probably be that trend change up or down on that 60-minute chart.
All right, good one. That's really cool. So let me ask you, what did it take for you to build confidence in these patterns and setups? Like, what happened for you to be able to regard these as reliable patterns? And like, when did you begin to form a belief in these patterns? Is what I'm trying to say.
I don't remember, I guess exactly the moment in time in my trading. I just know that, early on when I started using the technical analysis books and reading and looking at the chart patterns and finding them over and over in my charting. So I store all of my charts in stockcharts.com. And so I've used that for almost my entire trading career. So I have 13 or 14 years. I think I've actually been a member there for 13 years. So I have 13 years worth of charts stored there. And I sift through those charts all the time. So part of getting confidence in those, I think, is just staring at them for years. I think that I am wired to love to look at charts. I love looking at charts. I think for me, it's a little bit like putting together a puzzle. And sometimes it takes a long time in the charts for, a particular pattern to set up or for me to find something that I like or that makes sense. And so I'll continue to monitor, different charts that may be on my different watch lists that I have for something that I can make sense out of, something that's tradable in my mind. So I think part of, having the confidence in the chart has just come from years and years and years of looking at charts and following them. And now for me, when I look through charts, I can look through them extremely quickly. And my eye just will almost automatically pick out whether I have lines drawn on it or not, what the possibilities or what the setups are if they're there. I think just through a lot of repetition.
Sure, yeah. I like how you mentioned that repetition. And it's just something that's kind of happened over time and built up and formed. So, yeah, that's really good. Now, you've mentioned already that you use moving averages and exponential moving averages. Are there any other indicators that you use on your charts? And to what degree do these indicators influence your decisions to buy and sell?
So through the years of figuring out who I was as a trader and what I wanted to use, I remember early on, I would go through a lot of different indicators and moving averages, trying to figure out what I liked. And I remember there was a period of time where it seemed like I had 20 different indicators on, my chart, and it was very cluttered and very confusing. And so again, through time and I think through trial and error, what I use now is on my daily charts, I use the 200-day simple moving average and the 50-day exponential moving average. I use the RSI and I use the MACD on my daily charts. And for me, my technical indicators are guides. And I think that that's really important, especially for new traders, to remember that they are guides only. They are to help confirm what you're seeing with price and volume. Your price and your volume are most important, and your technical indicators are there to help confirm what you're seeing or to help foreshadow the possibility, of different trend changes coming, but not to be relied on solely. You've got to look at price and volume first. Then on my intraday charts, depending on the time frame that I'm looking at, like I've mentioned, the 60-minute chart, I like to use that 50-period exponential moving average along with volume. And then I use on my intraday charts, I use the slow stochastics a lot. And what I use those for is to help with overbought and oversold levels, to help me identify the areas as a stock pulls back or as it breaks out, does it make sense to buy here? And so I love the slow stochastics intraday. And when I am day trading, I use those slow stochastics a lot with my charts. If I couldn't use moving averages at all on my intraday charts, I could only pick one thing, I would use my slow stochastics and volume.
Okay, excellent. Now, that was, so we kind of covered the indicators that you use there, and you've mentioned previously that you like to stay out of the way of news and that type of thing when you know it's happening. What impact do fundamentals have on your trading decisions, if any?
I would say 95% of what I do is all based on technicals and maybe 5% fundamentals. So I will go and look at, for example, short float or what the float of the stock is, or, how much is held by the institutions. Those sorts of things can be interesting to me. Also, insider buying, if there's been a lot of strong insider buying, that's of interest to me. And I will do a brief run through an earnings report if news has been favorable for a stock and they've, come out with their earnings report. I'll look to see what their forward guidance, I don't go through it with a fine-tooth comb, but I will sometimes look through an earnings report briefly to help support, I guess, the technical picture that I'm seeing. But like I said, it's a very small, the fundamental portion of what I do is very small, and it's very limited to certain things that I'm interested, such as the float, the short interest, those sorts of things that could affect how quickly a stock may move.
Okay, and where do you get access to that type of information that you just mentioned there?
I pull most of it from finviz.com. And I know, there that the short interest data is not necessarily as of today, but it's going to give me a general feel. But I just use FinViz. A lot of people use, for example, Yahoo Finance There's a lot of different resources online where you can access that sort of information, but I like the format that FinViz gives me that information, and they provide me a very nice chart when I look at that information, so I don't have to go chart it somewhere else. So I really like that as a bonus.
Sure, okay, good one. So while you're predominantly a swing trader, you also day trade as well. So what I'd like to know is, how do you decide which trades you're going to be out of before the close and which trades you're going to be in for a swing position?
So the swing trades that I have are all coming from my scans. My day trade stuff that I do during the day is going to come primarily from news related things that are moving during the day, or it could be earnings, it could be any sort of news that's come out on something that's giving it intraday momentum. It could be a stock maybe that I've been watching that's trading in a range that I can make sense of intraday to trade. Now, what I will say there are times when I take something that's a day trade for me that's acting very well into the close that I will hold a partial position over if things are acting very well going into the close, and I like my entry on it to hold for just an overnight, maybe a 1 or 2 day swing. So sometimes the day trades will turn into swing trades for me, but I don't ever hold anything over that is not acting well into the close. So my day trade primarily is going to come from something that's news related, that has momentum, that's moving during the day.
Okay, so in that case, how do you go about treating profit targets and deciding when you're going to get out of the trade and lock in your profit?
Sure. The entries are always the most important part, and it's the easiest part of the trade for me. The exits have always been the most difficult part of the trade for me, is figuring out, where it makes sense. And what I do with my swing setups, the day trade stuff is different, but with my swing trade setups, I use a combination of my trend lines and my moving averages to, once I'm in the trade. So on the entry of the trade, obviously my stop is going to be set below my entry, and that stop is going to be set again using a moving average, using a trend line, and an area of support below that's within my risk tolerance levels that makes sense for me, that should support the stock, if it goes below my entry. Once I get cushion and once I have profit in the position, then I will continue to move those stops up. And I'm trying to be mindful in doing that I've got to try to avoid some of that intraday volatility, because every stock is going to move up and down during the day. And you're trying to avoid getting stopped out on that intraday volatility on your swings. Again, evaluating, is this stock continuing to act as I would expect it to act? Because nothing, or rarely does stuff go straight up or straight down. Things are going to move up, and then they're going to do one of two things. They're either going to consolidate through time, or they're going to pull back to a level that makes sense and work off the overbought conditions before they can move higher. So in figuring out where I'm going to exit the trade, I continue to use my trend lines and my moving averages to try and continue to give that trade time to work and move my stops up as the trade develops. Now, on the exit, it can be exited through two ways. If it's a specific chart pattern on the daily chart, so for example, a bull flag, there's a measured move or a potential measured move that comes with that target that I can be looking at as a possible exit. I can calculate where that is. It should, be clear to see on the daily chart. So that would be one option for me. The other option is to, if I'm using that 60-minute time frame, I can use my moving average and my trend lines to help continue to give that trade some room and time to work and continue to move that stop up, and then just get stopped out of the trade with a profit. Ideally, would be the other way that I'd exit, is I would allow that trade to continue to work, and as long as it's acting as expected, I move that stop up, and once it stops acting as expected, that stop will take care of the position for me. So it kind of depends on what the setup is. If it's off of a technical pattern that I can identify a potential measured move, I'll be looking at that. If it's off of a 60-minute chart that I'm using that trend change in, then I'm using my moving averages and my trend lines to help me. The other thing that I can look at there as well is areas of resistance above on the charts, on the daily charts, that it would make sense for the stock to pause at, or if the stock is getting very overbought and very extended, that would be another option for taking the position off and allowing it to consolidate or set up again. And then I can always re-enter the position again off of a new setup.
Okay, cool. That's really interesting. Now, Michelle, when we were speaking the other week, you mentioned that you ultimately like to keep your trading very simple. Could you speak to why you have such a great focus on avoiding complexity?
I think that, like I mentioned earlier, when I was trying to figure out who I was and using a lot of different moving averages and having a lot on my charts, I found that it paralyzed me more than it helped me. And, through the years, I've tried looking at different things to add into my trading. And I guess ultimately, maybe it's just how I'm hardwired. I'm a pretty simple person. We live in Montana. We like pretty simple things. We don't live a very, fancy or floofy lifestyle. And so maybe it's just kind of how I'm hardwired as a person. For me, when I look at the charts, if they're very clean, and I can make sense of stuff, on the charts, that just works for me, I guess, for my personality style and who I am, is just, keep it simple, stupid.
Sure. No, I like the way you explain that. That's really cool. So could you walk us through your process for scanning? Like, how do you go about creating watch lists? Maybe if you could tell us a little bit about what software you're using, or are you visually scanning, or are you using parameters and criteria to filter? Tell us a little bit about that.
Sure. So the way that I do my scanning, and again, probably one of the most popular questions that I get is, can I have your scan recipe? And the way that I scan, again, so in my stock charts account, I have my list, I have a trade watch list, I have an A, B, C list, I have lists of stocks by different sectors. And the way that my ABC list, I'm scanning through every day, just visually going through and so one of those lists has about 260 charts in it. I look at probably anywhere from 300 or 400 to 600 charts every day. And so my scanning process is very antiquated, probably. I love looking at charts. It's just how I'm wired. I love, just visually going through the charts to see what makes sense, what's setting up. The other thing that I do as well, though, is I can easily, as the money rotates from sector to sector, if oil starts acting well, I can quickly pull, my energy plays up and run through my list of setups to see which ones I want to pull and which ones I'm going to ignore. So within the setups, and the scans, they're not even scans, my lists of stocks that I have, it's very easy for me to jump, to the sector with my list of stocks that I like in that sector or that I'm watching, as the money rotates from sector to sector. If gold's doing well, if natural gas is doing well, if cybersecurity is doing well, I can easily go to my list and stock charts and pull that up. The other way that I do pull new ideas, or I do look for stuff that would be more shorter term or maybe for day trades, is I'll look at the percentage gainers list. And again, I pull that from FinViz because it's very easy for me to go there and look at everything in chart format. So I can pull up the percentage gainers list in FinViz and run through the charts and then pull the ones that I'm interested in and leave the ones that don't. So I don't have software. I don't have, a scan that I use on a regular basis. I have a couple of scans, I guess, set up in FinViz. I don't use them very often. My scanning process is just a very manual process of just constantly looking at charts. If there's a new stock that comes up that's, news related, I can put it into the appropriate list, or I can put it into my A list to start watching it every day to see how it sets up. And then what I do is I pull the charts out of stock charts as I'm interested in them or they're getting close. Then I pull them into my platform in Thinkorswim. Again, love the charting there. And I have about 60 to 70 charts up within Thinkorswim. So as something gets close, I can set my alerts in Thinkorswim and pull that actually over into my Thinkorswim platform and get it charted so that as it gets closer to being ready to move, I've got it up and front and center.
Okay, excellent. That's really good to get some insight into how you go through the whole process of finding, potential trading opportunities. So for whatever reason, let's say you do happen to miss a breakout or your ideal trade entry, how do you react to this? Do you let it go, or do you chase it, or perhaps you, I don't know, maybe continue to watch for a pullback of some sort? How do you react to this?
Sure. So it depends on how far I've missed the entry by. And again, it depends on what the setup is. Sometimes I might take, a small position ahead of the actual break and then buy it on the breakout of the pattern. But if I've, gone upstairs to make a sandwich and I come back down and it's moved 10 or 20 cents above where the entry was, oftentimes because I'm looking for larger gains, I'm not going to, for at least for myself, I don't worry about 10 or 20 cents because I'm not scalping. So a lot of times if it's a little bit over my entry and I really like the setup, I'll go ahead and buy. If it's moved significantly away from what the entry is, I will wait for some sort of either a retest or for another setup. And I see often, especially with new traders, they just want to chase or they'll just, forget about the setup. And the thing about good setups is they'll continue to offer entries, even if it's at a higher price. The stocks will continue to set up over and over and over again. So even if you've missed the initial entry, you may get a retest or you may get another setup at a little bit higher level that you can make sense out of. I think the key is just to be able to find an entry and a setup that makes sense for your trading plan so you can have confidence in understanding why you're taking the trade. Am I guilty of chasing occasionally? Absolutely. But I try to avoid that at all costs because chasing is never a good idea. And certainly when I do chase, often I'm sorry that I did.
Okay, so this is probably a good point to ask you about the meat of the move. This is something I actually picked up from watching your webinars the other day. So speak to us about your focus on just capturing the meat of the move and why you're not so concerned about being in for the entire range.
For myself, I think it's not realistic to think that I'm going to trade perfectly, meaning that I'm going to catch the exact bottom or get out at the exact top of any move. And I think as a new trader, I used to think that, like, if I didn't get the dead bottom, I wasn't going to take the trade. And when I would look back, a few weeks or a month later at the same setup, I would have been kicking myself because usually the stock had gone the direction that I thought it had and had made a much bigger move. And I was being so, I guess, kind of tripping over dollars trying to save dimes. And so I've tried to adjust my thinking in understanding that, I'm not going to get the exact bottom. I'm not going to get the exact top. But if I can remember to get the middle of the move, get the middle of most moves, that's going to be profitable and be very good for my profitability as a trader. And what I think that it also does is, takes off that pressure of finding that exact bottom or that exact top. I guess I can't speak for other traders, but I just don't think it's realistic to think that most traders are going to be able to hit that exactly. And I think that, understanding the time frame that you're trading in and what the setup is, and what the context of the move is, that understanding that if you can consistently get the middle part of most moves, that's certainly going to be very good for your trading account.
Absolutely, 100%. So I'd like to ask you a little bit about patience. This is something you've mentioned just before, and I've heard you speak about it in the past. It seems to be a very important trait to you. Could you perhaps talk about some of the reasons why you feel this is crucial to your trading success?
I think that patience is one of the hardest things, in trading, and it is even for myself. I still say that I don't have enough patience most of the time. And especially with the swing trades, obviously, but the intraday trades as well, I think that having some patience and having a plan and setting your risk and allowing your plan to work many times results in bigger gains. I think what happens, I know to myself, and I think for many of us, because we're sitting here staring at our computer screens and watching things tick by tick as they go by and watching, other things moving, it's easy to get distracted and sidetracked, out of what your current trade is, to chase something else or to go into something else. And that patience, I know for myself, almost always when I look back at charts, I say, gosh, I didn't have enough patience with that setup. I didn't have enough patience. And it's easy in hindsight to go back and look to know what you should have done. And it's much more difficult to be practicing, real time as the trade's developing. But good trades and good setups, they take time to play out. And whether that's a swing trade or an intraday trade, a lot of times those trades, given a certain amount of time within that set risk, will provide some, some really nice gains. And it just takes patience. It takes not staring at it. And it also takes, understanding what the price action is doing, because unfortunately, most times things don't go up in a straight line. And when you see your stock move up and then maybe it needs to reset and work off some overbought conditions and you see it pulling back some, you start second guessing yourself and you start seeing other things that are moving that you think, might be a better setup or you want to be in. And so it's easy to not have patience and get distracted by other trades or second guess yourself because you're staring at it. So, more patience, less staring.
I like that. That's really good. So, seeing as you're involved with many up-and-coming traders, what are the type of things that you find most beginning traders struggle with? What are some of the questions you're often asked by those still trying to find their feet, essentially?
Sure. I think that some of the biggest struggles that I see with new traders is, the first thing is that they think that trading is easy, and I don't know if that comes through a lot of the social media today or I think from the outside looking in, I guess I know I've had that comment to myself personally from, friends and family. Oh, must be nice. It must be so easy to be a trader. And I'm like, well, if it's so easy, why doesn't everybody do it? And the reality of it is it's not easy. You're going to get out of it what you put into it. And I think a lot of new traders come to the table. They just want to start pushing buttons. They don't want to take time to educate themselves. They come in with absolutely no plan or strategy or understanding of their personality style, of what trade style they may want to be pursuing. Do you want to swing trade? Do you want to day trade? How are you going to make your decisions to enter a position, and how are you going to manage that position, and what's your risk tolerance going to be? What are your options for exiting a trade? They just want to sit down and they want to start pushing buttons and they want alerts. And I think to have longevity, trading is not easy, and most traders, may or may not make it. And to have longevity in trading, I think that it's very important for you to have a plan and to make sure that any setups you're taking, whether it's ones you found yourself or other ideas you find out, through a service or on social media, that you take that idea and you make sure that you make it your own setup, and that you understand what your plan would be for that. I think that, and oftentimes people will say, is it still a good buy here? Well, to me, if somebody's saying, in a chat room or wherever it is it a good buy here? That's telling me you have no plan. You just want to chase because you see something moving. So if you're having to ask someone else, is it still a good buy here? You have a big problem, in my opinion. And the problem is you have no plan and you need to spend time. The market is going to extract a cost of education for everybody who comes into this trading. And what that cost is going to be is going to depend a lot on how quickly you are able to, come to terms with a number of different things, what your plan is, can you stay disciplined? Can you follow your rules? Can you manage your emotions? And are you going to be able to think for yourself as a trader? Because I know when I started trading, it never occurred to me to care about whether somebody else was in or out of a trade. And I see today so many people wanting to be in or out of a trade because I'm in it or somebody else is in it. And that's not a reason to be in a trade. You need to be in a trade because it makes sense for your style of trading and your time frame and what your plan is. Because relying on somebody else telling you it's a good idea or, yeah, it's still a good buy here, you don't know what that person's position is, what their time frame is, what their plan is, and how quickly that plan may be may change at a moment's notice that they're not going to convey that to you. So you need to have ownership and take responsibility for your trading, in order to have longevity as a trader. One other thing that I also see that is, I think, a struggle for new traders is mixing styles. So they come in and they want to swing trade and they want to day trade. And I think that that's difficult to do. I think people are often wired for one direction or the other. And I think that with time, you can certainly do both. But I think as a new trader, it's important to decide what style of trading you're going to do. Are you going to use fundamentals? Are you going to use technical analysis? What tools are going to make sense for your trading, and become consistent at that before you move on to trying something else. A lot of them want to jump from one strategy to another. Everybody gets a hot hand now and then. Every site, every trader, everybody will get a hot hand from time to time. And it seems like new traders are very willing to jump ship and try something new very quickly, just because something else is hot coming down the road, before they're able to develop consistency within themselves. And I also have seen a lot of traders who, want to trade stocks and options and futures all at once as new traders. And again, I think it goes back to picking your battles and making sure you become consistent with one thing before you decide to move on to other things. And that takes time.
That's such a brilliant answer. I'm so pleased you shared all those really great points there. That was awesome. If you could, give us a little insight to your life away from the markets. How do you like to unwind and get some downtime when needed?
I think that downtime is really important. And before I say what I enjoy, I will say that when I was a new trader, I remember spending an inordinate amount of time in front of the screen. I mean, from 6 or 6:30 in the morning my time until well into the evening, just being glued to the screen. And I think that was definitely not healthy for my trading and my emotional well-being. And so today, in my trading, as soon as the market closes or very soon after, I'm out of here, and I can come back in the evening and do some scans, and get prepared for the next day. But, we live in Montana. We both grew up fishing and hunting and riding horses. So we love all of the outdoor things that Montana brings with us. So, usually in the afternoons, we're riding the horses. We might go for a hike. Sometimes we're fishing, doing chores, turning the ponies in and out, cleaning pens, playing with the dogs, in the wintertime, maybe doing some skiing. So we lead, a very active lifestyle, and we're very lucky to live where we do and be in this beautiful place. So we definitely take a lot of time to enjoy that. And I think as a trader, it's really important to have that balance. It's very easy to get sucked into being tied to that screen for 12 hours a day, 7 days a week. And I think that, at least for myself, I know that having those breaks, and even during the day, I will take breaks and go out, to throw the ball for the dogs, or maybe go out, and do some chores for, 30 or 40 minutes over the lunchtime. I think taking those breaks even during the day is a very good, mental break for you, and helps keep some balance in your life, because it's just very easy to get sucked into, this trading thing that we do on, way too many hours a day spending in front of the screen.
That's excellent. Yeah, that's a really great point. So let's start to wind the interview down. I've just got a few more questions which I'm keen to ask you, and that should take us out. But what's one area of your trading that you'd like to work on more and improve going forward from here?
I think definitely my patience. Even though I feel like I do have good patience, I still feel like I never have enough patience. So working on, just continuing to be more patient with the setups that I trade personally. And I enjoy working, with the new traders. So, continuing to help traders, who are coming into the business, help them try and find their way, and hopefully maybe give them a few tools that can help them on their journey.
Cool. Okay. And speaking of helping people, you're also very involved with Traders for a Cause. So would you like to just tell us a little bit about this? I mean, it's a great cause, and I'd like to, give it a little bit of attention. So yeah, tell us a little bit about what the charity's all about.
Sure. So Traders for a Cause, it was founded 2 years ago by Nate Michaud, and I'm on the board of directors there. So I just have a kind of a helper role. Nate and, some of the other folks on there have really headed this up. But Nate had asked me if I wanted to be involved, with the goal of, being an organization to help promote, giving back, in the trading community. I think that, as traders, we have a very fortunate lifestyle with a lot of opportunities to make, a really nice living. And it's easy to get caught up in, the money and the cars and the, whatever your material things are. And we forget how fortunate we are to be able to do what we do. So, Nate founded this with the idea of, working towards traders, being able to give back. And so the first year we have our event every year in September in Vegas, and they bring in 5 or 6 or 7 different speakers every year. So going to the event, not only is it supporting different charitable organizations, but it's a great opportunity to learn from other traders, to meet other traders, people maybe that online, but you haven't had a chance to meet with in person. And I know for myself personally, that interaction, every year I've come away from the event feeling, happy to be able to give back, but also very inspired as a trader, from getting to hear other people's stories and learning from other traders who are out there. This can be a very lonely endeavor that we're in, often in an office in our house, not interacting with any other people. I sometimes, I always joke that I'm, kind of a hobbit in my little cave down here. And so getting out and getting to meet with other traders is great. The first year, Traders for a Cause raised over $100,000. And we had 2 organizations we gave to care.org and then to the Bachmann-Strauss Dystonia and Parkinson's Foundation. And this year we raised $175,000. We gave to the Breast Cancer Research Foundation, GiveWell, and the Honor Flight. So, I think that, we want to continue to grow this. Nate's done a great job with his vision with this, and it's received a great response in the community. And I think it will just continue to grow.
Yeah, that's very cool. Nice work. So, you just had an event recently, didn't you? Who were some of the speakers there?
So our event just got over this year in Vegas. We had it late September, and we had Peter Brandt was there, Kunal was there, and did a presentation. Jack Schwager was there. Had a great lineup. We had a roundtable discussion Sunday morning where we had everybody, several of the people that were up there and some of the traders that we know up there answering questions. So, great event. They do golf on Friday. They have speakers all day Saturday and then Sunday morning. And then, everybody can take off Sunday afternoon. So just a super great event.
Yeah, it sure sounds like it. I hope to make it over that way sometime. I was actually in Vegas December last year, but awesome place and very keen to go back sometime. So might have to try and line it up. Now, there's a number of ways that listeners can find out more about you. So let's just run through those real quick. So you were recently featured in the new book titled Momo Traders. What's this about, and where can listeners go to find out more on this?
So listeners can go to momotraders.com to find out more about the book or to purchase the book. And it is a book that has basically the stories of 10 different traders who were all regular people who got into trading and kind of their journey and their story and the different styles of trading, the different setups that everybody likes, and just a great inspirational book for new traders and experienced traders to learn from, people who were just regular people in life who went down the trading path in their journey. And also the majority of the proceeds from that book, all of the traders that were interviewed in the book, didn't get paid for being in it. We are donating our portion of the book again towards the Traders for a Cause charities. So super great book and a lot of really interesting stories in there.
That's very cool. That's one I'm certainly keen to read. And tell us a little bit about Trading on the Fly. Give us just the rundown on what subscribers can expect.
So Trade on the Fly is the site that I run. It's a swing trade service. It's a great community of like-minded traders We do trader education through, I have a DVD that I have completed this last year that's the basics of swing trading using technical analysis. We have an archive library of all of the past webinars, which are driven primarily by member questions, and then I pick a different topic occasionally to discuss in the webinars. I do scans 3 times a week that members can look through and find ideas there for trading if they don't have time to do their own scanning. And then I also have a private Twitter feed where I will put out setups and ideas that I see ahead of time. And the idea with these, and I will offer to the members, my suggested entries there. But as always, and I tell everybody, you need to take the setups and make them your own. This is what I see, and this is how I would trade it. But you need to make sure that you make that setup your own. And then we also have a chat room that we put swing trade setups in, and then we day trade in the chat room as well. And I have moderators in there, and the other moderators that are in there, between myself and the other moderators, we have over 40 years of trading experience between us and different styles of trading in there and different thoughts on the market. So it's a really nice environment, not only for setups and ideas, but we also, give advice as far as, how the market's acting, or give our thoughts on it, and, just kind of help new traders along the way find their path and to understand and work through, different areas of the market. If things are, getting scary and the market's falling, we can help people understand, what's happening so that they're not on their own trying to figure out what's happening out there. So just a great community of traders, and very supportive of new people wanting to learn.
Yeah, nice. That's really good. So if listeners want to find out more about Michelle's Trade on the Fly service, you can just go to chatwithtraders.com/offshore. And for full transparency, guys, that is an affiliate link. So if you do decide to sign up, I will receive a small kickback, but the price is not inflated whatsoever in order for me to be compensated. So if you'd like to find out more, just go to chatwithtraders.com/offshore. That's OFFSHORE. And last of all, if listeners would like to connect with you on Twitter, what's your handle, Michelle?
My public Twitter handle is Offshore Hunters with an S on the end.
Okay, excellent. So I highly suggest you guys go follow Michelle on Twitter, and if you're interested in finding out more about her service, chatwithtraders.com/offshore. All right, Michelle, well, thank you very much for doing this. This has been a lot of fun and very insightful. Enjoy your evening, and let's speak again soon.
Sounds great, Aaron. Thank you very much for having me on. I appreciate your time.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Okay, what's going on, guys? Welcome to another episode of the Chat with Traders podcast, and I'm thrilled to have you with me. Now, before I even introduce my guest for this week's interview, I just want to say I've been receiving a bunch of great feedback on the show lately, which is really cool. So I'd like to give a big thanks and a shout out to anyone who has either emailed me, commented on the site, hit me up on Twitter, or even left a review on iTunes. I really appreciate it. The support is incredible, so thank you very much. All right, so my guest on the podcast this week is Jack Little of mercenarytrader.com. Jack is a global macro trader who originally started out as an international commodity broker. Today, he now has more than 17 years of skin in the game and is a very competitive trader. He's also a keen poker player and believes there are many crossovers between poker and trading, which of course makes for some interesting conversation during this episode. Also during this episode, we speak about how Jack thinks of trading in terms of probabilistic outcomes instead of attempting to quote-unquote predict the future. We spent quite some time on the subject, and I myself found his views on this particularly interesting. Another highlight would be mastering the art of the big bet, where Jack shares insight to the times when you should press harder on a trade to make profits that have a real impact. Now guys, just a final reminder for the mentoring giveaway. Entries close this Friday, 6th of November at midnight Eastern Standard Time. So just in case you haven't already heard, this is your chance to win a free 90-minute one-on-one mentoring session with a seasoned pro trader. Who are these traders? Well, they are Chris Sace, Zach Hurwitz, and Brad Jelinek. Each have plenty of real market experience, very genuine, and most importantly, active traders who've previously featured on this podcast. Now, seeing as there are 3 mentors, there will be 3 winners also. So to enter, just go to chatwithtraders.com/win, that's WIN, and enter your email address. That's it. It's very simple. And I'd just like to add in here, this level of access is generally very difficult to come by. We have an experienced trader who is willing to block out their time to sit down with you and do what they can to help you see better results. So please make the most of this opportunity and go to chatwithtraders.com/win to enter now. All right, now time for this week's interview. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and please welcome my guest for episode 45, Jack Little of Mercenary Trader. Hey, Jack, welcome to the podcast, man. How's it going?
Good. Thanks for having me. Going really well.
Awesome. Good to hear, and no trouble whatsoever. It's awesome to be speaking with you, and thanks so much for taking the time to do this. I've been keen to speak with you for quite a while now, and I think this will be quite an interesting discussion because you've got some strong opinions and a slightly unique way of looking at things, which of course we're going to really dive into. Plus, I'm hoping there will be plenty of poker analogies thrown in the mix too, so I'm looking forward to it.
I'll work on that, yeah.
Awesome. So first things first, take us back in time to when you first got involved with trading. How were you introduced to markets, and also share with us what were you doing before this time also?
Okay, so I was introduced to markets in college, and basically, so I majored in English and philosophy. I was very much a left-handed, right-brained creative arts guy. And I originally thought that I was going to wind up as a professor. And I had this vision of being an academic. One of those cool professors, kind of like Robin Williams in Dead Poets Society, you know, wearing the tweed jacket and writing books in summers and all this. And I just thought I would be this cool English professor who wrote books. But then I had my dream completely shattered by one of my philosophy professors who basically said, look, going into academia is terrible. Your life's going to be terrible for like the first 5 years. It's awful. There's all these petty fights. And he just convinced me that academia would be a terrible idea. So I was completely set adrift, and I had no idea what I was going to do with my life because my cushy dream of being an English PhD was shattered because I thought it would be awful. And I didn't know what I was going to do, and then I came across this book on my buddy's dorm room floor, this guy who lived on my hall, and that book was The Investment Biker by Jim Rogers, and this was around 1995 or 1996. And so I picked up this book, Investment Biker, which was all about this guy, you know, this ex-hedge fund manager who takes a motorcycle trip around the world with his girlfriend and decides whether or not to invest in the countries that he passes through. And I had never really been exposed to markets, but I immediately thought, okay, making money by traveling around and thinking is the coolest job on the planet. So I decided immediately from there I have to get into markets, and I pretty immediately fell in love with macro because of the whole top-down sweeping perspective of looking at countries and currencies and things like that. And so I stayed an English and philosophy major because I was already halfway through college, but then I just started interning at stock brokerages and read a couple hundred books and just jumped in with both feet. And then when I got out of school, I decided that I wanted to go into commodities. I thought that was the best route in. I didn't really want to do stocks. I was already bitten by the macro bug and had read Market Wizards and stuff. And everybody was in Chicago for commodities, except there was this one little boutique firm that had clients all over the country and the world that was run out of Lake Tahoe. And the boss had moved it to Lake Tahoe just because he liked to ski. So I wound up, my first job out of school was becoming an institutional commodity broker. And I had a whole bunch of hedge clients and worked with farmers and cattle ranchers and currency hedgers and scrap metal dealers and things like that. And I also worked with a bunch of speculators, and my largest client was a Russian hedge fund. And a bunch of these guys would put in orders over ICQ, this old instant message system. And that's sort of how I got started. This Jim Rogers book led me to commodities, and I did commodities for a couple of years, and then I switched over to equity trading partnership, and just sort of expanded from there. But that was the beginning. I was an English and philosophy guy, and found a book on a dorm room floor, and became fascinated by markets, and came in through commodities and then got into stocks, and now we pretty much do everything.
And here we are now. So
yeah,
what a great story. Okay, so let's take it back to the beginning there. You said when you jumped in with both feet. So I take it that you had a little bit of experience trading independently before you went to work with the firm. Is that correct?
Well, a little bit, but not a whole lot. I jumped in just in terms of reading everything I could get my hands on, and then I had this friend of mine who had introduced me to markets, introduced me to his broker, and he got us into some penny stocks that wound up doing terribly. And so I learned pretty early on, don't invest in penny stocks. And I did some dumb things early on, but mainly I had a mental education of just reading a whole lot of stuff and then watching a lot of people before I went into the commodity brokerage business. I spent a couple of years, 2 or 3 summers as an intern at Raymond James Financial, which was really interesting. I was working for a really successful stockbroker who sold, his big thing was biotech stocks, and he loved these crazy stories about, this drug that's going to do X or this technology that's going to do Y. And I just saw a lot of interesting different sides of the business. Traded a little bit, soaked up a lot of information. My first couple of years as a commodity broker is when I learned, learned some good lessons and some hard lessons about trading.
Okay, so your role as a commodity broker, what exactly did that involve?
Well, we were a boutique firm that had both institutional clients and retail clients. So I worked with, I played support to my boss, who had a bunch of clients, and he's been in markets for a couple decades. And so he had a lot of hedging clients. So for example, farmers would call in and need to hedge their wheat or soybean crop, or scrap metal dealers would want to hedge their copper futures positions. And so I would get on the phone and take orders from people and give reports to people and things like that. And then I started, I'm sorry about that, there's a little construction going on in the building here. And then I started helping clients construct hedge positions. So I started working with people saying, I want to hedge this risk. And I said, okay, let's figure out a plan. You can do X and Y and Z. And then we put the positions on. And then we also had a bunch of people who were just straight up speculators and just trading futures, because they wanted to trade aggressively, and everything from some really smart traders to just flat out gamblers. So I took a whole bunch of orders back in the days when you still had to write orders on paper tickets and use a timestamp, and then call into the trading floor and yell at brokers for bad fills, and also constructed hedges for people, and just ran the gamut of different types of clients in futures markets.
Okay, excellent. So how long were you with this firm before you decided to move on, and walk us through your next step from there?
Sure, I was with the commodity firm for about 3 years, and it was a great education because I started in the fall of 1998, and I proceeded to observe the worst secular commodity bear market in history up to that point. In 1999, commodities were basically going straight down while stocks were going straight up, and the dollar was very strong because all this capital was flowing into U.S. markets. And so I got to experience this horrifying commodity bear market, which was very interesting. And I was at that, like I say, I was at that firm about 3 years. There was this giant clearing firm, Refco, which has since blown up, and they were sort of dominating the commodity business at the time. And commodities were just looking very ugly and bearish. And right about the time of 2001 or 2002, I decided that I had sort of gotten my education in the commodity space and wanted to make a change. So I was there roughly until early 2002. And then I decided to pack up and leave. And I did some freelance writing. I had some relationships there where I was writing about trading and writing about markets, and actually got involved in making contributions to Michael Covell's book, The Trend Following Guy. I had done a big study on trend following while I was at the brokerage. And from there, I went into an equity trading partnership with a friend who would come into a large amount of capital through an inheritance. And we set up a partnership where I traded a big chunk of it for him and learned to trade stocks through the market meltdown in 2002 when Enron and WorldCom and all those guys were blowing up. So that was another really interesting experience.
Okay, so tell us a little bit about that experience. I mean, were you affected by those names you mentioned blowing up, or how did you go through that period?
We wound up making a little bit of money, but basically breaking even. And I was still learning a lot of things about trading at that point. We did okay though, because I had risk management already tattooed into my brain, because now my path is a little bit unique in that I learned to trade basically with futures and then went to stocks second. And so when you learn to trade with futures first, it's like you learn to work with dynamite, and then you understand how risk works. And I was naturally, had a bearish bent from all these macro guys that I had been absorbing. So being in a crash, it was kind of fun. It was mostly getting used to, though, these huge wide swings, and I still had not really figured out my methodology or my market style yet. So we were probably more active than we should have. I traded in and out too much relative to what I would do now. But we did okay basically for the time, for how violent and crazy it was. So it was a great education basically, in living through that kind of market.
Sure. Okay. So would you be able to share with us some of the obstacles you had to overcome, during your earlier years, kind of up to the point where we're at right now? And what areas of trading were particularly difficult for you when starting out?
Sure, I would say obstacles and areas of discipline. I think one of the biggest things that I had to do was learn to develop a total picture of market awareness. In the beginning, it was funny because I had learned so much I had read Market Wizards and read all these books, but I didn't really understand the impact of macro. And the guy I was working for didn't either. And so a funny story in retrospect was in 99, all these commodities were going straight down, and my boss, the boss of the commodity brokerage, was a longtime bull on commodities, and he kept trying to buy things, thinking, well, this is the bottom. And meanwhile, the US dollar was just going straight up. I mean, the US dollar was just being powered by all this capital flowing into US equity markets, and it was just going vertical. And now my attitude would have obviously been, duh, of course commodities are going to do terrible because the dollar is so strong. but he wasn't aware of that relationship. He didn't even pay any attention to it. And so I didn't think to pay attention to it because I was looking at so many other things. And so I guess you could say in the beginning, I had so many things I was trying to pay attention to that I missed some really important things just because there's so much stuff. So if somebody says to you, listen, there are 15 things about trading that you really need to understand, and you're trying to absorb them all at once, you'll be lucky if you get 10 of them, and then you'll forget about 5, and those 5 that you forget about will come around and kick your butt. And then you cycle around and you remember those and you forget about some different ones. And there's this gradual iterative process where eventually you absorb everything, but you sort of have to run around and put out fires until you have this total picture of knowledge. And I never really had any direct mentors except the guys in the books. I never worked for another trader who was just a great trader, so I had to learn everything through sort of trial and error and reading from afar and things like that. And that was challenging. And then I guess just really putting a sort of worldview and style together and figuring out who I was in markets and how I wanted to approach them and what the important things were.
Yeah, that's great. I really like how you summarized that. So let's change gears now and focus in more on your style of trading that you've adapted and you're trading, in current times. So Jack, speak to us about how you would define your methodology for trading.
Okay, how would we define our methodology? Well, let's see. We're top-down, we're global macro in terms of we pay attention to the whole world and capital flows and the big things that are going on, but we're also bottom-up in that we're willing to trade anything. So we will trade commodities and currencies from the top-level view, but we will also drill all the way down and invest in individual stocks and hold individual companies for long-term positions if they look good. We have what we call sort of a combination of a systematic discretionary hybrid. And by that I mean, traditionally when you think of systematic traders versus discretionary, on the systematic side, mechanical traders hand all their rules over to a computer, whereas discretionary traders make all the decisions themselves. But we are a hybrid in the sense of we have a lot of things that we do systematically, like, for example, our position management will follow a lot of systematic rules, but we're discretionary in our decision making. So we're sort of like a cyborg in that we're like a human who puts on a mech suit. We're enabled with a computer jetpack, where we use computers, but we also use human decisions. And as I say, we're able to trade anything, commodities, currencies, stocks, anything liquid. And we're typically looking for swing trades or longer term trades where our favorite holding period is weeks to months. A really great trade, we'll hold a really great trade for many months, 10 months, a year, longer. And we're also looking for very big bets. We're strong believers in the philosophy that most of the time you trade small, and every once in a while things really come together and you see an excellent opportunity, and that's when you really scale up. And that's how real profits are made, because of the way the market distributes profits in a very fat tail kind of process.
Now, I think it was Peter Brandt, who just on a side note is a legendary trader, and also believe he's a good friend of yours. And he was featured on this podcast for episode 36, if anyone wants to check that out. He described you as having an unconventional macroeconomic perspective. And you've kind of just spoke about it there. But could you speak a little bit more on this subject, especially if someone is maybe completely unfamiliar with the whole idea of macroeconomic perspective? Like, what are some of the things you take into consideration when analyzing the market from a 10,000-foot view?
Sure. So the metaphor I like best, I forget where it came from, but there's a great metaphor, is if you think of the markets like a mountain, like a giant mountain, like Mount Everest or something, and bottom-up investors And people who only look at individual companies are sort of like they're walking around at the base of the mountain. And they're not looking up, they're not paying attention to weather, they're just seeing what's happening right there in the valley. And meanwhile, macro is up higher, the higher elevation levels of the mountain where storms can form and big weather systems. And so macro comes into play where if you're hanging out around the mountain and you're not paying attention to the weather and it turns really nasty, then you can wind up having thunder and lightning and boulders coming down on your head and so on. And so macro is paying attention to the total picture of the weather system and everything from what's happening down in the valley all the way up to the higher levels, including when there's big storms and thunder and lightning. And because of that, macro traders traditionally do well when there's more volatility. They do well and make more money when things are frightening. Whereas when the skies are blue and the sun is shining, that's when bottom-up investors tend to do better, and value investors and things like that will make more money. And so to analyze the macro picture, you look at things like interest rates and levels of inflation and risk appetite in markets, basic valuation levels. Are stocks overvalued or undervalued? Are we in a period of building risk appetite in a boom? Are we in a bust, and dealing with the aftermath of a crisis? You're looking at big long-term cycles. There are economic cycles of booms and busts. You're looking at capital flows all over the world. Money's like this big wave that's sloshing out of one market and into another market. You're looking at things that governments do. Governments will sometimes take really big drastic measures that have powerful effects on a market. Like, for example, China decided to prop up its stock market, and so they created this crazy bull market in Chinese equities, and then it crashed because it was unsustainable. And China created a housing bubble in Australia because Australia was selling all these base metals to China, and that in turn pumped up the Australian housing market with all this profit that was flowing in. So you're looking at these really big relationships, and then you're sort of playing a chess game to figure out what's going to happen next. And then you make bets based on that, which is very different than the traditional investor is only going to look at a single company and figure out what are the fundamentals for this stock. Or a trader might only look at a chart, whereas a macro trader says, well, we're going to look at everything.
Okay, so in that case, could you perhaps give us an example of either a recent scenario or just some of the things you like to see lining up before you actually commit to taking a trade or taking a position? Like, what gives you final conviction on a trade?
Sure. So at any given time, we have what we call themes about the market, where we're developing ideas and opinions on what's happening, and we're developing scenarios, sort of like movie plots, and we're saying, okay, X could happen or Y could happen based on following what's happening in markets. And then we pay attention to price to get a sense of which of these, what thesis is confirming. So if we're very bearish on crude oil, for example, then we want to see follow through on crude oil charts in a bearish direction to confirm that the thesis that we believe is playing out. So, for example, one of our large trades in 2014 was right around Thanksgiving. The news came out that Saudi Arabia was not going to cut production, and it became clear that they were going to try and punish U.S. shale producers. And so Saudi Arabia basically started an oil war. And energy stocks had begun to break down, and you could see this breakdown on the charts. And we realized, wow, the Saudis are serious. They're gonna try and drive the price of oil down to put shale producers out of business. This is going to be really bad for energy stocks. And so we shorted energy stocks, and it was a great trade. So you're looking for a theory about what's going to happen relating to supply and demand, or something strategic. And then you use price to confirm that your idea is correct and to enter the position when price is telling you, yes, it's happening, or price is giving you a green light.
Ever watch a stock rip and think, I could have nailed that if I had real capital. The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So I'd like to dig into a topic and spend some time on this. So I'd like to speak about certainty and probability. I know you have plenty to say on this subject, so help us to understand how you think about trading as a game of expectation and how you think about probabilities.
Okay. Well, one of the unique things about us is that we don't believe in prediction. We think prediction is kind of silly. And the purpose of being in markets is not to predict anything. It is simply to assess odds and probabilities. So we will spend a lot of time developing scenarios like here's what we think could happen, or here's what we think is likely to happen. But this is not at all the same as a prediction. This is more like saying here are the odds and probabilities of the situation, and so here is what makes a good bet. So when somebody goes on Bloomberg television and says, I think X in the markets is going to happen in 6 months, we generally think that person is stupid because nobody knows what's going to happen in the market in 6 months. And making money in markets is not about making successful predictions. It's about making positive expectation wagers. So an analogy for this, at the poker table, you never have perfect information and you never actually know what's going to happen next unless you're cheating. So in poker, you'll have a certain situation where you can use the information from how your opponent has acted and what the cards say to say, okay, I'm going to do X because there's a very high probability this is the right move. And then you have a positive expectation. If you ran that scenario 1,000 times, you would make money on it. And so the way we view all of trading is that you're not trying to predict the future, you're just trying to make positive expectation bets where you're in line with the odds and probabilities. And if you do that enough times, then you'll make a lot of money. There will be certain times where you have very strong certainty, you feel very strongly something's going to happen, or you have high conviction on a trade. But once again, you're not guaranteed it's going to happen, you just have strong conviction, and so you make a larger bet. But this attitude of gearing everything to odds and probabilities while not actually predicting anything is very different than what most people are used to. Most people crave some kind of false certainty without recognizing that the type of certainty people typically crave or want is impossible to have. Nobody can have it. And so we don't think trading is about certainty at all. It's just about odds, basically.
Okay, so for someone who does think in terms of predicting and feels the need to want to predict the market, how can they shift their mindset to think more in terms of probabilistic outcomes?
Well, I would say how to shift their mindset. Well, first of all, I would say just think philosophically about the challenge of prediction and think about how hard, if not impossible it is, just because there are so many variables, there are so many things that none of us know, or things that could go wrong that we had no idea about. If you just take a small number of variables in any situation and then you magnify those towards all the variables happening in the market, we basically, something could come out of left field at any time, anywhere, and render any prediction useless. So first I would say recognize sort of the folly of it, and then recognize all of the success that traders and value investors and trend followers and business people and others have had simply aligning themselves with probabilities. So a really successful value investor will look at a company and he'll say, I don't know what's going to happen in the future, but I know that this company is really undervalued relative to its assets and the stock is really cheap. So if I buy it, good things will probably happen. Or an entrepreneur will say, this is a great market to expand into. I don't know what's going to happen, but I know it's probably good to make a bet here. You know, a venture capitalist will say, I don't know if this startup is going to succeed or not, but it looks like it could be a 10x or 100x, so I'll make a bet on it, and I can be wrong 9 times out of 10, and I'll still make a lot of money. So if you look around, there's a lot of models that work well from just taking a pure probability expectation. And also another group that's made hundreds, or made tens to hundreds of billions over decades is the trend followers, particularly in futures in the CTA space. And these guys don't predict anything at all. They just run algorithms where they expect trends to persist. So I would say the first thing is sort of do a study of markets and see what works for people, and then just shift this mindset where you don't care about predicting the future. You just want to focus on odds, and because this is what so many winners do. Whereas typically the people who are trying to predict are the guys who show up on CNBC or something, and they're trying to build a track record of saying, oh, I said X and then it happened, but that's not actually related to making money.
Yeah, okay, so where would someone even begin to start trying to figure out their odds or the probabilities that, they would make money if they were to do this? Like, where would someone even start trying to discover those numbers?
Where would, I guess that's a really good question. I haven't really thought about an optimal introductory book to probability and statistics. I guess if somebody wanted to start philosophically, they might, Taleb's books might be good. Nassim Taleb in terms of The Black Swan, I believe, and his other one, I forget the name of his first book, just talking about, the philosophy of uncertainty. And then I would say just getting into a basic understanding of probability and statistics. Poker could be a great training ground for learning to think probabilistically, because almost every decision in poker is just simply a pure probability decision, where you say, if I repeated the situation 1,000 times, would my action make money? And you look at, there's a potential wager, and there's the size of the pot, and you multiply the potential amount of money you could win towards times the percentage probability of your action, and if it comes out to a certain formula, then you take it, because it's a positive expectation over the long run. So I would say philosophically, Taleb's books are probably a good place to start, like The Black Swan, and I'm blanking on the first one that he wrote now. Anti-Fragile is another good one. And for actually just learning the math, I would say check out poker and read some good poker books and figure out how professional poker players make money, and that'll give you a sense of that world of moving towards probability.
Okay, cool. Well, I'll try and link to a few of those resources you just mentioned there in the show notes. So anyone listening, they'll be at chatwithtraders.com/45, and there'll be links there. So, Jack, when did you actually begin to think in this type of way? Like, what put you onto this way of thinking, or is it something that you've had throughout your entire trading career?
My way of thinking has evolved from trying to reverse engineer the styles of the traders that I decided to be like from the very beginning. So, in my first year or two of being interested in markets, I read all the Market Wizards books, the original Market Wizards and New Market Wizards and Stock Market Wizards and so on. And my attitude was kind of, I want to be like those guys. Jerry Seinfeld talks about when he was starting out and thinking about being a comedian, his attitude was just, I want to be one of those guys, like one of those guys who gets up on stage. He wanted to be a comedian. My attitude was, I want to be like one of those guys, meaning Market Wizards. And I particularly picked out Stanley Druckenmiller and Paul Tudor Jones and Victor Sperandio as three names that come to mind of guys that really influenced me. And I just sort of read everything about what they thought and tried to reverse engineer it and say, okay, why does this make sense? Why does this worldview make sense? And then I took that input and I built my own understanding around it. So, and then another big influence on me from the beginning was the Soros idea of fallibilism, where he would go around saying, hey, I might be wrong. I could be wrong about everything and I could change my mind at any time. But at the same time, when I really feel like I'm right, I'll make a huge bet. That just made a lot of sense to me from the beginning. So I had the seed of trying to emulate and reverse engineer these sort of mentors from afar. And I just sort of built my own knowledge around those seeds as the years went by.
Okay, so just while we're still on the topic of probabilities and expectancy and that type of thing, I mean, there might be some traders who are listening to this and they think, okay, this sounds good in theory, but how well does this translate into real trading outcomes? Like, once you actually try to put this into practice, how difficult is it to not skew your odds?
I would say I think about it a little bit differently. I think understanding probability and expectation is more about understanding how markets work and how trading systems work. It's more information that you get from the situation. That may sound weird, so let me try and explain. So let's say, for example, a long-time swing trader analyzes thousands of trades, and they recognize that their average hit rate is 45%. Then they'll know, okay, the odds of me being successful on this next trade are 45%. And so then they can build a probability sense around that. Or you look at a situation and you say, based on my past analysis, the odds here are X. So it's more like how accurate your assessments are going to be are dependent on the information you get from the market. Like the better your analysis is, the better your understanding of actual probability is. So it's not that you start out and say, I assume X probability and this is how it's going to be. It's more like you pull that information from the market and it helps you. Another factor here is that when you understand the nature of probability and what I'm talking about, it actually changes the way you trade and the way you think about trades. So for example, one thing that a lot of traders don't realize is the incredible prevalence of the 90-10 ratio in terms of profit distribution. One thing I like to mention is there's this great book called Trading Risk by a guy named Ken Grant. And this guy, Ken Grant, was a risk manager for a bunch of the top hedge funds in the world. He worked for SAC, he worked for Tudor, he worked for More Capital, a bunch of others. And this guy has seen literally hundreds and hundreds of track records from the best traders in the world, all the managers at these funds. And in his book, he said that one of the things that blew him away is looking at all these hundreds of track records over and over again. He saw this 90-10 pattern where 90% of profits came from 10% of trades. And it was persistent, or even 95-5. And it was persistent across all kinds of styles and markets and long and short and blah, blah, blah. It was just everywhere. So when you understand something like that, a light bulb goes on and you say, there's something probability driven here about how the market distributes profits. And then that influences your expectation and your psychology and a whole bunch of other things. So I think it's more about developing a philosophy and an information flow of understanding the mechanics of how markets work than it is setting something up and expecting it to be right or wrong. Our message is not here's a tool you can use. It's more like, hey, this is how markets actually work, and the better you understand how markets actually work, the better you will function. If that makes sense.
Yeah, no, that's really interesting. I like the way you explain that. So yeah, thank you very much, Jack. Let's keep this moving along, and I'd like to get into your thoughts on some more general pointers for developing traders to take into consideration. So can you talk about the subject of pressing harder when the opportunity arises and betting bigger when the time is right? Has this been an important factor to your success, and what are your views on fixed position sizing also?
Sure. I think I think position sizing is one of the biggest factors, if not the most dominant factor, in trading success if you are a discretionary trader. And it's also, this replicates all across what you see in investing and markets and business and in life. I think that being able to make the very large bet at the right time is absolutely, if you don't have this, the odds are much lower that you will succeed. When you look at how the market distributes profits are distributed on a fat tail basis, meaning profits are not just distributed regularly every day. They're very lumpy. They come in individual, they come along sort of semi-rarely. And this is why I think what I was saying about Ken Grant, he observed all these P&Ls that were 90-10 or 95-5, and Peter Brandt has said the same thing. His P&L was 90-10. You see this pattern over and over again, and what that implies is when a position is really, really attractive, you want to be able to take a very large position. And if you don't do that, then you're at risk of simply getting chopped up or ground to death because the light is not worth the candle. There's a popular trading phrase out there that says, if you worry about the losses, the profits will take care of themselves. And I think that viewpoint is actually very, very wrong. I think it's totally wrong. I think you absolutely want to worry about the losses in terms of having risk management, but also if you don't bet really big when the time is right, then there's not even a reason to be there. And the extra profits from betting very big when the time is right are what makes the whole thing worth it. The other interesting thing about this is that value investors and poker players, those disciplines, and even entrepreneurship all show the exact same pattern of when it's a really great opportunity, you want to make a really big bet. Warren Buffett in the beginning wrote in his 1965 letter, he said, listen, we're willing to put 40% of our whole partnership funds into one stock if it's the right stock. And he made some huge bets. Really successful entrepreneurs have made really huge bets, and poker players in high stakes cash game poker, once again, your profit ratio is going to be like 95-5. Maybe 5% of the hands you play, if not 2%, are going to produce the vast majority of your profits. So you see this happening over and over again where the big bet is really important. I think that this is actually one of the things that happens to quote-unquote experienced traders. New traders tend to trade too big and blow up and then, lose their capital. And then they become experienced and they become super conservative, and they always want to take small positions and always want to be careful with their risk. And then their accounts stay small and dinky forever, and they never really make any money, and they wound up, it's like they're eating stale bread and drinking watery soup. And they never actually make the profits to justify trading. And that's because they haven't mastered the art of making the big bet, which is so, so important. It's the reason why you're there.
Okay, so just to add on that, how do you yourself sense when the time is right to take a larger position or bet larger?
Sure. So I recently wrote about this. There are a number of factors that just sort of all come together. And I used four words to describe this recently, and they were alignment, resonance, clarity, and flow. So by alignment, meaning if you're looking at this trade, are things above and below the trade in alignment with your idea? So like if you're bullish on semiconductors, does the whole tech space look bullish? Do other semiconductors stocks look bullish? Is there alignment there? Clarity, do you really see the situation clearly? Do you really see why this is an excellent trading idea? Is it powerful in your mind's eye? And then resonance, are all the parts and pieces of the puzzle pointing in the same direction? Is there good risk appetite? Are the trends flowing well? Other things, and then flow is is this a flowing market where you've got a nice counter trend and you're about to resume a nice trend, or is it choppy and gross? And there's these different factors that you look at, and when all those factors line up together, and they just all come together, that's when you get this instinct based on all these factors that are shining green lights to just really press harder than normal situations when you're trading smaller.
Okay, and just in line with your style of trading, when you do take a larger position, is it sort of likely that you're going to jump all in right at the beginning, or do you tend to pyramid as the trade evolves?
We will tend to pyramid as the trade evolves. However, we will also take much larger positions from the start if we have high conviction, and then it's also influenced by P&L, how much profit cushion we have. So if we have high conviction on a trade, we might take a significantly larger position to start, but then we'll also add to it. The more aggressive we are, the bigger the position we'll take to start, and the more that we'll add. And we're willing to vary our position size by as much as 40 or 50 to 1, and possibly even 100 to 1 under extreme circumstances. So initial position size does vary with conviction, but we also definitely pyramid when we see the opportunity to.
Okay, well said. So I'll definitely try and link to that article you mentioned just before in the show notes. And I mean, just while we're talking about your writing, I mean, there's just so many great one-liners in your writing. I was spending a lot of time on your website last night, and something I discovered or came across, which I'd like to quote you on here, because I just thought it was brilliant. So you said, traders waste a lot of time on things that have no bearing on their P&L. If a line of inquiry has no direct or indirect bearing on your P&L, then why are you expending energy and effort? So could you tell us a little more about your reasoning for making this statement? Or perhaps you could give us some examples of how aspiring traders could spend their time more wisely.
Sure. Well, I think a lot of activity and effort is devoted towards the wrong things or towards useless things. So a classic example is, let's say you have a chart that has 5 or 6 different indicators on it, and all those indicators are based on oscillators or momentum. So if you're looking at MACD and then you're looking at something else and you're layering something else on top of that, this is like looking at the same thing 5 different times, and it's all saying the same thing. So you really didn't need all that extra. You're seeking false confirmation by finding yes men to agree with the first thing, which is a waste of time. Or if let's say somebody has a strongly bullish view on oil, they think oil is going to go up, and then they read a bunch more articles all saying the same thing, but they don't get any new information. It's like, well, why did you need to spend all that time reconfirming an opinion that you already had? So there's just a whole lot of inefficiency, and sometimes that inefficiency is aimed at ego or reconfirming a bias that you already have, or repeating information in a way that's not useful. And so I think there are a lot of behaviors in trading where if you really look at them and you examine them and say, what's the return on investment from behavior, you'll realize, you know what, I could just stop doing that. I could just cut that out. And I think a lot of traders they're not thinking about the habits they have, that they would be better off if they just stopped doing those things.
Yeah, I think that's a really important thing that you highlight there. I mean, that really resonated with me. I quite liked that. So again, something else I'll try and link to in the show notes. But another article you wrote was on form and technique. And in it you spoke about what separates market participants who are average traders and those who are serious competitors. Would you mind just sharing a little bit about that now with us?
Sure. Well, I think there's a level of, to be a serious competitor, there's a level of professionalism that you have to aspire to, and that just is created by a certain amount of training and focus, and it just shows up in a sort of discipline and consistency that other people don't have. So say, for example, that you are serious about being a martial arts competitor, and you wanted to win martial arts competitions and other things, then you would practice and show extreme discipline and rigor, and your form would be very good. You would be able to move through the kata and the different disciplinary movements, and you would know them very well as a function of your desire to succeed, and that would help you. Whereas somebody who's not as serious and not as devoted might be sloppy. There would be, they would have much looser movements. They would do a bunch of small things that aren't as efficient, and they wouldn't be nearly as likely to be successful. And so really understanding high quality form and technique and focusing on the best technique is what's going to help you make the best decisions on a day in, day out basis, and lower the odds that you make any significant mistakes, which might reduce your performance. And that really, over the long run, all those little things really add up.
Yeah, 100%. Now, Jack, we've discussed some really great topics here, but as we know, trading isn't black and white. So at the end of the day, how important is experience to bring this all together?
Well, I think experience is absolutely crucial and irreplaceable, because without experience, you cannot really make good decisions in real time. And the reason I say that is because if you had a whole bunch of books from, master traders, and it was the best education in the world, but then you had to go out and actually make decisions from those books, the flow of market data coming at you and the amount of decisions you have to make in the analysis and the time window that you have, you wouldn't be able to make decisions fast enough. You can't go look up a book every time you get confused about something. So, when you're acting in real time. So part of what experience does is experience is the process of downloading and assimilating all these various nuances and subtleties of information and knitting them together in your head. And another thing that experience does is when you have experience, you run into weird or odd situations that come up very infrequently. And the only way to come across these situations is to get experience in the first place. So you kind of need to build that experience or work with someone who has it in order to really be at the place where you can trade comfortably with large size and have a lot of exposure at the right times, which is sort of what it's all about. So I would say, you have to have it, and you have to build it. There's no real way around that.
Yeah, well said, Jack. Now, just a few more questions before we bring this to a close. So one thing I'd like to ask you is, markets and trading aside, how do you spend your time when you're not in front of the screen and need to shut off?
Okay, that's a good question. Let's see. I really enjoy outdoor activities. I really enjoy snowboarding and hiking. My fiance and I have a 5-month-old Rottweiler puppy named George Soros. We named him after the famous speculator.
Very cool.
And yeah, he's a blast to play with. Really enjoy traveling and spending time with friends and colleagues. Poker, of course. But really, I guess I would say it centers around outdoor activities and travel and, great food and great culture. Really enjoy visiting world-class cities and then, coming home again. So yeah, outdoors, travel and culture, and spending time with friends and family.
Excellent. So one more question. If you weren't trading, what do you think you would be doing?
I would be a professional poker player, no question. It's amazing the amount of profit that is still in that game, and it's for similar reasons to what you see in trading. It's just because 9 out of 10 people at that table, or even 9 out of 10 people who think they're professional, don't actually have the requisite discipline or even the requisite mathematical training to really be serious, and that just creates a whole lot of profit opportunity. So
yeah. So what came first? Were you into poker before you got into trading, or was it the other way around?
I was into trading long before poker. I came across poker about 10 years into my trading journey, in that I had a a friend and client who I was having lunch with 2 or 3 times a week. And he was this brilliant software entrepreneur who was also had Asperger's. And so he would just super focus on these things. And he had become obsessed with poker. And he just kept talking about it. And it was all he would talk about when we had lunch. And after about 6 or 7 of these lunches, I realized, you know what, poker sounds a lot like trading. So I took it up as a hobby because of the similarities to trading. And I was delighted to find that they're so similar. They're both, it's amazing how much they overlap.
Yeah, I have no doubt. So, not that I've played it before, but yeah, definitely I take your word on that. So, how competitively do you play, or is it still just a hobby for you?
I played pretty seriously for a while always keeping it in the background. I was playing 20 hours a week for a while actually working and doing market research at the table. They let you have a laptop as long as you don't slow the game down, and so I had a laptop in my lap while I was playing. I was playing. I've played medium to high stakes for a while. I was playing high stakes in the Bellagio, where the average stack was between $10,000 and $20,000. Overall, I take it pretty seriously. But of course, trading is far more important. I think in the future, one of the things that we'd like to do, we plan to actually start a poker team, in part because we can teach people the methodology that I created around poker, and also in part because poker is just an excellent training ground for trading. To become good at poker, you have to really learn math and statistics and probability on your feet, and you also have to control emotional swings and understand extreme probability cycles and fat tails. So poker is one of the best training grounds you could have for becoming a top-level macro trader. So I've sort of backburnered it a little bit right now because we've got so many other big projects, but we're going to bring it back around and probably start a poker team in the next year or two.
That's really interesting, and I mean, you're definitely in the right place for it, being in the city of Las Vegas. So, yep. Jack, tell listeners where they can go to find out more about you and how they can connect with you.
Sure. Our website is mercenarytrader.com, and we post a bunch of stuff up there. We're about to do a complete overhaul and website relaunch. I'm excited about that. We write daily, and we have an e-letter that goes out. You can get our stuff in our inbox. You can also find me on Twitter. My Twitter handle is mercenaryjack, and I'm pretty active on there. And you'll get some of my sarcastic humor and pieces of news, and I also tweet our articles up there. So really, yeah, visit mercenarytrader.com or check out Mercenary Jack on Twitter, and you'll be plugged into our stream.
Awesome. Really good. So yeah, guys, definitely check out mercenarytrader.com. There's a ton of great articles there which have been written by Jack. So plenty of great reading. Jack, thanks so much for doing this. It's been an absolute pleasure speaking with you, and hope to catch up again soon.
Sure. It was excellent. Thanks again.
Thank you. Hey guys, hope you enjoyed the interview with Jack here. He was a really interesting guest, and it was great to learn more about how he views markets and trading. Now, just a final reminder to take us out here. The giveaway to win a free one-on-one 90-minute mentoring session is coming to a close this Friday, 6th of November at midnight Eastern Standard Time. So if you haven't already entered, go to chatwithtraders.com/win, WIN, to enter now. This is your last chance to be one of 3 winners. So, I mean, this is just an awesome opportunity to get access to a seasoned pro trader who is genuinely keen to help you improve and become a better trader. So, time is ticking, guys. Go to chatwithtraders.com/win, WIN. Go there now, enter your email address. That's it. It's very simple. Best of luck to you. And if we don't speak in the meantime, I'll catch you again next week.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up everyone? Welcome to another installment of the Chat with Traders podcast. You're listening to episode 46. Now, it's really great to have you listening, so thanks a lot for taking the time to tune in today. This week I interviewed Hans Dieterle, who is the founder and president of Honza Financial, which is an options trading asset management firm located in Florida. Hans originally started out as an accountant before becoming a stockbroker. Following that, he began to trade independently and now trades other people's money as well. He's been doing this for just over 8 years now, and one of the things I really liked that came about during our discussion was how Hans has a laser focus on quality over quantity. As a day trader, he averages between 1 to 3 trades per day, which he's usually in and out of within the first couple hours of each session. This then led into the topic of making money as a secondary objective and having a primary objective to consistently make good trades in line with your strategy. A bunch of great takeaways over the next 45 minutes, so let's jump right to it. My name's Aaron Fifield, I'm your host of the Chat with Traders podcast, and here's my interview with Hans Dieterle. Hans, what's up, man? How you doing?
Good. How are you?
I am doing very well. Tell us, what's been happening? What have you been up to this week? I mean, how's trading going for you?
Oh man, trading has been wonderful this week. Solid volatility in the markets, as usual. Creates for the perfect trading environment. So can't complain on that end.
Good to hear. So firstly, big thanks for coming on and doing an interview. It's really cool to be speaking with you. Now, let's see. So some of the topics I'm keen to speak with you about will be how you got into managing money, what can we learn from your approach to trading, and really just some of the foundations developing traders can build from. So how does this sound to you?
Perfect. Let's dive right in.
Cool. Okay. Well, let's do this. So Hans, I understand you've been actively trading for about 8 years now, but take us back before this time though. What were you doing? What's your background? And what was your intro to trading?
Well, it all started back in my freshman year of college. I started working as a junior accountant, and my boss at that time was a former broker on Wall Street and introduced me to the markets, introduced me to the world of investing, and, I instantly fell in love with it. I mean, it was just, something that just pulls you in. And so the following year after that, I decided to join a brokerage firm, got my Series 7, got licensed, and just jumped into the world of investments. And through that experience, being a broker, I always took the time in the evenings and nighttime to really just jump into trading and just, try and learn as much as I could to see what exactly I was selling to clients and how those stocks moved. And that's where I really got intrigued by trading and decided to really pursue that full time.
Okay, so let's just take it back right to the very beginning there. What do you think it was that initially appealed to you about the markets, or more specifically about trading?
What really intrigued me about the markets is just the uncertainty of it, the mystery of it, because you really don't know whether a stock's going to go up, down, or sideways. And so it's really interesting how many different aspects of the market there is, from a fundamental side, technical side, and what really captured the interest for me in actual trading is once I started, listening to earnings calls and watching how volatile the stocks can be, right after an earnings call and even a few days after, that's when I really jumped in and found an interest for trading and decided that, that was the path I wanted to take.
Now, you mentioned at the beginning there that your boss at the time kind of introduced you to trading. How much did he teach you? Was it enough for you to get started, or was it just enough to expose you to something new?
It was really just enough to expose me to something new, and especially coming from an accounting background, which is pretty dry. I mean, investments were just something that is just like it's like a diamond. It just like shines and just brings you in. So, from a trading standpoint, that was more into about the second year of being a broker, but he really just gave me the foundation into the stock market, and that's when I just, jumped into everything from the basics all the way to, money managers and how they managed accounts.
Okay. So at what point did you actually decide to become a broker? Because I take it you obviously left your job at the accounting firm and then switched to becoming a broker. So how did you go about this?
Well, the nice thing was that it kind of just fell into place, so to speak. When I worked for the accounting firm, we did mostly, tax preparation, which I was involved with. So once that ended in April, I just started looking into, where can I apply to become a broker, and there were a few openings, and so I jumped in right into that. So, it kind of went right from leaving the accounting position to working for a brokerage firm.
Sure. Okay. And what was your experience like as a broker? And maybe if you could share with us, what were some of the greatest takeaways from being a broker leading into the '08 crash?
Well, I'll tell you what, the best insight is that when you work at a brokerage firm, you know, um, you pretty much are just another piece to the puzzle, and it's just selling, selling, selling. So from a trading standpoint, unless you're really in a division that's managing money and trading, you're not going to learn as much as you need to. That's more of on your own time. But as a broker, it was very interesting seeing the information, everything, how it flowed, how to deal with clients. Really just dealing with the analysts and seeing what their recommendations were, and just the whole gist of it. I mean, it's a very energetic environment, and so when you get into it, it's very exciting.
Okay, so presumably you probably knew quite a bit about markets while working as a broker, like you kind of mentioned there, but not necessarily about trading itself. So how did you tackle the learning process of becoming a trader once you left the brokerage?
Well, I actually started to really jump into learning about trading while I worked there. A lot of times we would work evenings, and I would spend my evenings and nights just, doing as much research as I could into actual trading. And it wasn't with a specific purpose, like I trade now with technicals. It was just, everything, so to speak. So once we started really getting into stock trading in terms of earnings reports, that's what really lured me in, because, every time a stock got halted, it kind of made me think, why does that happen? How does it happen? Where do the orders come in? How do they get filled once it reopens? And that's when I really said, what, this might be something really interesting to get into, because I would look into other blogs on trading and see how people would trade these companies off earnings, and they were making a killing, and it was just something very lucrative and very exciting at the same time.
And so what were some of the things that you were researching during that phase, like you mentioned there? Were they things that did you have access to more information and more content than your typical trader on the retail side may have?
At that time, we just had mostly just reports from our analysts, so it wasn't anything that, a retail trader couldn't get. I mean, at that time, we were really making headway into, electronic trading, still baby steps compared to where we are now. But on the same token, you know, where I was and retail traders were on the same page. Um, but for me, it was more so just skipping the reports and just getting right into the trading side, because that's where, a lot of people were placing bets, and it wasn't necessarily based off, an earnings report, because all the trades were placed before then. And that's when, I really divulged into learning about trading, and then the options part as well, because that's where a lot of trades and a lot of hedges were made as well.
Yeah, okay. I'm keen to ask you more about options a little bit later, actually. So, just so we're clear, how did you transition from being a broker to then trading full time?
It was pretty much, it was an easy transition, only because, I was already studying it. I was already, pretty much absorbed into learning as much as I could about trading. So once that time came that trading was a full-time thing, I was already in it all the way. So um, for me, it was a little bit different, because now I was managing my own money, my own capital, and not for other clients. So it was a little more emotionally involved, so to speak, right when I started off.
Okay, so when you did make that jump with your own trading, you were already fairly consistent with your profits and your returns and that type of thing.
Well, the unfortunate part and the fortunate part about when I started trading was it was at the peak of '08 when the market collapsed. But when I first started, it was maybe 2 or 3 months prior. And I remember distinctly my first 7 trades were all profitable, all phenomenal profits. And right when I made my first mistake and had my first loss is when the market started collapsing. And then that's when the real learning curve, set in for me as a trader.
Okay, so I mean, you had actually mentioned this to me before we started recording this conversation, but you mentioned that you had blown up 1 or 2 accounts. So speak to us about like how did this happen? Like what led up to that? What was the cause of why those 2 accounts got run into the ground?
Well, the biggest thing is emotion. The second biggest thing is stupidity, because at that time I knew that the trades I was making weren't the right ones. But when you're a brand new trader and you have the type of market volatility that happened at that point in time, everything just hits you like a ton of bricks, and you don't really stick to your strategy. And you take one loss, you want to make it back, so you jump into another trade, make another loss, and then you start, you know, averaging down, making more mistakes, and one thing leads to another, and you just blow everything up. I mean, it's really just an emotional roller coaster, just because it's your money, and you make one mistake and you want to make it back as quickly as possible, and that's just the biggest hurdle that I had to deal with is really just sticking to my strategy and not becoming way too emotionally involved.
Okay, and besides becoming too emotionally involved and that type of thing, were there any other challenges or other significant failures that you had to overcome, which were also frustrating at the time?
Well, in terms of day trading, it's a very tight type of trading. And what I mean by that is, it's not like you're buying and holding. It's not like swing trading. You're getting in, so you basically have to fight volume, you have to fight volatility, you have to fight spreads, and you also have to fight the market makers and the specialists who are always against you. So, I mean, there were many hurdles, and all those hurdles can really take a toll on you if you're not careful. And the way to be careful is to really devise a strategy that makes sense and that, works with your particular trading style. And a lot of times when I first started out, that was the mistake I was making, is not rationalizing a trade and just jumping in just to actually make a trade.
Okay, cool. Yeah, thanks for sharing that with us. Now, moving forward just a few more years, you began to actually manage money for other people. So, how did this opportunity come about? And had it always been your intentions from the get-go to take on other people's money?
For me, it was never an end goal to manage other people's money. For me, trading was more of a lifestyle, was more of the excitement of the job. To me, it was a dream job to be a trader. And once I started really being profitable and I had 11 months of consistent profitability, that's when, family members and friends started taking notice and wanted to be involved. And, once I started managing money for them and, being successful in doing so, that's when I decided, maybe this is the path I could take because, uh, right now, hedge funds are emerging. It's the new hot career. And so, if I'm good at what I do, why not jump into it? Why not try it out? So that's when I really decided, after managing money for friends and family, is, maybe I can make this, a long-term thing.
Okay, and when this began to happen, you were, of course, handling large amounts of capital. How did this affect your decision making, your psychology, and just your overall trading? Did it have any effect in any way?
Um, it actually had a more positive effect only because, when you're trading your own capital, you have more of a safety concern and you put that mental block in your mind, and sometimes you miss the right opportunities to make an entry and to make an exit. When I'm managing other people's money, it kind of takes that personal emotion out of it, and I can focus more on the actual trade and not the monetary value and not how much I'm looking to make out of a trade. So I'm looking more at the entry and the exit, and so it's more of a professional standpoint and not an emotional standpoint. So once I was able to take the emotion completely out of it is when it really just started clicking for me. And that was especially when I started managing money for other people. Um, it's just a different caliber of trading. My trading style never changed, but it had to become more adaptive to, higher capital allocation, and also, um, with that said, the emotions taken out, so it's easier for me to be able to handle multiple accounts at once and not be, you know, uh, strapped down, wondering where everything is going, what's happening, and all that.
All right, good one. So, Hans, I'd like to now focus more on your style of trading. So, if you could, just take a few minutes to describe your actual method of trading and the types of trades that you like to be involved in.
As for me, I like to trade in mostly tech and biotech companies. I think that for my style of trading, high volatility stocks are the only way to go. Um, when I did start trading first in my first few years, I did trade stocks primarily. Once I learned about options and the leverage they provided, and the minimal capital you can put up, based on how much you're actually controlling in stock, that's when I, decided to trade options full time. And for me, what I look for in my trading strategy is mostly reversals, and these happen usually in the first 30 minutes of the trading day. Um, and this was one article that I read that talked about specialists and market makers and how the correlation between them and retail traders is the same as Vegas and gamblers. I mean, the house will always win. So, especially in this day and age where everything is electronic, you're not going to beat them, so you might as well join them. So, I kind of started to develop that into my strategy, and a lot of times, there'll be gaps in the morning, either up or down, and I'll basically watch the volume. I'll see where the resistance and support is based on the candlestick patterns. on my 5-minute charts, and that's the way I place my trades, is to find the extreme on either side. So, for example, if Netflix drops on the open and we're down 5%, and I'm looking at the volume, the typical reaction from any, beginning retail trader is going to say, let me sell out of this position because it's dropping. For me, is let me find that, support level at the bottom, because this is where the big boys are buying in, and that's where I'll place my position on a call and ride that up. And it's the same pattern if it's, reaching a high point, reaching resistance on a gap up, then I'll be looking to place a put option. So for me, my style of trading is mostly reversals, and that is also why I only place about, 1 or 2 or 3 trades a day, because I try to focus on the quality of the trade and not necessarily the quantity and just scalping.
Right. Okay. So I've of course got a bunch of questions around your comments there. So first of all, trading the open. I mean, that's generally the most volatile part of any given day, and there's a lot of noise, lots of short, sharp moves. What helps you to get a clear read on what's going on here, or to even anticipate the direction?
For me, it's just I usually take a look at the stocks that I have on my platform, and I take a look at the charts, and I try to see where they are relative to the prior day's close. So if they're already gapped up, then I'm going to be looking to have a put position ready to trade. Same thing if they're gapped down, and be looking to have a call position. So for me, it's mostly looking for the extremes in the volume, because you're going to have your high and low set within the first 30 minutes of the trading day. So, the broad markets don't really, matter to me. The futures don't matter. It's really just looking at that individual stock. And for me, it's the price action, the volume, because, there could be a huge gap up. It'll start to push up even higher, but the volume will be extremely low. So that'll be, an indicator for me to get into a position. So for me, it's really the extremes, and they usually happen every day, unless there's some kind of catastrophic event in the market.
Okay, so just on the topic of volume there, I mean, some traders really do factor this into their trading decisions, and it sounds like, you're one of those traders. And then on the other hand, some have very little regard for volume. But I mean, could you just share a little more on what you like to see happen with the volume to give you conviction on a trade?
For me, I'm looking at not only volume, but also level 2, because I'm trying to see where the order flow is going. So, for example, if we're, let's say we're at neutral on the day, so the stock hasn't moved pre-market, and the first candle, it gaps up, and let's say it's up, stock's at 100 and it's up at 105. So what I'm looking at on the volume is I'm looking to see what the order flow is. Are there more sellers coming in at this peak? Are there more buyers? And that's really where my conviction is. I don't like to add too many indicators. I use RSI strictly as a lagging indicator, and that's on more of an extreme level. For me, it's just using the candlesticks, and I mean every day it's the same setup. So it's really also a psychological standpoint, because as much as everything is electronic, everything's controlled by specialists and market makers, and everybody placing a trade, besides your big funds and algorithms. I mean, a lot of them are retail traders, so there's a lot of human emotion involved. And so what I look for is the greed in the market, and the greed in the market is what really develops a solid trade, because the volume will tell me whether people are starting to pull back, whether they're still buying. Once I see weakness, and that's where my price action is my primary indicator, that's when I'll start to have a trade ready and place it when I'm starting to see resistance or support. Okay,
cool. So typically speaking, 1 to 4 trades per session, like you mentioned a little bit earlier, I mean, that's a fairly low number for a day trader. This is obviously intentional. So share with us why you choose not to take more trades.
Well, I mean, the first part, I mean, commissions will eat up your profits if you're taking way too many trades in a given session. But that point aside, for me, it's always been quality over quantity, and I look for I look for moves that I can get into and ride the wave instead of just getting, I don't know, 10 cents on a contract and then pulling out. So what I like to do, let's say for example, I'll buy a call option, I'll put a trailing stop in, and so it'll be at a 10 cent interval. So every 10 cents it goes up, my stop gets moved up. So even if it drops again, I'll be stopped out at a profit. So for me, I like to get into a solid trade where all my instincts and all my indicators are giving me a solid conviction, and be able to ride that move up a few minutes, and then exit the position instead of just trying to scalp, a few cents per move. Um, and that's worked for me for many years. I tried the scalping, but it's really, it gets too complicated, and it just gets messy.
Okay, so with that being said, how long would you say on average you hold a position for?
Um, that actually it varies. I'd say on average between, let's say, uh, 1 to 5 minutes. There's positions. I placed a position last week where I was in and out in about 30 seconds. Um, it really just depends on how extreme the move is in the individual candle. Um, if the stock's at 100 and I'm in a call trade, and it goes to 104, then I'm gonna exit my position. So um, it really all just depends. I usually try to set an entry and exit on each trade, um, and if it jumps into a next candle and just keeps going higher and higher, then I'll wait a little bit. Um, if not, then I'll just exit my position. So I try not to get too greedy with each trade, but I do like to have a set target, with each position I enter.
Okay, so you just said there that some of your trades might range from 30 seconds up to like 5 minutes. I mean, that kind of sounds like it's borderline on scalping. How does it differentiate from scalping?
Well, how it differentiates is the fact that, because of the volatility in the first 30 minutes, there are going to be, very wild swings in either direction. So um, there can be a pop, a drop, and another pop, and then it's just going to ride up and away for the rest of the day. But for me, a lot of times I've seen friends that scalp, and I've even tried it my first 2 years of trading, is just looking for a few cents per move, and get out and get in and get out. But for me, it's just, especially in these stocks that, are so volatile, the moves will be quick. And if you're in the right position at the right time and that profit's there, then I'm going to take it. Um, Otherwise, if I held it longer, then it would turn more into like a swing trading scenario, and that would be for more into the session. So I try to end my trades around 10:15, 10:30 is when I'm done, and that's where the most volatility is. So I try to make sure I capture my profit instead of being greedy and then taking a loss.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
I mean, you spend very little time actually, I don't know if it's the right word, but invested, actually active in the market. So how do you actually find those, 1 to 2, 3, 4 trades that you might take in a session? Like, how do you have an idea before the bell rings what trades you might be taking that day?
I mean, definitely. I usually trade, I pick 2 stocks. I kind of done, a lot of back testing, a lot of research, a lot of, studying charts on individual stocks, and I try to figure out which companies work with my strategy the best. And so I'll have them set up, and I mean, for example, I'll trade Netflix and Amazon day in, day out, and I've traded them for the last 4 or 5 years, and it's the same moves all the time, with exception, obviously. So for me is I'll set up my, my options, set up my trades, and I'm ready to go. So if I see, a gap up, a gap down, or a neutral, then I already know, where my gut's telling me where it's going to go, where the highest probability that it's going to go, and that's where I'm, ready to pull the trigger. Obviously, it's a little more involved than that, but I always have a game plan going in, and I like to be, prepared for each trade.
Okay, so essentially there's 2 stocks that you really like to focus in on, and that's essentially where most of your trades are taken, within those 2 stocks. Is that right?
Yes.
Okay, cool. So I'd like to pick up on something you touched on a little bit earlier, and that was kind of trading on the actions of market makers. And I'd like it if you could perhaps go into this a little bit more. So just help us understand the concept of this a little bit more, of trading the actions of market makers.
Well, definitely. Market makers are in it for, to make a profit, and they're not going to lose. They're the ones from the big firms, J.P. Morgan, Goldman Sachs, list goes on. And so they're basically the ones that, are on the other side of our trades. They're the ones managing the order flow. They're the ones that have their own capital and, in the millions, to really, keep the individual stock, liquid. And each stock can have, depending on their volume, up to, from 4 to 40 market makers. And so you have to know that these guys, are all going to make money. And so you have to be on their side. And, it's like I talked about before, when the market's dropping, then, they're slowly buying up. And when the market's just ripping higher, I mean, they're starting to accumulate short. So you'll never know, because now, you have dark pools, and you have, smaller block trades. So they have a way of manipulating and really hiding their individual trades. So you'll never know. But I mean, it's just a pattern that I've noticed when I started, and it still holds true to this day, that, these guys are in there and they're making their trades, and if you're on the same side as them, then you're making money, and if you're not, then you're losing. I know a lot of times when I would place a trade and I would say, this is the perfect position to buy, and I would buy, and all of a sudden the market, would just, the individual stock would just crash, and I would either get stopped out or at the sellout. So, and as soon as I did so, then it would pop up again. So it's really about timing, and it's really about understanding, what their mindset is. And once you click into that and you really start making trades on, on their fundamentals mentally, then you'll be successful.
Okay, so is there anything that confirms or makes it very obvious to you that you're on the same side as the market makers?
For me, It's more so looking at the extremes. Once I start to see the support and the resistance, you'll start seeing that you'll start to see the switch in the number of trades and the actual volume in the level two. Um, and in those extremes, they'll have in the individual candle, you'll see that they'll, for example, if it's down big, and they'll pop it up a little bit, bring it back down, pop it up, bring it back down, and once you start to see that, you'll start to see the consolidation happen in the individual candle itself. Um, and I use 5-minute candles, and so that's when I start to see that the momentum is there to go back up, the accumulation's happening on the buy side, and that's when I'll place the position. A lot of times I'll want to, the next candle drops even more, but I have to see that support. And if I don't see it, and if I don't see them, starting to accumulate slowly, then it's not something I want to get into.
Okay, sure thing. So, yeah, that's good to get a little more insight on that. Now, this is something we were speaking about a little bit off air, and that was simplicity. And I mean, this seems to be a topic that's come up quite a lot lately. But how have you made a conscious attempt to keep your trading style simple? And also, is it occasionally difficult to maintain simplicity because naturally we have the urge to often overcomplicate things?
It's always interesting whenever I see other traders online, or I see seminars, and they'll have a chart and it'll be just jam-packed of indicators. And what happens is a lot of times you confuse yourself when you have too many indicators, and they're not always going to be in correlation with each other, and so you're going to make mistakes. For me, RSI is the only thing I have on my chart, and that's more of a lagging indicator. That's more of a final conviction for me. If the stock's trading at its extremes, be it, whether it be on the low side or the high side. But when you keep it simple, you stop overanalyzing, because especially in day trading, there's no time to really overanalyze. It's either you're getting into a position, or it's gonna jump away, and you miss your opportunity. So for me, it's find the conviction and the simplicity of the actual stock, because it's there. Price action will always tell you where a stock's going to go. Everything else is just more of a probability, in essence. So price action and volume has always really been the most important thing I rely on. Plus, I mean, stocks don't really move necessarily on fundamentals or technicals. They move more so on supply and demand imbalances. So, it's who's buying and who's selling, and that's going to drive the extreme of any stock. That's what's going to drive your price action. That's what's going to move the price. That's what's going to drive the chart patterns, and that's the easiest way to make a trade, because once you start overcomplicating and putting way too many indicators on your chart, I mean, you're just looking at a maze and you just confuse yourself.
Yeah, that's a really great point you bring up. And something else that came up when we were initially exchanging emails back and forth, you hit on the importance of creating a system and sticking to it. So what I'd like to ask you, as a discretionary trader, what does having a system mean to you?
A system to me is most importantly being disciplined. And a lot of times, especially as a new trader, I would do it, and many other people have done it. You make one bad trade, and then you try to make that money back as quickly as possible, and then you completely throw your system out the window because you're focused on one thing, and that's making back a loss, and not actually focusing on trading. I mean, you're always gonna fail your way to success. I mean, that's just hands down. So for me, the most important thing is discipline and having a strategy and sticking to it. Obviously, emotion is the hardest thing to take out, and that takes years, because we are human, so emotion's always going to be there. But you want to limit it to a point where it doesn't affect your trading style per se. So for me, it's I don't look at it as how much money can I make. I look at it as, okay, here's the chart, here's what's happening, this is where I want to enter, this is where I want to exit, and that's it. So, everything else is secondary to that.
Okay, now you hit on emotion there, and I'd just like to not skip over that because it is such an important thing to traders, and it affects pretty much everyone who's involved in this game. So, over the years, how has your attachment to money kind of shifted? Like you said, it took a matter of years before you begin to kind of not ignore, but reduce the impact that emotions had on your trading. So what type of things have changed over time?
As with anything, I mean, it's really experience, and if you have discipline with experience, then you're going to move in the right direction. If anybody can be doing something 20 years and be doing the wrong thing for 20 years. So you really just need to focus on the strategy, the discipline, and look at money as a secondary objective. The primary objective is to make profitable trades each and every time. And even if you make one bad trade, 2 or 3 in a row, you just need to still focus with your strategy and stay disciplined to it and never quit. Because I used to look at money as the end game. How much can I make on this trade, how much on that trade, but capital really is just a tool. And so when you take that out of the equation and just focus on the trading at hand, then that's when you'll start really focusing on what needs to be done, and the profits they'll be there at the end of the day. But if that's the only thing you're focusing on, then you're not going to be successful as a trader.
Yeah, so speaking of kind of sticking to a strategy, even after, several losing trades, how did you gain the confidence to stick to a strategy? Because I mean, as a trader who's still kind of on the come up, many struggle to have confidence in what they're trading. So how did you get the confidence to stick with a strategy in the early years, even though it hadn't really proved to you yet that it was a good strategy to be trading in the first place?
I mean, to really be confident in a strategy just takes perseverance. You know, especially with trading, it's an ever-changing landscape, and you're always going to have to adapt to different conditions. With my strategy, it's pretty much been the same for, I'd say, 5 or 6 years, but it has always been tweaked, a tiny bit here, tiny bit there, to really adapt to the market. And that's the important thing, is to know that you don't have to reinvent the wheel, but sometimes you're going to have to make improvements, and that's what I've done. And I'm sure there will come times where the market's going to change up a little bit, and I'm going to have to adapt to that and kind of make improvements to my strategy as well. So it just takes perseverance and really just like practice at it. I know I spent about, I'd say, 4 to 6 months paper trading my strategy, just to fine tune things and really just focus on the actual trading instead of the money, because like I said, like we went on before, when you take the emotion out, everything just rides much smoother. So if you have a strategy, practice with it first, really fine tune it, and then implement it into the actual market.
Okay, well said, well said. So, just while we're kind of on the subject of it, the fear of missing out is a real thing for many traders, and I'm sure this is something that you've been affected by in the past, even if you're not affected by it too much in current times. How did you deal with this? And speak to us about your views on chasing trades.
A lot of times you will, as a new trader, I mean, you're obviously going to want to chase trades, and the problem is you chase the wrong one. So I mean, I've done it countless times where you have a position move against you, and you just want to hold it and just hope it comes back. 90% of the time it doesn't, and you just take a bigger loss than if you would have just stuck to your stop loss and got stopped out, or actually sold out by yourself. And then again, on the flip side, you have a position, you have a small profit, and you cash out before, and then you see it just keep riding, and you missed out on hundreds or thousands of dollars in profit. So the important thing is to, if a position moves against you and it's at whatever your risk tolerance is, mine is 2%, I will exit that position, and that's done. So if no other opportunities come, then I wait till the next day. If I have a winning position, then I'll put in a trailing stop, and so I have my profits locked in. And I'll either ride it out or I'll just take a profit and then the position and look for another one. So the important thing is not to chase the wrong side of the trade. And a lot of times for traders, and for me as well, when I started, you're chasing the wrong trade, and you're letting your losers lose and your winners you're cutting short, and that's a huge mistake.
Sure thing. Okay, really great answer there, Hans. Now, let me ask you one last question, and then we'll probably call this a wrap. So, are there any resources, blogs, websites, or books you'd like to recommend to traders listening that have been helpful to you?
For any traders that are actually looking to trade intraday, I would say just basically go online and just look up trading, just look up the fundamentals of it, and really, set up a paper account and just start trading, and it's more of a trial and error. I don't think there's really any book or textbook that's really going to give you a great answer or a great blueprint for day trading. I mean, value investing and long-term investing, those are great for other people, but you can read up on that all you want. But for trading, it's more of a experience type of career. So all it is just do your fundamental research and just build a foundation. Just read as many articles as you can, and open a paper account and just start trading and just figure out what works for you.
Totally brilliant answer. Now, Hans, where can listeners go to find out more about you and to also connect with you?
To connect with me, you can connect with me on Twitter at Dieterle. That's DEDERLE. And my firm is www.honzafinancial.com. It's HONZA. And also, I'm also on Instagram, at HONZA options, and that's with a Z. So you can all find me on there.
Awesome. Okay. And guys, I'll be sure to include links to all of those in the show notes. All right, Hans, well, thank you very much for doing this. It's been awesome speaking with you. So have a great evening, and let's speak again soon.
All right, perfect. Thank you for having me again.
No trouble.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with consistent execution.
Is that they're just like everyone else. However, they've worked hard.
All right, what's up, guys? Hope you're doing great. Welcome to episode 47 of the Chat with Traders podcast. I'm your host, Aaron Fifield, and this week I interviewed Timothy Sykes. If you're not already familiar with Tim, for some strange reason, he's made quite a name for himself as the penny stock guru who trades, teaches, and flaunts big piles of cash on Instagram. And before you can get a word in sideways, he'll also gladly remind you that he does have millionaire students. Now, I really enjoyed this conversation with Tim because we covered many substantial topics that do play an important role in a trader's success. To rattle off just some of those topics, we discussed what's all the fuss about making $1 million, how to stay motivated and get the most out of your dedicated study time, how to combat the urge of overtrading, how to avoid liquidity issues in OTC markets, and so much more. Now, I'll quickly point out there's a full recap on this episode with all the links and resources mentioned at chatwithtraders.com/47. So you can find everything there all in one place. Alright guys, hope you enjoy this episode. I'm your host Aaron Fifield. This is the Chat with Traders podcast, and here is my guest who has become wealthy from penny stocks, the most hated niche in all of finance, Timothy Sykes. Timothy Sykes, what's up man? How are you?
Hey, how's it going, man?
I'm doing very well. What's been going on?
Nothing much. I'm watching your channel blow up. Good work.
Thank you very much, and welcome back to the podcast. It's good to be speaking with you.
And thanks for having me.
No trouble. I think it's actually pretty close to 12 months since we recorded our first interview. So bring us up to speed. What's been happening?
Time flies. Just more craziness. You know, my business has doubled. It's been doubling every year. So just trying to deal with it. It's a good thing. It's a good problem to have, you know, and now I have a charity, and I don't think I had a charity last time I talked with you.
No, I don't think so. And I'm keen to ask you a little bit about that.
Yeah. So I got the charity, and, you know, now I'm actually starting to teach on how to grow your social media. I've got this company called Wolf Millionaire, which is going to teach how to grow and make money on social media. So just expanding, teaching more, and, you know, trying to show opportunity wherever there's opportunity.
Very cool. Okay. Now that sounds really interesting. And you had the Trader and Investors Summit in Las Vegas just a couple months back. I mean, how was that?
Oh, it was great. We had like 550 people as opposed to last year was like 350. So that's growing nicely too. And, you know, we just talked, and a few more people broke down crying in front of me saying how much my lessons have helped them. I've got over 3,000 video lessons now. So it's just been building, you know, it's a good year.
Sure. Okay. And I've got to say, congrats on your recent interview with Larry King. I mean, you must be stoked with that.
Oh, yeah. You like that?
Yeah. I was listening to it. And I like the part where you described to Larry that the technology of a company, and I mean, really just the company in itself, is very disconnected from the actual stock price when you're dealing with penny stocks. I thought that was really interesting.
Thank you. It was kind of interesting because he actually has promoted a penny stock, and there was a kind of an awkward few minutes when he was talking about that. And the interview hasn't blown up very much because his people don't really want to push it because of that little section. So kind of funny.
Sure. Okay. Yeah, I kind of sense that a little bit. But so let's dig into it. I mean, one of the things you were really preaching during the interview was how you want to help more traders become millionaires. So I'd like to spend some time and drill down on this. Why do you believe so many people have the goal of becoming a millionaire?
Yeah, I mean, again, $1 million in today's world, not going to help you retire. Like it's a good start. Like you can live very well, but it's just a good, you know, just a good goal. I've been doing a lot of reading lately on psychology and, you know, just how to improve performance. And if you look at some of the classic studies on goal setting and improvement from Locke and Latham, two psychologists and sociologists, I mean, they basically say having a big goal increases performance 15 to 25%. Not necessarily saying, okay, I need to make $1 million all at once. It's not like some get rich quick bullshit. But just having that, like, okay, what are the steps I need to take in order to get to $1 million? Rather than if you have 5, 10, 20,000 to your name, you know, how do I double this money? That's what most people, you know, theoretically want when they first start. So a lot of people don't like the fact that I throw out these big numbers because they're like, no, that's unrealistic. But, you know, I did make a few million within my first few years. Several of my students now have done the same. And having that big goal, even if, you know, you're not necessarily going to get there within a first few months or a few years, it helps push you to study harder, and it keeps you, you know, disciplined on the right path. And that's why I think that, you know, frankly, out of all the stock trading and financial teachers out there, nobody else has several millionaire students. And, you know, obviously I kind of look like foolish to talk about money and to talk about millions and to show these big stacks of cash. But, you know, I do whatever I can to try and keep people studying. You know, less than 10% of the people who have access to my video lessons even bother watching them. They just want hot picks. So I have to do my best to try and, make this into a marathon, not a sprint. And, marathon runners do what they have to do to get through the whole marathon.
Sure. And we're going to get right into that. So before we do, let's just stay focused on this point. What are their underlying reasons and motivations for wanting $1 million? Because in reality, it's really just an arbitrary number. Wouldn't you agree?
It's an arbitrary number, but, so is owning your own home, like where it's the American dream. You need these goals and these visualizations. I take out like just stacks of cash from my bank accounts and take pictures of them rather than just sharing, a screenshot of a few $1 million in a bank account, because these visualizations, that's what we, really get motivated from. Like I hashtag, Monday motivation or daily inspiration. And it's these big goals that really help you. I mean, the same thing. Why is my orange Lamborghini so famous or infamous? It's just a car. It goes fast. But, when I was a kid, I had a poster of a Lamborghini and a Ferrari on my wall. And I said, one day I'm dreaming, I want these things. And now that I have the Lamborghini and I'm actually getting a Ferrari, it doesn't mean as much, but it was pushing me. And, when you get pushed and you finally achieve the goal, it's pretty beautiful. It's no different than winning like a gold medal at the Olympics. You have a little circle of gold around your neck. What does it really mean? It means nothing. In the real world, if you melt it down, what is an Olympic gold medal worth? Not that much, but it's the journey and it's the process and it's beautiful.
Okay, sure. So let me ask you this then. When you yourself crossed the $1 million mark, what changed for you? Was there anything that stands out?
So this was 2002. I was just 21 years old. I was on semester at sea. And I was on this trade. I made like 80 grand on it. The internet had gone out on the cruise ship. And I was running around freaking out. We were like in the South Pacific in a storm. And, when the internet came back on, I turned out to be right shorting this stock. I think the ticker was ASIA, Asia, which was ironic because that's where we were. And, nothing much changed. Tim Grattani, I was there when he crossed $1 million. You had him on, great interview, and he made like $9,000 on a trade. It wasn't anything great. Now he's getting close to $3 million a few years later. $1 million in the grand scheme of things is meaningless. It's just a good goal and a good, mental achievement.
Sure. Okay. Yeah, and it was really good to speak with Tim Grattani. So if anyone wants to hear that, that's on episode number 10, so you can check that out there. Let me ask you, do you feel like it's potentially a problem that some people may be motivated to trade for the wrong reasons? Like, you said just before, you use your flashy marketing as a way to attract people to trade. But if they're attracted purely by, Lamborghinis and big houses, is there a chance that they're motivated to trade for the wrong reasons? And can this be an issue further down the track?
No, as I was telling Larry King, once you get to $1 million, you get a lot wiser. Like, you don't really care about the Lamborghini. You don't care about the flashiness because theoretically, if you have gotten to $1 million trade by trade, wins and losses, it's been a journey. It's a struggle. You've grown and you've matured and you realize, what matters. But when you only have a few $1,000s to your name, and trust me, I have more students than anybody, so I see more of these people than anybody. What they really need is that motivation to keep going, to after their day at school or after their day of work, they need what is the motivation that's going to push them to study this SEC filing or to listen to this conference call from this company at night when they're exhausted. And you need that extra push. I think it's insane how there is like this small subset of traders where they're like, you shouldn't talk about money. It's too flashy. Like, we're trading money. We're speculators. We're gamblers. This is all about money. There's a lot of people who fancy themselves philosophers and, we're doing trading not for the money. Like, are you freaking kidding me? We are in this for the money. Yes, you learn about yourself. Yes, it's a journey. Yes, it's an amazing achievement and it is a struggle, but this is a business. This is financial, improvement. This is trying to change your life. And then once you have the money, you can do whatever you want. You can help orphans. I just started a charity very late in my life. I got my Lamborghini before I started the charity. Maybe my priorities were messed up for a little while, but I do love giving back, and I do like my Lamborghini, and I like my house, and I like my trips. And, I think that you should be proud of wanting, financial freedom. You shouldn't want to struggle in a rat race 9-to-5 job with a boss that you hate, with mortgage loans and school loans and, just a crappy life. So I'm very proud of my flashiness, and it might be over the top, but at least it punctures this bullshit that we see in society where, you have to kind of be ashamed that you want nice things, and you have to be ashamed that you're in this for financial freedom. Like, this is what everybody dreams of. People should want financial freedom. You can take care of your loved ones. You can take care of your kids. You can take care of your friends. You can go wherever you want. You don't have to stay in your same small town or city. You can travel the world and explore. I think this is the dream, and I think there should be more flashiness. I was also telling Larry King, I said, imagine if your high school math teacher pulled up in his Lamborghini every day. You probably would be a lot better at math if he did that. But most high school teachers and junior high school teachers, even college teachers, these are people who can't do. And now they teach. And so you don't really get motivated by someone who's like, this guy, maybe your teacher. I had a teacher who was like once on Jeopardy. That was like his claim to fame. And you just don't get inspired by their life story. So I wish more teachers shared their life story in a big, bold way to get people studying. I think any single thing that you can do to get people studying, not just following hot stock picks, is a good thing. Once you subscribe to my stuff, once you see my video lessons, I'm not saying, buy this stock and you're going to buy a Lamborghini. I say, watch this 6-hour DVD, learn about risk reward, risk management, how to choose the best stocks, what factors to avoid. So, yes, I'm drawing people in with the flash, but once you start studying, you see that that's not what I'm about. And, I think a lot of the people who think that I'm just all flash and no substance, they don't study. I have 3,000 plus video lessons. 500 of them plus are free on my YouTube channel. So you can see everything. And that's why I'm very proud of my business.
Yeah, that's really good to get your take on that. And I like your perspective as well. I think that's really interesting. So while we're on this subject, how do you feel about setting goals with a monetary value? Because some people with this school of thought that your goals should be process driven rather than being fixated on a dollar amount. So I'd love to get your take on this.
Again, I deal with people who have $1,000, $5,000, $10,000, sometimes $50,000 to their name. But the vast majority of my students have a few $1,000s to their name, and they need to dream big, and they need to see, visualizations that are big to get them, just through this whole long journey. And, setting big dollar amounts as opposed to small dollar amounts, in the process and the philosophy, like, you don't have time. We don't have the luxury of, being all philosophical and looking down on material goods when you have a few $1,000s to your name. You need to get these people inspired. Big money, fast cars, exotic trips, the life that they dream of. And that is the only thing that will get them studying. And I know it comes across as douchey, and I'm sure a lot of people dislike me purely because of that. And they've never once watched any of my, video lessons or my DVDs or, I just finished a 2-hour webinar that I give every single week to my Trading Challenge webinars. Tim Grattani gives webinars too. My first millionaire student, Michael Good, gives webinars. So there's a lot of education that is required in this. And it's just not fun. There's no way that studying all these webinars and charts and indicators and learning about trading, which is not like an exact science, like I say, look, buy earnings winners, short pump and dumps, but sometimes an earnings winner goes down and a pump and dump goes up. And people are like, why is that? It's not logical. And you have to realize that the stock market is not always logical. And you can't say, it's very difficult to teach the stock market as opposed to mathematics, because mathematics, you have specific formulas. They're always right. 2 + 2 always equals 4. In no way does 2 + 2 ever equal 5. But sometimes in the stock market, the absolute worst shit company can become the hottest stock for several days, weeks, or even months. And even if you're eventually right that it's going to go bankrupt, you can go bankrupt in the process shorting too soon. So you have to kind of do what you can to teach these hard realities. And, I get into that in all my stuff, but in order to get people even watching the videos, I'll tell you an example. I don't know if I told you this last time. I tell this story often, but I have a 45-minute video of basically how to read SEC filings, how to spot red flags and stuff like that. And on the JPEG, the little thumbnail for the video, at first I had just like an SEC filing, and it's, it's white with like little black type, and it doesn't look very interesting. It looks like you're reading like little jargon. And then I tried an experiment, and I put a thumbnail of my orange Lamborghini. Same exact 45-minute video lesson underneath, but one has the thumbnail with a rather exciting car. Guess how many more people click the thumbnail than the little thumbnail with the financial jargon? Let's see if you can guess, Aaron.
It's tough. I'd say probably 4 times as many, 400% increase.
That is correct. 4 to 5 times, depending on, what day it was. But that's a huge increase. And also the amount of time that people watched. If there wasn't the right thumbnail, people would watch between 5 and 7 minutes. And then with the Lamborghini, they watch between 30 and 40 minutes. So it's about getting people to study and knowing what incentivizes them, because even it's very similar outside of finance. 80% of people who have gym memberships don't go to the gym. It's like, oh, I'm going to be healthy. I joined the gym, and you're paying this monthly dues, and it's kind of like these guilty dues, and you just don't go. So I have to try every single day to motivate people to actually study. And that is the toughest part of my job.
Okay. So, you've been very out there in saying that it's your goal and you're very motivated right now to create more millionaire traders. How do you intend on helping others to reach that $1 million goal? Can you share that with us?
Yeah, so last time we spoke, I did not have nearly as many video lessons. We didn't have as much categorization. On Profitly, we now have user tools where it's not just me giving video lessons. But now users can actually make their own videos and post their own blog posts and post their own watch lists. So I think that a lot of the key of becoming a self-made millionaire in trading is really looking at yourself. Most people think you need the hottest plays to make a lot of money, when in reality, the hot plays are always there. The question is, are you going to be able to really take advantage of them and profit from them? And that comes, it's a battle of you versus you. That comes from inside of you. So in order to be the best you possible every day for the stock market, you really have to look at what you're doing right and what you're doing wrong. And that comes down to, keeping spreadsheets. My top student, Tim Grattani, has thousands of spreadsheets tracking every single successful strategy, unsuccessful strategy, what's working, what's not, which stock promoters are influencing the stock, how is the stock performing on day 1, day 2, day 3 of the promotion, and in tracking all of this stuff incessantly. And, it's a lot of hard work. And even when you do the hard work, you're still not guaranteed a profit. So I think that as a teacher, obviously I can create more video lessons, do more webinars, answer more questions, create more guides. But I think users and students really need to understand that they have to, really look inside themselves and use these new tools that we've, created to blog. I wish that more traders were fully transparent and showing all their trades on social media so that, they could have the community show them, look, I just made this trade. And you get rewarded when you do a good trade and you say, even if the dollar gain isn't that big, I really executed and stuck to my plans and stuck to my rules, and it was great risk management. And if you post that on Twitter and on Profitly in the chat room, you get a lot of, positive feedback, versus if you make a dumb mistake and, you talk about that dumb mistake, you're still going to get positive feedback from the community, but at least you're going to be kind of held responsible, held accountable for your trades, good trades and bad, by sharing everything transparently. And I know a lot of traders don't like this. I know that some traders have ex-wives and IRS problems and privacy issues, so they don't want to do that. I don't think that you need to share your name. You could be Purple Dragon 457, but as long as you, try and really just look deep down inside of you and your own psychology, what is the best strategy for you? Some of my students are better at buying. Some of my students are better at shorting. There's not one right path to making millions in the stock market. And I think that as, Profitly grows, we nearly have 100,000 members now. More and more people are rising to the top of the leaderboards with different strategies. So it's not just my strategy of shorting pump and dumps and buying earnings winners. people can come up with all sorts of strategies, and sometimes strategies work for only a few days, weeks, months, years, and you have to keep adapting. That's the beauty of trading. That's the beauty of the stock market. It's constant adaptation. And if you don't adapt, you're going to perish. You're going to be a dinosaur.
Yeah, I mean, accountability and tracking, both really great points that you brought up there. I like that. What tips can you give to someone who may be struggling with study? Either it's the task itself, because I mean, some people have a difficulty when they're not being told what to do. And I mean, others just struggle to find the time to fit it in, especially if they're a 9-to-5er and they've got a family and that type of thing. What tips can you give to someone who may be struggling with their study?
Yeah, I tell a lot of people to study at night who have jobs and kids and stuff like that. Like if you can put an hour aside at night or on the weekends. A lot of people like to sleep in on the weekend. For me, sometimes I'm just exhausted, but sometimes I like to really catch up on emails on a lot of projects that I'm working on and wake up at like 6 a.m. on a Saturday before everybody else wakes up. And I have like 2, 3, 4 hours to myself. On the same token, some people say, oh, Tim, you're always saying, look, study hard, work hard, all this stuff. Like, when does it ever end? And it never really ends. It's a constant challenge, but I do think that you can, tune out a lot of the noise. There's a lot of people who claim to be very knowledgeable in the market, especially 7 years into a bull market right now. And I think you can cut through a lot of that and just ask by 2 questions, like, what is your track record? Show me your trades. And who are your most successful students? So while you think like you have to study from everybody, you can really weed out a lot of junk just by asking those questions. If somebody does not have, millionaire students, or maybe not even millionaire students, but somebody who's made several $100,000 and they show their full name, not like in this industry, we have a lot of fake testimonials where you see financial websites and gurus saying, oh, Andrew C. made $3,000 today. And you're like, okay, what's Andrew C.'s real name? Give me his email address. Show me him on Facebook. That's why I tell my students full names. My students also teach on the webinars. So you can really cut through the BS with transparency. And that's why, I know it doesn't make me the most popular character in the world where I'm always preaching privacy or transparency over privacy. But I do think that in a world where there's so much noise and so many people claiming to know the secret of how to get rich, you have to really focus on people who actually have, a solid track record of doing so, and not just for themselves, but for other people.
Yeah, 100%. And I like how you mentioned in there, getting up early on a Saturday. I think that's a really great point. And I mean, that's something I often do. And it's a great time to play catch up, like you mentioned. Just to go one step further on this, how can someone get the most out of their dedicated study time? So let's say they're doing 1 hour every night. That's their time they've set aside. What are some of the important things they should be focusing on during that time to be as productive as possible?
Yeah, that's a really good question. For me, a lot of the time people want hot picks and they just want whatever's hot right now. And I'm always trying to say, I can't wait for there to be a bear market. I wish that it was a slow time right now so that people would not be trained to want hot picks, and instead they would be trained to want to look through history to find strategies that have worked in the past, and then they can, kind of adapt those strategies and find strategies that are working in the present and maybe in the future. But that's a tall task, to order. Most people just want what's hot right now. So I understand that. I understand the addiction. And if you want to really focus on what's hot right now and you want to get the most out of your studying, you need to be rewarded right now. Because again, what I've learned as a teacher, it comes down to, time spent studying and watching videos and preparation, and then you want to be rewarded. So it's tough for me to say, go back and look at history and see this, strategy that worked from 2008 to 2012. It doesn't work now, but it'd still be good for you to learn. That's nice, but for most people, it's just not going to work. They're going to get turned off because they're going to look at the past, and it's like studying, like the Roman Empire. For me, I love history. I love learning about what Napoleon did wrong and, the Romans and the Vatican Empire and all that stuff. But most people don't. So I would highly, highly encourage anybody to study what is working right now, what strategies are working, what sectors are hot right now, or what, if you're a short seller, what stocks are the worst, what are the worst performers, what can we learn about all these exposés with like Citron research, like study everything there is, about Valiant Pharmaceuticals, VRX, which has been the hottest topic recently. How is that different from Herbalife, which was another hot topic over, whether they were a scam or not? And that way you can look at what is actually happening right now and be rewarded by seeing the stock move the very next day. And, maybe in time you can get mature enough and wealthy enough where you can say, you know what, I've made some money. Now it's time for me to look at past strategies and past history. But if you focus on the now, I think that really helps your motivation to study.
No doubt. Okay, Tim. So can you give us an idea on how much time you devoted to studying when you were starting out?
I'm kind of crazy. And I think that a lot of my success is due to that. I started senior year of high school. I ignored friends. I was a tennis player, but I was injured, so I couldn't really go out. I had Tommy John surgery, so I had casts on both arms. So I'm like walking around like RoboCop. And, I spent every waking hour. And right now I spend pretty much every waking hour, just teaching. It's not so much studying for me anymore because I have my patterns pretty much refined after 15 or 16 years of trading. But you got to want it. You got to be dedicated and you have to be willing to sacrifice. Every now and then on a Saturday or Sunday, I post a tweet or something on Instagram and I say, you have a choice. You can either go out tonight with your friends and family, hang out and, take it easy, go watch a movie or something like that. Or, you can really, take your studying and take your education seriously and make sacrifices. And that's the decision that you're going to have to make. A lot of people aren't willing to make the sacrifices in order to study. I'm not saying you necessarily have to study every waking hour, but every few hours when you get a chance, if you get some free time, stop watching TV, stop going out, stop playing video games. You need to sacrifice your entertainment and try and, change your life.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So you often link the amount of misinformation that's out there to your motivation for teaching. Could you share an example of this so younger traders have an idea of what to be aware of?
Sure, yeah. What really got me into teaching, I was on this TV show Wall Street Warriors a few years ago, and I started getting 20, 50, 100 emails a day just from people saying that short selling penny stocks was illegal. And I was like, you got to be kidding me. Like, it's not illegal. This is what I've been doing. That's how I made not my first million, but my second million. And it just, my blood boiled every single time. I have some anger issues if you've ever listened to any of my webinars. And I really just got angry by people saying that, this tactic was illegal when in fact it was the result of brokers who can't find shares to short. They didn't want to seem incompetent. They didn't want to seem like a crappy broker that they were. So they would just lie to their customers, and their customers would think that, what I was doing actually was illegal. So be very careful with what your broker tells you. Every broker just wants commissions. Brokers are whores, and that is all they want. They are not your friends. They're not your family. It's not a long-term relationship. They just want commissions, and they will say and do anything they can to get those commissions from you. A lot of brokers don't like me because I call them out. And, most importantly, I tell people you don't need to trade every day. I think the big problem is that people do overtrade. They think that they have to make $25, $50, $100, $200 every single day. And they think that that's how their money works for them, and they turn into scalpers, and they make these small amounts every single day, or every few days, and then they lose sometimes, and then one or two times, because they're using such a large part of their account, or sometimes they're using leverage in the scalper mentality, and they lose 50, 75, sometimes 100% of their account on one or two trades. And I've seen that happen too many times. And the brokers don't care, because the brokers have been getting commissions from you every single day. So you have to fight that addiction to trade every single day. Whether the broker tells you trading is good, or, I know it seems like if you go by a day and you're not trading, your money is just sitting in the account. It's not working for you. Sometimes the best thing you can do is just to sit on your hands. Sometimes the best trade is no trade. If you look at my gains and my top students' gains, we don't make that much every single day. We sometimes just make a lot when there's a perfect play, when there's a perfect pump and dump to short, or when there's a perfect earnings play that just keeps running. If you look at Mark Crook, he's one of my students. He's up nearly $500,000 in the past few years. He makes 80% of his profits from 6% of his trades. And a lot of my top students have similar ratios. And I think that you have to really think about that. And you say, wait a minute, if the vast majority of my profits are coming from so few trades, why am I trading every day? Why am I feeling the need to, make a few $100s and try and feel good about this? Sometimes I say to my students who have trading problems, you should just watch the market all day. I'm not saying close your laptop, turn off your computers, and not watch the market. I'm saying test yourself. Try and watch the market all day and try not to trade. And if you can do that 1, 2, 3 days in a row, you will have beaten the addiction, or, you'll be on the way to beating the addiction, because, trading can be addictive. You want those profits to validate your time spent. You want to feel better. If you can make $5,000 in a few minutes, you feel better than everybody else who tries for a month. But you really have to control your need for profits. You have to, tame the beast. And, whether brokers tell you to trade more, or other people to trade more, or, even your addiction is telling you to trade more, that is not the successful path to big money. Scalping does not work. I know sometimes I make 2, 3, 4, 5, 10 cents a share on a trade. That's when a trade doesn't go my way and I exit just safely. I never aim to make so little on a trade. So I really want people to focus on better trades, lesser trades. And yes, shorting penny stocks is perfectly legal, and it's actually very logical, because most penny stocks are absolute scams. So fight the addiction and fight the misinformation.
Yeah, that's excellent, and some great advice there for people who have a problem with over trading. I think that's a really important point that you shared there. Besides brokers kind of being at the root of a lot of misinformation, is there anything else that's kind of obvious, or that upsets you, annoys you, makes your blood boil? Just misleading information that's out there.
That's like an hour-long or maybe a day-long conversation. But some of the biggest things that I see in chat rooms and on social media, people are posting their profits at the end of the day, and they claim to be profitable. Here's a news flash: 90 to 95% of traders lose money. I know CNBC doesn't want you to say that. I know brokers don't want to admit it, but that's the truth. If you look at academic study after academic study, there's a reason why CNBC's ratings are at all-time lows. Their viewers don't make money. Most people in chat rooms, on message boards, on social media are full of shit. And Profitly, my little, venture on trying to be transparent, is not taking off very much, because one by one, traders have excuses why they shouldn't be transparent. And I've seen it all before. I've heard it all before. I've heard every excuse. There was a company called Covestor, of which I was the number one ranked trader out of 60,000 when they were very popular. And, Covestor came around right when I got started teaching in 2007. Fantastic business idea where they could validate traders and investors' performance by tapping into their brokerage accounts, and you could see, who was doing good and who wasn't. And when it first started in 2006, 2007, all these different financial bloggers had the little Covestor badge on their websites, and it was like Covestor verified. And, I wasn't number one to start. I had to show my track record. When I first got started teaching, I went back to my 12,000. But over 3 years, I turned that 12,000 into 230,000, and I became number one ranked. And it wasn't because I was that much better than other people. It was just because so many bloggers took the badge off their website because their blog was meant to show their credibility and their expertise, but Covester ruined that transparency and ruined their credibility by showing, guess what? They don't make any money. They underperform against the markets. So, when you're seeing people who post and they think that they're almighty and they're also profitable, you need to see all trades. I'm very proud to show every single one of my trades. In real time, it's a bitch. Sometimes I look like a complete idiot when I take the wrong trade, but transparency is so huge. And in this trading community, a lot of people get burned by believing the wrong people. And a lot of people should just be fully transparent. It would make this trading industry so much bigger and greater. It would benefit all of us. But, I know that's just a dream. So all I can do is warn people. Again, it goes back, if you're looking for your teacher, ask 2 questions. What is your track record? Show me all your trades. Ideally, it's several years, or ideally even, several decades. And show me your millionaire students. I think you also had my friend Paul Scolardi, aka Superman, on, and he shows all of his trades. He just had his first millionaire student the other day. So, those of us who work our asses off, we get to show the results, of our labor, and it's a very proud thing. When you were asking me earlier, what's so important about $1 million? I mean, just when a student crosses $1 million and they knew nothing a few years ago, or they had very little to their name, it's an incredibly rewarding experience for me. When my students make $10,000 in a day versus me making $10,000 a day, I feel nothing anymore. I'm totally numb when I personally make that money. But when a student makes $10,000 for the first time, and they send me like this heartfelt email, or when I see them at my Vegas conference, and literally, I don't know, maybe a dozen or 2 dozen students were crying in front of me. And I have it all on video. I got to get it edited. It's just an amazing experience. Trading can change your life if you have, the right idea, how it's going to be a lot of hard work, not thinking that, you're going to make a lot of money really quickly. And ideally, you need a mentor. You can learn everything that I've learned over 15 or 20 years, but it takes too damn long to learn on your own. I wish I had a mentor, and I just didn't. And that's bad for me and good for you guys. It's good for people who are starting to learn right now. We're in a very special time where, video lessons, live webinars, this stuff is changing the educational landscape, where you can literally follow, exactly what's going on in real time with a stock and learn from an expert rather than just a bullshit penny stock promoter.
Yeah, great points. I like it when you go on a tangent there.
Yeah, this is my life's work, so I literally do this 16, 17 hours a day, and it's not just about the money. I'm so proud of my charity now having raised nearly $1 million in a few months. And, I just freaking love where my business is heading. So I'm very, you caught me at a very proud moment in my life.
No, that's really cool. And I haven't had Paul on the show yet.
Oh, you need to have him. He's amazing.
I've been hassling him about it, but I'm just getting some pushback. I have had Matty Owens on the show, though.
Yeah.
Triforce trader.
That was his millionaire student. I'm going to talk to Paul. I'm going to get him on the show because that would be a great episode. I want to hear.
Okay, I'll leave it in your hands.
There's no pushback. You need to chat with traders right now. I'm going to text him right when we're done. That's bullshit.
Awesome. So I'll leave that in your capable hands. But yeah, Matty Owens, Triforce trader, he was on episode 7. So really cool interview and awesome guy. So if anyone wants to check that out, episode 7. Now, I'm not sure if I may have asked you this last time, but from interacting with the traders you teach, what are the top 2 or 3 things that often hold them back from being successful and gaining consistency?
I think that a lot of people don't realize that studying is something that never ends. Some people make some money and then they're like, oh, I've made some money. I've learned some lessons. That's cool. I'm going to go chill with my family for like 3 months. I'll come back to the market. And, sometimes they do, sometimes they don't. Sometimes they come back to a market that's very different and they're all confused. I'm not saying that you have to trade every day. In fact, I'm saying you shouldn't. But I really, really encourage people to study even for 15 minutes a day, just to see what stocks are moving, what sectors are moving, what social media is talking about. If you follow several millionaire traders, which I think that you should, to see what's working and what they're having trouble with. People like Tim Grittani and Matt Owens, they, even though they're millionaires now, they're very open about their losses. Tim Grittani was just tweeting about some of the troubles he's had in the past few weeks since coming back from getting married. And, I wish him a congratulations. His wife is awesome. You can't just leave for a little bit. And I also have some people who say, I'm gonna make some money first in the market and then I'm gonna study. And I'm like, wait, how does that work? And they're like, well, I'm just gonna trade on my own, make some money, and then once I have enough money, then I'll really fully commit. They feel like, okay, I have a $3,000 or a $5,000 account right now. I'm gonna turn that into like 10 or 20,000. That way, I have more money, and then I can really commit to my education. And that's not how it works. You can't become a doctor without studying. You can't just be like, oh, I'm going to operate on this patient and we'll see how it goes, and then I'll get my medical degree. Trading is very similar, where you need to put in the time. It's very front end loaded with study and education and learning about which catalysts and patterns work before you ever risk a dime of your money. And that education is constant. And I know I'm not making this sound like a fun profession. You're like, God, what about all these trips? Like, even though I travel, you're going to ask my fiance, much to her chagrin, I still study every single day. I still look at opportunities every single day. Trading can be a great thing, but you can't just put it in a box that you want and wrap it up and make it this nice, tidy thing. Trading can be a gruel. It's a challenge. It's a journey. And it's a beautiful journey, and, it never ends, and you can get better at controlling your addiction and controlling your discipline and, cutting losses quicker and being more right than wrong over time. But, 15, 16 years into my career, I still make dumbass mistakes. I still screw up, and I still sometimes get the story and the pattern entirely wrong. So this is something that should never be looked at something where you can totally master it and then just leave it. I really want to emphasize that point where, sometimes I only work an hour a day, and I don't know of any other industry where you don't need like a college degree or master's degree and you can make 6 or 7 figures in a year and only, work an hour or two a day, but you still have to put in some time. Even on weekends, I'm still reading the news. I'm seeing what's hot. I'm thinking about what potential plays there are. If there's, God forbid, like some terrorism, what are the security plays that might be affected? If there's some salmonella poisoning, then, there's a lot of food, health, and safety companies that might spike. So I'm always in the trader mentality, and I don't know how to turn that off. And I really caution people from ever turning that off. You have to be opportunistic. Sometimes, I've made some of my biggest trades out of the blue, where I just, I see a trend and I jump on it and I'm first or, second to the trend. I don't actually want to be first. I want the stocks to be spiking a little first to prove that I'm on the right track. But I'm very early in the trend, whether it's marijuana stocks or Ebola stocks or something like that. And thinking that way nonstop might be a little annoying, but keeping that idea that there's opportunity around the corner every single day. And you kind of have to be like a sniper, and you take your shots when you're ready, aim small, miss small. I think that keeps you in a good place.
Yes, I mean, it's fair to say that you just want to pretty much immerse yourself in the market as much as possible, yeah?
But you also don't want to burn out, Aaron. So it's a tricky thing. I'm not saying to study 18 hours a day and being like, where's the next play? Where's the next play? I need to hunt. That's why I say, like a sniper, you wait for your enemy, you wait for your prey, and you take your shot. But sometimes, you're waiting for a very long time. So I don't want people to burn out.
Absolutely. That's really important. So one of the things I'd like to ask you about is confidence, okay? So confidence in your trading. Now, you cop a lot of slack online, right? Everyone knows that, but you handle it very well. And I mean, it doesn't seem to bother you. So I think you're going to give some good insight to my next question here, and that is, when you're starting out as a trader and you haven't had any major breakthroughs yet, some of your friends and even some of your family might not believe in what you're doing and may try to discourage you from even getting into trading. What advice would you give to someone who has those negative influences in their life?
Yeah, I get that a lot. A lot of people like Instagram me or tweet me, and they're like, yeah, my mom, my dad, my friends, they all say, this is a scam. Like I shouldn't do this. And what I tell them is that this is education. Like, is school a scam? Is learning a scam? Is intelligence a scam? I know that the vast majority of traders lose money. Okay, let's be very frank about that. I understand that not every single one of my students is going to be a millionaire, but who's to say that it's not you? Just because your parents say that you can't do something, does that mean that they're right? If you have the talent, if you have the dedication, and most importantly, if you have the determination, you can be my next millionaire. And that applies to anybody, whether you're in Asia, Europe, North America, whether you're, 21, 25, 40. I have some students who are 70. I had one guy at my Vegas conference. He looked like, the character Blue in the movie Old School. And he was like on his last legs, but he was loving trading. He was like telling me the story how he made 40 grand the other day. And there was just a great look in his eyes. So it doesn't matter your age. It doesn't matter your background. It doesn't matter whether you trade penny stocks like me or Forex or options. There's money to be made in every single sector. And, it's just amazing that there's so much hate. And it's because of people who make promises, like people who say, I promise I will make you a millionaire. Or there's, these scammers. I see these Google ads where they're like, I win 99% of the time. And that's bullshit. And you really have to watch out for bullshit. But if you find someone who's honest, and, this goes back to transparency, showing every trade, showing their track record, showing their losses, showing their successful students, showing their unsuccessful students. A lot of the time I highlight what some of my students who break the rules and what happens to them. So just don't go in with the wrong expectations. This is an industry just like any other. There will be some people who rise to the top. Picture this like American Idol or, Major League Baseball. There's a lot of people who want to go to the big show and the big dance. But unless you work your ass off, you're not going to get there. But the one good thing I would say, or the best thing I would say about trading, is that unlike baseball or singing or, if you want to be a doctor or a lawyer, you don't need any fancy schooling. You don't need some, genetics that are amazing where you're some kind of freak athlete. You don't need to have an amazing voice or that you somehow inherited from like your mom or something. Trading can reward the most mediocre individuals. And I say that lovingly. Like I think I myself as a rather mediocre individual. I suck at math. I know that I'm not that smart. I know my limitations, but because I've worked so hard and because I wanted it so hard, I became a millionaire trader and I saw the opportunities. I made my first million buying penny stock breakouts. I didn't even know about short selling, but when the market adapted in 2000, 2001, 2002, 2002, I adapted and I began short selling. So I haven't had just one successful strategy. I have many successful strategies and lots of failed strategies too. But if you keep adapting, if you keep staying determined, if you keep proving, these doubters and your family and your friends wrong and saying, look, I'm not just following hot picks. Like trading is a very intellectual process. Like this is a beautiful challenge. I'm training my brain to look at opportunities. I'm trying to think differently than the crowd. I'm trying to be part of the few percent of people that actually make it big in trading. And you can. And that is, what I would tell people who doubt on this. It's not just about following hot picks. I mean, I trade penny stocks. This is the most hated niche in all of finance. But because I explain, even like to Larry King, where I say, look, actually, Larry, I short sell. I mainly bet against these scams. And he's like, wait a minute. If you watch the interview, he's like, wait a minute, you're rooting against the people that you're investing in? And I'm like, yes, I understand that most penny stocks are scams. So just try to be true to your niche, whatever it is. Try to be true with, the realistic opportunities where most people are going to lose. You're probably going to lose at first. So you need to cut losses quickly. I don't want you to lose and lose everything and then your friends and family are right. So it's good to have doubters. It's good to have haters because you need to prove them wrong. And you need to work your ass off to do what you must to prove them wrong. And that involves studying, being realistic, and staying, determined all along. Every single great actor, every single great athlete has had somebody doubt them in the past, okay? Meryl Streep just had a great YouTube video where she didn't get a part because she was, quote, too ugly when she was young. And now Meryl Streep is one of the most recognized, awarded actresses of all time. So don't ever think that you're going to go through something and have zero haters or zero doubters. Use those haters, use those doubters as inspiration to work harder and to succeed. Remember, the best revenge is massive success.
Yeah, I love that quote. That's a good one. So, I mean, in life, you come across as a very confident person. And I'm curious to know, how do you manage your confidence levels when engaging in the market? Does this help you, or do you think it kind of has some sort of a, what's the right word, disadvantage to some extent?
Well, so here's the interesting thing. So if you actually see me trading, I'm very cowardly. I might be confident outside of the stock market. I'm confident in interviews like this because I know what I'm doing and what I'm teaching is right and useful and helpful. But when I'm trading, it's kind of funny to see people's reaction to my trades, like where, I alert in real time, and sometimes I cut losses. Sometimes I get out with like a 5 cent a share gain. And I'm like, I'm scared. I'm a coward. In my DVDs, I even have a voice where I say I'm a castrated choir boy. And I'm like, I trade like a castrated choir boy. And I talk like that. So, there's a very different way that I am in life and in trading. And I can't encourage anybody to be aggressive in trading. Gunslingers, I see them all the time. Sometimes they make money, sometimes they lose money, but they are out of the game very quickly because one way or the other, they screw up. They bet too big, they bet it all, they use leverage, they think that they're going to be right. I was a philosophy major in college, and I think philosophy really helped me in understanding that the smartest man is the man who knows that he knows nothing. And that's a very, anti-business kind of approach. If you're in business school, if you're on Wall Street, you really can't admit defeat or mistakes or errors, because if you do, then, someone's just going to go to another banker or another broker who has the exact same high-priced suit and tie and, will take you out on some high-priced dinner and then try and rape you for commissions for life. That's how Wall Street works. But as a teacher, I get to show my losses. Some of my most popular blog posts and video lessons are, lessons from my biggest losses. What did I do wrong on this trade? Every time I have a big loss, what did I do wrong? This is my first year. And, this is November 2015. So I've been trading for 16 years. This is my first year without a big loss. And I fully credit social media and being a teacher because I don't want to look like an ass in front of my students. And so thinking that way, I actually respect my rules more. And I think that's the number one problem that people have. A lot of people know the rules. They know, cut losses quickly, don't bet at all, don't use leverage, don't be too over aggressive, never think that you're always going to be right. They know those rules. Sometimes they have it taped on their computer or their laptop, but they don't follow them because they don't have the community and they don't have, there's no consequences if they don't follow it. And that's, I think, why being transparent and looking like an ass so often, like I do, especially on reality TV shows, has helped my trading. And it's helped my confidence because now I understand that, I'm basically bulletproof in the trading world as long as I stick to my rules and cut losses quickly and exit trades and play so safe because I'm transparent. There's a whole group of traders that I've learned like to trade against me. And at first I was pissed off and I was like, oh God, this sucks, But then I realized, wait a minute, this is just a consequence of my success as a teacher. This is a consequence of me being transparent because they know, look, if we can all trade against Sykes and, force him to cut losses quickly, he will cut losses quickly. And they know how I trade because I'm very open about my trading strategy. So whenever I enter in a trade, I have to be damn sure that I'm right. Otherwise, this group of traders that trades against me will just pummel me. And that forces me to be a better trader. So what I tell people, pretend as if a group of traders is trading against you. Is your position secure enough to withstand that? If you're so right about a stock, it doesn't matter who is trading against you. The market will be in your favor. So for me, I have to be very, very choosy about my trades. I want them to A, be profitable, and B, be educational. I want to follow rules that I preach again and again in my video lessons and DVDs. So my teaching might look very successful from the outside as, a business, but for me, it has been my therapy and it's been my own teacher. My teaching has been my teacher, and that makes me a better trader. if that makes sense.
Yeah, 100%. Now, last time you were on, we spoke quite a bit about your strategy. One of the things I didn't get a chance to ask you about, which I'd like to ask you about now, and we'll just kind of skim over this because I've got a lot of questions to get through, and some of them are crowdsourced from listeners, so I really want to get to those. But
nice, bring it on. I got all night, buddy. Let's do it.
Awesome. So one of the things we didn't cover was the liquidity issues that often exist in penny stocks. Are there any pointers you can share with listeners that may help them to avoid getting stuck in situations where liquidity is very thin?
Yeah. There's a lot of penny stocks with great stories, and they claim to, this and that and just do amazing things. And what I've learned is that most penny stocks are full of crap. So I've learned to really tune out the stories and the press releases and focus on price action, patterns, and volume. So I really only want to play stocks that are spiking quite nicely. And I want to play stocks that have volume of, 200,000, 500,000, usually 1 million or two shares traded a day. Now, I am not 100% disciplined. Sometimes I fall for these press releases and I have to correct myself, and it's not pretty. But if I'm truly disciplined, I focus on price action and liquid stocks. I don't do very well, though, with stocks. Sometimes penny stocks trade, 10, 20, 50 million shares in a day. I do not do well with those because they are way, way, way too choppy for me. And because I'm such a coward trader, I cut losses quickly when the stock goes, against me. So I've learned what my sweet spot is, roughly 500,000 to, 2 million in daily trading volume.
Okay, and when you say 500,000 to 1 million in daily trading volume, is that on an average day, or is that when something's, moving?
It's on the day, because a lot of the stocks that I trade, sometimes they don't trade for months, and then they have good earnings or a good contract. So I'm usually interested, or a stock promotion. So I'm usually interested in the catalyst that is moving the stock right now. That's part of the problem why I had to actually get off Covestor. A lot of people don't realize it. Covestor turned into a company that did auto trading, like it would copy your trades for people who subscribe to your feed. But the problem was that they disallowed stocks that did not have a $50 million market cap. And a lot of the stocks that I trade have under 50 million. But even when a stock that I traded would go above 50 million in market cap, it was only because the stock was up 100 or 200% in the past day or two. And so Covestor looked at market cap over the past 3 months. So they would say, hey, their system would read 10 or $15 million market cap, and it wouldn't be up to date. And so my stocks are moving so fast. Most companies don't triple in valuation within 3 months. So that was a big problem with me and Covestor, and we had a falling out because my stocks simply just don't fit their metrics.
Okay, yeah, I mean, that makes sense. And just on a similar note, as you have grown as a trader, have you experienced any scalability issues with your strategy in the field of penny stocks? And if so, how have you had to adapt?
Big time. When I first turned 12,000 into 1.65 million, I thought that I could turn 1 million into 100 million. There's definitely limited scalability, especially when shorting pump and dumps. Now, part of the reason why I got into teaching, I just didn't think that my strategy was that scalable. It would be much easier for me to teach 1,000 students to make $1,000 each rather than for me to make $1 million on any one trade. But what I've learned, a few things. There is a hedge fund out there. It's called Anson Funds. I'm actually an investor. My friend Moez Kassam runs it, and he basically shorts penny stock scams and some larger scams. And they're at, I think, like 300 or 400 million in assets. And they returned like 25% last year for me, which I was very happy with, and nearly 10% this year. So I think there is greater scalability. I just don't know how to do it. I would love to get you to have Moez on. I don't know. Have you ever interviewed hedge fund managers, or are they not allowed to talk?
Yeah, I've interviewed a few guys who manage money. Yeah, feel free to make the intro. That'd be cool.
Cool. I would love to hear that too. I think that would be amazing.
Awesome.
So he found a way to make it more scalable. But for me, I never really, found the shares to short. And I'm kind of impatient. I have to recognize my own faults as a trader. As I was just telling on my trading challenge webinar, my 3 previous biggest days in the past few years, of several $70,000 profits and $100,000 profits, I did not capture even half of the profits had I held another hour. So it wasn't like my big profits were due to me being a perfect timer. It was me being so dead on that even when I captured half of the potential profits, it was still a huge day for me. So that's a lesson for me that I'm frankly just not a very good trader. So for me, or a very great trader, I've made 4.3 million now. Last year actually was my best year ever in trading. I made nearly $1 million, but I'm a far better teacher. And so every year I actually go back and trade with less. Last year when I made nearly $1 million, I started the year with 500,000. This year I started the year with 100,000 and I've made nearly $200,000. And next year I'm going to start with just $12,000 and I'm going to be under the pattern day trader rule. I'm going to trade with a very small account and, see if I can grow it exponentially like I have in the past. So for me, I have my own impatience and personality issues that prevent me from taking my trading to the next level. And, you have to know your limits. For some people, you want to try and become a better trader, but for whatever reason, it's preventing you. But the cool thing is that I kind of adapted to my own issues and became a teacher. And that's what I'm good for. But Moez Kassam of Anson Funds will be better to talk about scalability issues with penny stocks.
Awesome. Yeah, no, I look forward to that. And it's cool that you'll be starting out with 12 grand next year. That'll be interesting to follow along with.
Yeah.
Now, seeing as I've had you on in the past, I thought I'd put the word out to the listeners. So I put on Twitter to see what questions they had for you. So first question was from RayTrader10. And he asked, when do you sleep? So I think what he's trying to get at here is how do you find time to run multiple sites, education, continue to trade, and then live a life outside of that also? So I guess it kind of comes back to how do you avoid burnout, which you touched on a little bit earlier.
I solved that problem by eating a lot. I've gained 50 pounds in the past 2 years. Not my proudest moment. I'm actually 25 pounds off my highs now in the past few weeks since I took health a little more seriously. It got a little out of control for a while. It was a bull market in my weight and it just kept making new highs. But it's tough. I'm very passionate about my teachings. I'm passionate about my travels and, I have a beautiful fiance now and I have a little cute Pomeranian dog too, just to round it all out. So balancing has definitely been tough, and I definitely probably put too much with focus on my business and my students, and I need to do a better job with work-life balance. But I really get pumped up when I have these millionaire students, and it's tough for me to pull back because I see the mistakes that people are making, and by making a video lesson every single day lately, as opposed to before I was making a video lesson like every 2 or 3 days in the past. And one thing that has helped me lately is that I used to give 2 or 3 webinars a week. And now I only give one because part of my trading challenge, which is, for my most dedicated students, thankfully my successful students have come in to help me out. So Tim Grattani, who you had on, Michael Good, my first millionaire student, and Mark Crook, who's up roughly 500,000. They now also give weekly webinars to my trading challenge students. So they've helped me out tremendously. And now we have nearly 1,000 people in the chat room. And, I have several other chat room moderators. So the successful students are coming in to help me out. And it's kind of a nice circle where they want to give back to the community that's helped them. And that's going to be huge going forward. So it's even more inspiration and motivation for me to create successful students because I'm basically just breeding future helpers to reduce my workload. So that's the plan there. And I don't sleep. I'm trying to sleep more, but I definitely could do better.
Very cool. Now, at Teo P7, he asks, what's the minimum to open an account? I think this is a good question because a lot of people are attracted to penny stocks because they have limited capital and, it's kind of the field that they think gives them most buying power. So what would you suggest is the minimum to start with?
Right now I use, and to start 2016, I use basically only E-Trade and Interactive Brokers. Interactive brokers, the minimum is 10,000, but there's a loophole. Like if you're under 26 years old, you can open an account with 3,000. E-Trade, I believe the minimum is 500 to open an account, but in order to short sell, you need 2,000, which is an SEC rule. I would say anywhere from 2 to 5,000 would be good to start. People ask me, hey, I have $200. I would be like, come on, save up. Like, go take out the trash for your neighbor like every day. Like, you got to be able to save up a few $100s. If you can't do that, then you're probably not going to make it as a trader anyways. The good thing is that even before you start trading, you really should be studying. I have over 500 free videos on YouTube. So while you are saving, watch my free YouTube videos and start getting in the mindset of what are the plays that I'm actually, trading long and short. What is this weird, penny stock strategy where you don't trade every day and you don't want to scalp stocks like so many traders do. So you need to learn before you profit. As Tim Grittani shows, Tim Grittani has the single best track record, I think, of any trader that I know of, turning a few thousand into now 2.8 million in 4 years. And he lost rather consistently for the first 6 months. He just kept losses small. So when you first start, don't you dare expect to have any profits. Focus on getting educated, focus on learning the best practices, and focus on not blowing up. That would be a better question.
Yeah, excellent advice there. And he also asked, what's the best introductory book to penny stocks? So if someone likes to learn or, finds that they learn best by reading, what's one penny stock book you'd suggest to them?
I don't think there's any. My book, An American Hedge Fund, talks about my journey, but it's not very technical. We're actually publishing a book by one of my students, Jamil, and he basically, it was kind of a funny email. He's like, Tim, I love your teachings, but you're so fucking disorganized. I'm an engineer. I had to organize it. And he sent me this PDF basically organizing all my DVDs, all my video lessons into a book. And it's actually very organized. So that book, I don't know what it's going to be called, but we'll be publishing it. And it's not talking about my journey. It's just a technical look at penny stocks and patterns. And I think it's going to be amazing. And it's kind of funny that it took one of my students to organize my thoughts to pull it off. But that'll be coming out in the next few months.
Oh, nice one. That is quite funny.
Yeah.
Now, we've got another question here, and that's from Ghost Trade. So that's Ghost with a 0 and 1 T. How did you learn to read filings and interpret press releases? And where should a new trader start with this type of thing?
Yeah, so my first millionaire student, Michael Good, and I actually partnered on a DVD called Learn How to Read SEC Filings. So I think it's a 6-hour DVD. Every single person who watches it says it's the single most boring DVD they've ever seen because it's so dry, talking about all the different SEC filings and the legal stuff. But they also say that it's very useful. So it's dual purpose. It's like natural NyQuil. So you don't need to take NyQuil or Advil PM. You just watch this DVD, for a half hour every night before you go to bed, and you will sleep like a baby. And ideally, you'll be dreaming about these boring financial statements. But I learned on my own, the same way kind of Michael Good did. Michael Good have you had Michael Good on yet?
I haven't, no.
Oh my God, Aaron, I have so many people for you. Michael Good is up to 1.5 million in profits every trade shown. He just had a nice $25,000 profit the other day, shorting the pump and dump, ticker AREN. But he's fascinating. He's so methodical and scientific, and he reads through these SEC filings the way that I used to. I really don't even read them anymore because the community on Profitly has grown so much where basically either Tim Grittani or Michael Good or Mark Crook is doing the due diligence. And because, I know that how crazy they are with their work ethic, they basically go through all of these filings and they pick out the red flags. But you basically have to see, every single press release is just media hype. It's meant to lure in investors, lure in, naive reporters into focusing on a penny stock company's product instead of the stock and the nasty financings and usually pretty messed up share structures that they have. And then the SEC filings, companies are required to talk about all that. So they don't talk so much about the hype of the product, whatever it is. They talk about, how 5 million shares were sold at a third of a penny to an offshore Cayman Islands hedge fund, like really weird, exotic, toxic financings. And you have to really be careful. But that DVD that I mentioned is great. And, I have so many video lessons where I talk about, what is wrong. I actually have a free video on YouTube. I'll give the link to you, Aaron, which is called An Ideal Trade by Tim Sykes, and it has nearly 500,000 views on YouTube. And I talk about all these red flags in an SEC filing and contrast that to all their positive press releases. And you see me, it actually cracked, the pump and dump cracked while I was giving a webinar, and I made 30% in 30 minutes. And then it cracked another 20%. So I took profits too soon, as I usually do. But, shorting pump and dumps where there's a huge divergence between what is in the press releases and in the legal filings, that's when you're onto something.
Okay, sure. Yeah, we'll link to the DVD you mentioned in the show notes, and also link to that video you mentioned there as well. So if anyone wants to check that out, you can get links at chatwithtraders.com /47. This will be episode 47. So we've got one more listener question, and that's from Sao151, and he asks, how much has the penny stock game changed since you started teaching?
Yeah, great question. I wanted it to change more. I kind of got into teaching. A, I hated the misinformation, but B, these patterns and these opportunities have kind of taken my life away from me. You asked when I crossed $1 million. I was actually on semester at sea, and I was loving life because you go around in the world on a cruise ship, and we were in Asia, so I wasn't trading much. And I had 2 girlfriends. I was popular. I had never had any of this stuff because I was always trading my, senior year of high school and the first few years of college. And because I wasn't trading, I actually had a life on this boat, and it was a pretty good life. But then as the ship passed around a little more into Africa and then Brazil and Cuba, I really stopped living life as much and focused on trading. And by the end of the cruise, I was up roughly $250,000 using their satellite internet. And I had no girlfriend by the end of it and very few friends because I was on the computer all day long. So you kind of have to choose. And when I got into teaching, I really kind of hoped that if I taught these patterns well enough, I could burst them. I could, teach so many people that, the opportunities weren't there anymore. But unfortunately, or fortunately, depending on how you look at it, 7 years into teaching, I have taught a lot of people. I do have several millionaire students and a lot of students who are making 6 figures, but the patterns are the exact fucking same. And they haunt my life to this day. And I can't get away from them. On semester at sea, I had an Indian homestay. I was going to stay with this family in India. It was going to be incredible. And it was going to be so beautiful. And I turned that down in order to trade. And I kind of regret it now, but I made like 12 grand on the trade. I missed my college graduation because of a trade. I missed birthday parties. A lot of my friends would say I'm the biggest asshole in the world for missing so much of their life. So trading has been a blessing and a curse for me. It's a good blessing, because I've lived a rather very blessed life. But at the same time, I have not done a good job at controlling it and knowing when to say when. And, probably that's the reason for my success as a trader and a teacher. But I kind of got into teaching hoping to end it all. And it's just weird that I feel like it's kind of like oil. Like, if you drop oil on the table and you see all these little bubbles and you try and smush the bubbles with your finger, it just creates new bubbles. And that's what's kind of happened with penny stocks where, everybody kind of knows my breakout levels or where I want to short, but it really hasn't changed the game. The patterns still work like kind of crazy, like eerily to a T, the same. Either, not enough people are shorting or buying, or, there's a ton of volume, or there's just a ton more plays because we've been in this 7-year bull market pretty much ever since I got started teaching. I don't know what the reasons are, but I really do hope for a bear market so that there's less plays and I can live a little more. I just got back from the Victoria's Secret fashion show, which was an awesome experience. So I'm still living a little bit, but I do wish that there were fewer plays, and I I hope that more people learn these patterns to make it happen.
Okay. So just to summarize, you would say that the landscape of the penny stock market structure hasn't really changed too much since you began teaching?
Correct. There's less penny stock promoters, but now, websites like Seeking Alpha, and, there's a million little wannabe financial websites, and they try and, push up stocks in chat rooms. You have all these traders colluding and trading together. So they're basically, promoters, for lack of a better term. So there's always something moving, and I'm just playing the volatility.
Okay, cool. So let me ask you one last question, and that's, what's one area of your trading you'd like to improve moving forward from here?
Yeah, so I'm really excited to go back to trading with just 12,000 next year. Trading with a bigger account, I get a little tempted to exit trades early where, like just for today, for example, my goal was on HCKT, which is actually an $18 stock, but it's an earnings winner and it kind of trades like a penny stock. And I dip bought it. My goal was to make 50 cents a share. But within an hour or two, I was up like 25 cents a share and I took it and I made roughly $1,000. And, with a smaller account, I would have more patience. As it turned out, HCKT did go up 50 cents a share by the end of the day. So I should have had more patience, but taking $1,000 is tough for me in a bad market as today was. So I think with the smaller account, I'm going to have more patience and I'm going to be more disciplined to let the trade, really play out. So I'm looking forward to that. But impatience, it's good for cutting losses, but it's definitely bad for me, cutting gains too short.
All right, good one. So Tim, before we bring this to a close, share with us a little bit about your charity and what causes you're supporting.
Yeah, so this is something new that was just created in the past year. I've always done like a little charity. I've been doing Make-A-Wish in some capacity or another for a decade since I dealt with Make-A-Wish New Orleans. I went to school down in Tulane. But now I actually have my own official charity, the Timothy Sykes Foundation. It's a 501c3 foundation, so it's real. And my latest DVD, How to Make Millions, which is 35 hours, all the proceeds go to charity, and I'm actually matching the donations. So we've raised nearly $1 million from that, and I'm going to match it with $1 million of my own. So I'm going to fulfill my goal of raising $2 million in 2015 for charity. Very proud of that. And, we've done a few charity I take it one at a time, like 20,000 here, 10,000, 5,000, 20,000. So one of the 20,000s, Make-A-Wish, it was an incredible story and I want to share it with you. It doesn't really go viral on the internet, but it was one of the most beautiful and rewarding experiences of my life. I donated $20,000 to Make-A-Wish, to help this child, Ewan. He can't move, he can't, talk. And it's been a struggle for his family to communicate with him. And, this new technology basically tracks movements in his eyes. And he can move his eyes. So if he moves it in a certain pattern, it basically learns his language and he can communicate with his mom. So he was testing out the new device. He sits in this chair and looks at this TV screen, which has sensors, which tracks his eyes. And he was moving his eyes and, trying out different words. And after like 30 minutes, he got the words right. And it said in like an electronic voice, "Hello, mother." And his mom cried. My mom was there. She was crying. I was crying. My dad was there. And it was an incredible experience. And that was just one of the Make-A-Wishes. We have several others. We also partner with Boys and Girls Club, the Lord's Place in Florida. And actually 2 weeks from now, we're going to be partnering with PATH, which is a charity out here in LA, where my fiance lives. And we're going to be moving these homeless people into a house for the first time. And then the next day I'm partnering with Soup Kitchen, and we're going to feed a lot of these homeless people just some good, hot food. And I love it, and this is totally a new game for me. I've been to over 100 countries. I have all the crazy cars and, big ass houses, and I've lived a pretty solid life, but nothing really competes with this charity. Giving back. I'm ashamed that I didn't do it earlier, but I guess it's better late than never. And, I'm going to blow up this charity. It's going to be one of my main focuses going forward. So I'm excited.
Awesome. Yeah, really good work, man. That's incredible. So, Tim, before you go, do you want to share with listeners where they can go to find out more about you and where they can connect with you?
Yeah, TimothySykes.com. I have 8,000 blog posts. If you go to my YouTube channel, I think it's TimSykes.com. We have 500 plus free videos. I'm on Twitter, Instagram, Facebook, all under Timothy Sykes. And I try and post stuff every day, either pictures or video lessons or blog posts. I write for Entrepreneur and Inc. and Huffington Post now. So I'm always just trying to give tips. And I really just want to teach more. This is my passion in life, and I love it. I love your show, Chat with Traders, because you cut through the BS and you see that there's a lot of amazing individuals in this industry. We're still nowhere near mainstream like we should be. But I think with the internet and transparency playing a bigger role in the future, I think, we have a shot. We're so much better than this bullshit fantasy sports and stuff like that people think they should focus on. This is much more a game of skill. And I think the odds of you maybe not even necessarily making $1 million, but making, enough money, like an extra $500 or an extra $5,000, just getting a little extra by using your mind. I think that's a very good thing instead of, just partying or watching TV or playing video games where you're spending money and you're wasting your life. I mean, we have one life. So I just want to try and show people how to maximize it.
Totally agree. And all those links which you just mentioned there, if listeners want to find them all in one place, chatwithtraders.com/47, they'll all be there in the show notes. Now, Tim, awesome to speak with you again. Thank you very much for doing this. Let's stay in touch and talk again soon.
Yeah, my pleasure. Keep up the great work, man.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
Hey, what's up everyone? Thanks for tuning in to the Chat with Traders podcast. I'm thrilled to have you listening. And this week on the show, I interviewed Linda Raschke. Linda has been an active trader since 1981 when she started out on the floor of the Pacific Coast Stock Exchange as an options market maker. In 1992, Jack Schwager interviewed Linda for his second installment of the Market Wizards series, The New Market Wizards. And since then, Linda has traded for several hedge funds, and in 2002, she began one of her own, which has been ranked 17th out of 4,500 hedge funds for best 5-year performance by Barclays Hedge. During this interview, we covered some great topics, for example, adapting to environment changes, using models to study price behavior, and the part I really enjoyed was Linda's advice to young traders towards the end. So please make sure you pay close attention to this part. I feel like I should probably forewarn you just a little bit. The sound quality is not ideal, but I hope you can push past this because I'm sure you'll learn something by listening to a woman who has been trading for over 35 years. All right, guys, I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and here is my guest for episode 48, Linda Raschke. Hey, Linda, welcome to the podcast. How are you?
Hi, Aaron. Fine, thank you.
Awesome. Good to hear. And let me say, first of all, it's such a huge honor to be speaking with you. Thank you very much for taking the time to do this.
You're welcome.
I mean, I for sure appreciate it, and I've no doubt listeners will gain a lot from hearing about your experiences, your insights, your views on trading, and any other topic we may get onto during our discussion here. But let's start this off with getting some context and to help us understand where you've come from. So can you share with us how you first got started trading and what were some of your early experiences with markets?
I started on the trading floor back in 1981-82 in the equity options. It was a bit random about how I got down onto the floor. I worked across the street from the exchange and befriended another trader. So, I pushed him to back me, and that's how I got into the business. That vehicle for entree no longer really exists, but in truth, the barriers to entry are so minimal compared to what they were in the beginning. So I hope that would offer a note of encouragement to any new aspiring trader, the fact that the barriers to entry are just so minuscule compared to what they were many years ago. When you're in this business, the longer you're in it, the more you see all the progressions and changes in the industry. So it's not merely a journey of adapting from on the trading floor to in front of the screen, but also one of ever-changing products and methods of execution and even subtleties in the market behavior in terms of efficiency versus noise. And, I always used to laugh that once you find the key, they change the lock. But that truly is true. Every 5 or 10 years, it's a case of Darwinism. You must learn to adapt and go with the flow in that respect. So, yeah, in terms of, the lessons that you learn on the trading floor per se, I guess you have a little bit better perspective in that you're in a universe of a couple hundred people, and you can very quickly see who has longevity and who is gone 6 months later. And, with that, you've got examples all around you of what not to do and what to do. But still, it's an environment where every man's got to find their own particular niche and style. And what one person's doing in the pit next to you is probably not going to be best suited for you. So I'm not so sure that the floor is relevant anymore, but many of the things that I learned down there really aren't pertinent to my trading technique today. It's more a matter of work ethic and principle in terms of taking one day at a time and not trying to project a forecast too far out, and just doing your best to manage your risk for that day's session.
So what are some of the things that you learned specifically from being on the trading floor early in your career? I mean, I know you suffered an $80,000 loss just a few months into your career, which was more capital than you even had at the time. What did you take away from this?
Obviously it's a business with a lot of risk, and there's nothing that you can take away from it other than the fact that you respect the market a great deal.
Okay, and I read somewhere that it took roughly 5 years for you to make that money back by trading. Feel free to correct me if that's not right, but I'm interested to know how far into your career was it before you felt like you were beginning to make some real headway with your trading?
When I first started on the floor, it was much easier to engage in arbitrage in the equity options, where you had a much bigger edge than there was a decade later. There is no edge to equity options now. So I guess that as that edge disappeared, at the same time I also gained in experience. That means just general tape reading and learning to follow the market day after day and seeing numerous different environments. And I think that's one thing that people underestimate, is that you may feel that you're knowledgeable about technicals or a particular style, but it's not until you live that in low volatility, high volatility bull markets and bear markets, and that's truly where the learning curve takes place. So you really cannot do a whole lot to speed that up. And I do remember probably about 7 years after I had begun my trading career, and we entered into a different type of environment, actually about 6 years, and it was one of just a creeper uptrending market with very little volatility and very few pullbacks, just a steady grinding move higher. And so even after trading for full time for that many years, I realized that I had no idea what was going on or how to categorize that type of price action. So I think you're never fully a master. I still learn every day. There's new things or subtle changes. Maybe after 10 years, I felt like I had solidified a better program that worked for me, but there's always new things that you're recognizing and developing along the way.
Yeah, I really like how you highlighted that you're forever learning and there's always new things that are coming into play. During your time on the floor, how much did you learn directly from other traders compared to what you learned on your own, just from being deeply involved in the market as an active trader?
I didn't really learn anything from other traders, quite honestly. I mean, I can just remember one afternoon where a trader that I was friends with sat me down and showed the way that he calculated conversions and reversals in the derivatives in terms of theoretical pricing. And other than that, everybody had their own style and was doing their own thing. I didn't really learn anything from one particular trader.
Okay, and would you say that was almost by choice because you strongly believe that everyone must find their own way, or was it more a fact that no one really wanted to share information with you?
It's not that people don't want to share or have any great secrets. It's just that, you know, everybody's very much doing their own thing and concentrating on their own business. You know, they all have families to feed and so forth, and different styles, you know, and what one person does, it might be selling a premium, and that's not going to suit my risk model or profile. I don't feel as comfortable doing that, so maybe I do something else. I honestly think it's that way upstairs now electronically. You can't go and copy another trader. You know, a trader's only somebody that can really come up with their own thing, and then you have confidence with it, and you've done your own research, and you know when it's working and you know when it's not working. So I really about the only thing I learned on the floor was the person who backed me initially was the one that taught me how to keep track of market internals, meaning a 10-day moving average of the advanced decline and the trend, and there were some things that are outdated nowadays, QCHA, specialist shorts, put-call ratios, those types of things. But even so, it's up to the individual's interpretation of them, as well as putting them in the right context. Nobody else can do that for you. And it's not like a black and white, right or wrong. It's all a little bit of an art, and a little bit of a subjective framework and feel.
Yeah, great answer, Linda. Now, you were a floor trader for about 6 years. When was it that you decided to move on, and what was the next step for you?
Well, not to prolong this, but I mean, I've said this several times in many different interviews and so forth. I had a bad accident where I had broken some ribs and dislocated my shoulder, and I really couldn't stand on the floor for a period there. So at that point, I started trading from upstairs.
Right, and I believe it wasn't long after that, maybe a couple of years, that you were motivated to change to futures markets after you'd already been trading equities and options for quite some time. I'm curious to know what inspired the shift.
Well, it wasn't necessarily by choice. After the crash of 87 and then after 89, the liquidity just dried up in the options. So there really wasn't much to trade. And this is a recurring theme that you'll hear expressed with many traders that have been in the business for 3 decades or so, is that you have to be flexible to move to different products or where the volatility and the volume is, and it might be in one particular product or market for a period of a couple of years, and then it changes. You've seen that many times. Some of the products that they came out with in the late 80s no longer exist. For a period there, I remember I was in the pits in the value line options. They actually had equity options on the value line index. Well, that disappeared many years ago, and the OEX don't trade anymore. Some of the products that they came out with, index futures, originally on the Amex, they called it the Fancy or the XMI, that no longer exists. If you've heard about the XAUUSD bandit, that particular modus operandi no longer exists. So, some of the markets that I used to trade no longer exist. Pork bellies don't trade anymore. So it's just, you always have to be ready to go where the action is, if you will.
Yeah, and did you find any challenges in being forced to jump to a different market? Was there any challenges or hurdles you had to overcome to adapt to these new markets that you were now trading?
No, it's Darwinism. You make the jump or you die. Some people can adapt and change, and others never do. So it's I think you just. It's like being an entrepreneur. You always have to keep an open mind and look for opportunities, no matter how they present themselves.
Sure, okay. Now, Linda, let's say I know nothing about how you trade. How would you describe your style of trading and approach to markets? So share with us the timeframes you trade and some of the opportunities that you're actively seeking out.
Well, not to be cliche, but the market's either going up or it's going down, and it either stops going up, in which case it's probably ready to reverse, or else it stops going down and finds support, So I'm pretty much real basic with regards to that, looking, it's just like the tide's going in and the tide's going out, and you want to, be positioned to be riding the tide in either direction. And of course, it's not always so clear cut, so sometimes you're sticking the toe in the water and, maybe it's just a little tide or a little current, but what you're really doing is waiting for, that big wave or those big money flows or that big volume day, which might only come 2 or 3 times a month. So that's, it's a lot of the trading aspect is staying in the game until you see your opening and not forcing anything. So very much like playing a tennis game. You're just keeping the ball in play until you see that one moment where your opponent is caught off guard, and then perhaps you can go in and put away the ball or put away a winner, but you can't force it to happen. You have to stay in the game until you see your opening. And, I'm sure there's many other analogies one could make. If you're a poker player, what do? You stay conservative and stay in the game until you feel like the deck is hot or you've got a really hot hand, and then you can press it bigger. So I think all those analogies apply to trading. So in terms of style and time frame, that's just simply going to be a matter of how much risk you want to assume. Obviously, I think that the big money is made holding overnight, if not for one day, maybe for a couple days. But now you also have more risk, theoretically, in a overnight risk or event risk or a longer holding time. I don't see any big money being made with day traders, but you certainly can have some fabulous days day trading.
Okay, so you would say that you trade a mix of time frames, so you also are active intraday as well as those trades that you might hold for, 2-3 days and so on?
It really depends on the volatility level of the particular market, because as the volatility level is higher, you can certainly trade much more aggressively on a short-term basis. You have bigger swings intraday, bigger moves, and better liquidity. And what happens is that as the volatility contracts and range contracts, you have much less frequent opportunities, but you really need to go out to a longer holding time. So part of it is determined by the overall volatility of the market.
Okay, interesting. Now let's take that one step further. Are you able to share some of your favorite chart patterns or setups that you like to trade?
I think this notion of chart patterns and setups is, it puts things in a very linear framework, and of course the markets don't really move in a linear fashion. So if everything's going to be in a trending channeling mode or a consolidation mode where it's a noisy range, and the ranges these days are much noisier than ever before, or you're doing a climax sale and then a retest and perhaps trying to see if you can shift some supply demand in the opposite direction. And I like, Wyckoff probably still has the most appropriate market model out there in terms of test or retest and contraction and so forth and so forth. So it's easy to look at a textbook and see these contrite examples of chart formations, but as well as I do that in real life, you are going to find those types of chart examples far and few between. So I think it's much more important to recognize, is there strong volume on the day and a strong chance of a directional bias for the day, or even if you're on a longer time horizon, that swing for the week, or are you much more prone to a rotational type of mode, in which case, you are probably going to have a shorter holding period of time, and you have to be a little bit more careful about your initial trade location.
Okay, this is really interesting. So, how do you identify good trade locations? I guess that might be a better question. Like, what gives you conviction to, put on a position and take a trade?
Well, if the market's consolidating, we're forming a trading range. Let's just look at the yin and the yang. Let's say, for example, that you've just had a large standard deviation move, for example, 6 or 7 standard deviation move over a multi-week period. And then the market's probably going to consolidate and go through a testing process. Could be for 1 week, could be for 6 weeks, and when it's going through that testing process in terms of trying to find an equilibrium level or a balance, in the supply-demand, you really are not going to have favorable opportunities unless it's testing the upper or lower end of the boundaries, okay? So, you see a chart formation and your best opportunities are going to come on tests of the highs or the lows, the little mini whipsaws, if you will call it that. It's lethal to try making trades in the middle of the range. It's just a noise fest. When a market is actually breaking out and trending and making its move to a new level, trade location really is irrelevant. It's much more a matter of get the trade on, and participate in that move. So you have two different styles there, if you will. And nowadays, everybody's smart. Everybody's very knowledgeable. Everybody has, extremely fast bandwidth and so forth, and can digest information instantly, unlike, 20 years ago. So once a market tips its hand, the moves are very efficient, meaning if you want to wait for a pullback to have a graceful entry, you're probably going to be left in the dust and having to enter at after the market's already moved quite a bit. So context really is important in trading.
All right, cool. Yeah, thanks a lot for sharing that, Linda. That was really insightful. And I noticed on your charts you use a number of indicators and oscillators in particular. A lot of traders have very mixed opinions on these types of tools. I'm keen to hear, what are your thoughts on using indicators, and to what extent do they influence your trading decisions?
Well, when I actually model the market's price behavior or do any type of quantitative work, I really use price functions such as average true range, things along those lines. It's not going to model out well if you try using a derivative of price, meaning like an oscillator. I just stick to one oscillator. It's a moving average of a 3 and 10 period simple moving average. And it's just there to support the charts. I mean, you can train your eye and see the same thing without the oscillator. It just makes a little pretty feel if you start to get a loss of momentum in a trading range. So it's just a little bit of a crutch. It smooths out the data a tad, but you're not necessarily going to make a decision on that per se. It's just supporting evidence that price is always going to lead. The price is always going to be 1 or 2 bars ahead of a turn up or down in an oscillator. It just helps make a pretty picture.
Okay.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So you have a focus on becoming intimately familiar with the markets that you trade. So just for an example, let's say you have 20 futures markets that you know intimately. If you were introduced to a brand new market tomorrow, what are some of the first steps you'd take to becoming intimately familiar with this market also?
Well, the first thing that you always want to evaluate with any market that you are not as familiar with is the liquidity, because it's never a problem getting into a market. It's always a problem getting out if you need to get out very quickly. So it's just like if you test drive a new car, the first thing you want to do is not test the gas pedal, you want to test the brakes, So it's the same thing with the market. You want to make sure that you can get out of it, That's what I always look at.
Okay, liquidity. So that's definitely a big one there. Linda, you've been trading for over 35 years now. Let me ask you, to what degree is intuition and instinct a contributing factor to your trading success?
Instinct, I would say 0. All these things like intuition, really what you're talking about is just getting proficient at monitoring the tape. And what do they say? Intuition is just a sum of experience. So, I can think of just as many times where I had a hunch and it was wrong as it was right, which is why I really try to trade around a model. Even then, at least I know when the model's wrong. So I think that you have to have a core methodology or something that's going to add consistency to your approach to the market. You need to have a very consistent approach or framework with which you deal with the market. So when you start popping in words like intuition or hunch or these types of things, immediately you are starting to question your consistent framework. Now, with that said, I can have my consistent program and model, and I know when something's not going. If I initiate on a buy signal and the market's feeling really sticky and not really moving as much as it could otherwise, I wouldn't necessarily call that intuition. I would just say it's more noting the reaction of the price to the framework, that I had. And if it said, hey, everything's ready, for a green light, go to the upside, but, they're not taking the ball and running with it, and, it's just a dead market, or, it's perhaps there's, the market's already way too long and it's just not going to go anywhere.
Sure. All right. So you've mentioned models a few times. I'd really like to dig into this and learn a little bit more about what you're referring to here. So can you help us to understand how you use models to study price behavior, and how do you then take that information and apply it to your actual live trading?
Well, anytime you start to think about developing a model, it comes from asking a question of the market. So, for example, a simplistic example would be if the market has gone from low to high 2 days in a row, what happens the following day? What percent of the time does it go from low to high the next day, or from high to low the next day? So that's a basic departure point. If we've been up 2 days in a row, what are the odds that it's going to be up a third day? And then if we say, and if it is up a third day, then what does that imply? So you can start building on this, and you can start saying, gosh, if the market's up 7 days in a row, now, that might indicate that you've got some reason for persistency of trend, and perhaps it could go up 14 days in a row. So this is your basic modeling. It's usually from just asking one question and then trying to to quantify that with just one or two variables. So you end up with something that's very durable and robust, but it's not going to give you anything that you would use to bet the farm on. It just provides a framework. So let's take that example of low to high, low to high. Now I've had 2 up days, and I'm in a normal trading environment. Perhaps I'm below the 20-day high and I'm above the 20-day low, meaning that I'm in a range. So once I can add a little filter like that, I'm not making new 20-day highs or new 40-day highs, but I'm in a range, and I had 2 days low to high. Perhaps my model would tell me then that the next day I should look to trade from the short side. And so it gives you a bias, if you will. And then I would know pretty quickly if my bias was correct or not, because I'll come in and it's sort of like the old saying with the art of war, you prod with bayonets, and if you encounter mush, you advance, But if you encounter steel, you back off. In other words, if you're not getting anywhere, you back off.
So how do you then take that information and apply it to actually live trading scenario? Are you trading specifically what you've discovered from, doing your modeling, or is it just a guide?
My modeling gives me my game plan the night before, so I can come in with n number of markets and say, we've got great sell divergences in this market. It's falling into my little framework here. If it starts to break to the downside and there's an increase in volume, I'm going to add to my position or be all over it. And so, what my models do is they give me my preparation the day before, and then, when I come in and I sit down in the morning, it's like, the dealer is dealing the cards. Let's go, So it could be very analogous to if you look at football or baseball or a sport, you're going to, the night before, you're going to be studying the behavior of your opponents. You're going to be seeing, okay, does this team have a tendency to pass or to run? Who are the strong players? Who are the weak ones? Where am I most likely to get an opening, right? But then, boom, when they blow the whistle and the game starts, the conditions could change. It could be rainy, in a sloppy field, or your best man could be out and you have to make adjustments. But at least you've done your homework so that you are prepared, if you do get an opportunity to capitalize on something.
Okay. Yeah, so it's kind of like if your bias is confirmed by the market, your modeling gives you extra conviction on that trade. Is that a...
Absolutely. And what you learn is that it doesn't matter if it's a mechanical system or a discretionary approach. Probably 80% of your profits are going to come from 10% of your trades. Even if you're a day trader, you'll find that 80% of your profits will come from 10% of the days. It just is the way that it plays out. So you're always trying to stay prepared and ready, with the hopes that you get that opening and can jump on it.
Okay, excellent. Now, are you using mechanical trading systems alongside your discretionary trades?
I don't right now. I have in the past. They're more for good discipline. They're more for, for example, there's been periods in the past where, I feel like I'm starting to spin my wheels, or I don't really have any clear-cut play, and, or perhaps I've experienced a drawdown or a particularly disorienting loss, and a good way to get back into the game is a volatility breakout system. So I've used that on and off, every 5 or 6 years to sort of get the ball going again and have a mechanical guideline to, keep pulling the trigger and keep managing the trades. And with that said, I've never really made much money with a volatility breakout system. It's not something I would recommend for somebody to make a living, but you're not going to get hurt either. If you traded a volatility breakout system for 6 months, I would say there's still 90% odds that you'd have a positive equity. It's just a lot of work. It's a lot of work and it's not real fun.
Yeah. Now, Linda, how do you prepare for each session or day before the bell rings? Could you shine some light on your daily routine? Obviously, presuming you've got one, of course.
Yeah, I find that it works best for me if I do my game plan the day before after the markets close. I don't like to come in the morning and have to scramble to put something together. So I really do best if I can go to bed feeling like I'm already prepared for the next day. And it's sort of like taking a test, and using a number 2 lead pencil. Your first guess is probably your best guess, So I just try to make my best guess the night before, as to what's going to play out or, where the openings might be. And of course, we have to adjust everything to how the market's traded overnight. That's just part of the game.
Excellent answer. Yeah, that's a really great point. Now, you said at the end of your Market Wizards interview, I know this was quite some years ago, but you said, "I really believe that I can become one of the best traders around," and I really like that line, and it shows that you're very confident, and I feel many traders probably lack such confidence. So I'd like to ask you, are you successful because you're confident, or are you confident because you're successful?
No, you're never confident because you're successful. It doesn't work in that order. I think that it's more that you're confident in your ability to focus, and I would say above all, concentration. And that's what I see will affect me, and I'm sure it's that way with 90% of the people around, that your success is going to depend on your ability to concentrate, particularly in the past number of years, because it's so easy to have pervasive distractions. The social media, the Twitter, the TV, the tweet decks, the blah, blah, blah. I don't even know all this stuff. All the blogs, the emails. I have no idea how somebody can concentrate and trade well with all these extra opinions and energies and noise going on around you. I think that you need to figure out for yourself how to totally eliminate the noise and then concentrate on your own strategy. And for a lot of people, myself included, I feel that if somebody else if I hear somebody else's opinion or strategy, I feel like I'm in a lose-lose situation. Damned if I do, damned if I don't. I don't want to know what anybody else is thinking. I don't want to know what somebody else's work is. I want to know what my work is, and then how the market is acting according to my plan, and then I can do best. So I think the confidence comes when you're in that mode of, not to sound cliche, but trading is a performance-oriented sport, if you will. And so all those books that came out 15 years ago talking about flow, and staying in the moment, and now it's sort of gravitated towards this mindfulness terminology, but it's all the same thing. It's all your ability to concentrate and focus, and I think that is what ultimately gives somebody confidence then.
All right, brilliant answer. And just while we're speaking of cliches, I know this question is kind of along those lines, but I've got to do it. Is there any advice you'd like to pass on to younger traders that would be beneficial to them? And of course, feel free to repeat anything that we've already discussed too, if that's what you'd like to really emphasize.
Yeah, I don't like sounding cynical, because I'm not a cynical person per se, but I would suggest that you take anybody else's opinions that you see expressed on internets and blogs and tweets and so forth, take them with a grain of salt, okay? Perhaps those people are doing well. Perhaps they're only more vocal when they're having good trades, you know? And a lot of, quote, educators out there honestly couldn't trade their way out of a paper bag. That's why they're doing other activities, you know? And I know you can make such a ridiculous amount of money, you know, as a CTA or a fund manager or managing other people's money. It's not even funny. So, you know, if you can trade well, you're certainly not going to be out there trying to teach other people how to trade. You know, it's a bottom line business, and if you can put together a good bottom line consistently, trust me, the money will just flow to you, and you can make so much more. So really, you know, have your antenna up. And I'm not here to diss people in general. There's some good people out there, but it's really important that you find your own style or something that makes sense to you. And the best way to start out is print off charts of key moments, of where there was a big move. Print off charts of these and see what the price action looked like leading up to that, you know. So it's sort of a deductive type of logic, you know, in backtracking back here and seeing if there's some common elements or common themes, and then how can you position yourself in that direction. It's really good old-fashioned detective work, and it's not going to come, in my opinion, from looking at artificial constraints on the market. And by that I mean, you know, Fibonacci numbers or Gann numbers or you know, all these types of things. And by the way, Gann, up until like his very last 2 or 3 years when he had syphilis, was a basic swing trader. If you read all his early work, it's swing highs, swing lows, you know, cycle anniversary dates and stuff. It wasn't all these little goofy, you know, spirals and all that kind of stuff when he was pretty demented in his head. He was just a good old-fashioned swing trader, as was Wyckoff and all those early works. So, you know, do your own work. And then what you want to do is you want to just concentrate on one initial pattern, and meaning one initial play, either a breakout type of thing or a retracement into the direction of the trend. And, you know, see if you can make a little library of those. See if you can capture 20 examples of those. You know, print them off and make a little notebook. And then as you see them unfold real time, maybe you just get 2 a week and start to keep statistics on your own ability to replicate something in that direction. And don't think about trying to capture a big play. Think about only trying to take a couple ticks out in the direction of that movement, okay? And if you do that, then just let it go on to the next trade. And what you'll find is that initially, perhaps your ability to capture a piece of the swing might be capturing just 10% of that swing, you see? But if eventually you can capture 1/3 of that swing, that's a really good metric by which to measure yourself against. So you have to find something where you can make it a game against yourself. You see, can I have 5 winning days in a row? Can I make 3 winning trades in a row? And it's keeping track of your own records and performance statistics, you see? And you have to make it into that type of game for yourself. And then it will help you free yourself from the ego-driven drive to call a market right. You know, say, oh, you know, I called the turn. Oh, it's going up. Oh, it's going down. And that's really not what trading is about. You know, it's not that we're smart and we can foresee something in advance. It has nothing to do with the markets. It's more, you know, imagine you're out on the sea and you're surfing. Nobody can see when that seventh wave is going to be the big wave, right? You just try and get up on your board and stand up on the board numerous times, and then, whoa, lo and behold, you catch that big wave, but you can't say, oh, that big wave is going to come in 11 minutes from now. It doesn't work that way. So it's very much with the markets. You're really at their mercy. And let go of all this, egotistical stuff, and then you'll really be the better trader and the better breadwinner for being able to extract profits from the market. It's just being ready to take what the market gives you. And I hope that makes some sense. I really feel strongly about that. I feel incredibly strongly that people think that there's an easy way, or they think that they can follow a guru or somebody else's, perhaps path. And the only people I see really make it in this business have found one little arbitrage that they can relate to for themselves. And then they can expand on that. And once you've reached that point, there's no harm in seeing what other people are doing and extracting ideas. Then you take that idea and you say, well, maybe I'll add my little twist to that. Maybe that only happens on Fridays. Maybe that only happens when the first hour's volume is greater than the previous day's first hour volume. You see? And that's sort of the evolution of constantly coming up with ideas and growing with the markets.
Excellent response there, Linda. That was really brilliant. Thank you very much for sharing that, and you've definitely given us all a lot to think about. So I appreciate you going to lengths to explain that to us. Before you go, do you want to share with listeners where they can go to find out more about you, and where can they connect with you?
Oh my goodness, I have a little website up that I've been pretty negligent in posting to this year. I kind of set up this blog format, and I'm a pretty crummy writer. I should get back to doing something like that. But I think there's a contact form on there if you had a question and you wanted to contact me. Other than that, I'm sure there's a proliferation of information on the internet. I know I've done YouTube videos for Big Mike Forum or Money Show or goodness knows, so much stuff over the past. So I'm sure nobody would have any problem finding much material for free. Hey, for free out there.
Yeah, well, I found a bunch of great resources while I was doing some homework for this interview. So I'll be sure to link to those in the show notes to this episode. So anyone listening, if they want to get the show notes and links to find out more about Linda, go to chatwithtraders.com/48. Everything will be there in the show notes. Now, Linda, thank you very much for doing this. It's such an honor to speak with you, like I mentioned earlier. I really appreciate you taking the time to do this. Have a great evening, and let's speak again soon.
All right. Best to you, Aaron.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
The biggest secret of the best traders in the world is that they're just like everyone else. However, they've worked hard to learn the markets and discover what works and what doesn't. But how can you hear about these journeys and get in on the strategies and tactics they use? You can do it by listening to Chat with Traders. Here's your host, Aaron Fifield.
What's up, guys? What's going on? Glad you could join me for episode 49. Thank you very much for tuning in. Now, I have a very special guest on the podcast this week who I'm excited to introduce you to. His name is Haim Bodek, although some refer to him as the Algo Arms Dealer, and I totally understand why. Haim began his trading career at Hull Trading, a prestigious firm well known for driving forward innovation in the domain of automated trading. Following Hull, Haim then went into significant roles at Goldman Sachs and UBS, which are all discussed during the interview. But to further set the scene, in 2007, Haim founded Trading Machines, a high-frequency trading operation, and at the peak, Trading Machines accounted for 0.5% of all options trading volume with a team of 25, one of who was Brian Weiner from episode 40. All was well for a couple years until the beginning of 2009, when Trading Machines ran into issues and began to bleed money for unknown reasons. Until Haim later discovered at the root of the problem was secretive order types being used by a select few firms, giving them an unfair advantage to front-run the orders of other participants. With this discovery, Haim went to the SEC to raise his concern about such order types, and little did he know at the time that this would be the beginning for one of the most sophisticated and complex investigations carried out by the SEC in US history. So of course, we speak about all of this in much more detail during the interview. And we also speak about another fascinating topic, which is the payment for order flow. Haim shares with us what is really happening to your orders after you click the button to buy or sell. And you might even be surprised to find out that a large majority of retail orders never even make it to an exchange. So just from listening to this interview, you'll quickly realize Haim has an incredible knowledge of market microstructure. And in case you find that some parts are a little technical, then this may be one episode worth a second run. Just while you're listening, I'd love it if you could please leave a brief review on the podcast in iTunes. It's a very quick and easy way to support Chat with Traders. All you need to do is go to chatwithtraders.com/iTunes and follow the prompts. That will be a huge help, so thank you. All right, it's time. I'm your host, Aaron Fifield. This is the Chat with Traders podcast, and please welcome my guest for this week's interview, Haim Bodek. Haim, welcome to the podcast, man. How's it going?
Doing well. How you doing?
I am excellent, thank you. And thank you very much for doing this. It's great to be speaking with you. Now, here's how I picture the interview playing out. So we'll have three major talking points, right? They'll be walking through the roles you've had over the years, so working at Hull, Goldman, UBS, and of course, Trading Machines. And secondly, really keen to get into the topic of blowing the whistle on HFT's secretive order types, and then what's happening to retail order flow. So if that sounds good to you, let's dig into it.
Okay.
Awesome. So Haim, share with us how you got started in finance and what was it like to work at Hull Trading? Because, I mean, just quickly, from my understanding, they were a very prestigious firm regarded by many as pioneers in the realm of automated trading. So what was that like?
Yeah, well, I'm still pretty nostalgic about the experience, and I know a lot of my former colleagues also are. I got into Hull. I guess most people who joined the firm probably had unusual backgrounds that were relevant. I started out working under a entrepreneurial professor named Bob Grossman, doing credit card fraud detection using machine learning algorithms. So I was really kind of oriented around large data, detecting patterns, and had some good successes with that project with Visa. And at the time, there was a lot of hype about using those methods in finance, and it was kind of funny. But there was actually an advertisement that said, wanted individual who to use machine learning algorithms to forecast markets. So I applied and got the job.
Excellent. So what was your role at Hull Trading there? Like, what were you doing on a day-to-day basis?
Well, the role changed. I mean, I was still very green, and Hull was a good environment for. They really focused on taking scientists or other technical types, and basically grooming them. I was probably in the financial engineering group one of the stronger programmers, and there was a lot of competition for like the pure quant jobs. And I kind of started out, working on machine learning and forecasting. Then I started to work on basically the data infrastructure for all the financial engineering models. And eventually that kind of led into a role where I was one of the few people who focused on the intersection between what we think of as the three disciplines in the field. So at Hull, there was basically a financial engineering group, which is the quants. You had a technology group where the developers, were situated, and then you had trading. And Hull traded on the floor. They also traded electronically. And my role kind of evolved to be the guy who sat in between those groups. Eventually, it was in the early 2000s. The role that I had at Hull started to actually have a name. People had a hard time describing what I did, but we call it strategy now, and it's basically the algorithmic trading part of this type of business. So I started to focus on quite literally the intersection in terms of how those three functional areas, trading, financial engineering, and technology, were actually all bound into a system that could execute trades strategically, on the exchanges.
Right, okay. And after Hull was acquired by Goldman Sachs, what happened next? Is that when you went to UBS, or did you stay on at Goldman for a while there?
Yeah, I stayed on for a while. It was actually pretty interesting and difficult time because Goldman actually acquired Spear Leeds and Kellogg, the very big NYSE specialist operation, and there was basically an integration effort between Hull, SLK, and Goldman, and a lot of people burned out on that. That was a pretty, I don't know what the word is, but ambitious integration. And I think the guys who were probably the happiest there were people who found roles at Goldman that were, that leveraged their skill set, but wasn't really in the middle of this very difficult integration of these businesses. So you actually saw quite a lot of attrition over that period, and people from the firm ended up setting up and joining other desks, and that's really how the DNA got around the street. I joined UBS after that. A group of guys went there, and I joined up with that group and focused mostly on the U.S. operation. And in about 2 years, we kind of replicated the entire kind of business model that we had done at Hull. So it was a pretty successful group. It was called EVT, Electronic Volatility Trading. And, I guess, towards the end of my stay there, probably I think the last year and a half, I took over the group globally as co-head.
Okay, so that's a pretty major role, isn't it?
Yeah, I benefited from the fact that the things that I focused on, what we had in the early 2000s, mid 2000s options industries, we had the markets were basically going from floor-based exchanges to hybrid, which was a combination of floor and electronic, to purely electronic. And they're really, because the floor was, primarily how business was conducted in the options space, there really weren't a lot of people who did what I did. I kind of cut my teeth working on European options in the late 90s, and those markets were automated. So, my career basically, I got a leg up on a lot of the other people because as markets went electronic, a guy who, what is my task? My task is to put literally 300,000 or 400,000 bids and offers across 500 names, hundreds of options per name. And I have to put all those out and do it in a manner, where we don't lose money. I mean, you think about it, it's about making money, but there's been some pretty big blowups in the options market making space because of how difficult it is to actually trade that many different securities and to react, really within milliseconds to the changing prices of them.
Okay, excellent. No, that's really interesting. Now, this is what I'm really keen to hear more about. So tell us about trading machines. What motivated you to start the firm? How did you go about it? And what type of operation was this?
Yeah, well, I guess in 2007, the options market in the U.S. Had what was known as the penny pilot, and there were 13 names that were quoted in pennies instead of the nickel increments that had existed beforehand. And when I looked at how those names were trading, I thought to myself that these products were actually quite similar to maybe how the Korean market traded, and I came to the conclusion that the way that market making would operate in the U.S. would necessarily have to change. So basically, the margins would be so thin that option market makers wouldn't be able to do traditional bid offer capture, or spread capture is what we call it sometimes. So I kind of came to the conclusion that I was going to have to rebuild, and that it was going to have to be a we were fast at the time, but I kind of felt we needed to really pursue the low latency game harder than maybe what was possible at a bank. And at that time there were many high frequency trading firms in the equities universe that were really pushing the arms race there. And to just kind of give you some more color, it's a very complicated decision I made, to leave and go do my own firm. But we also had the integration of stock exchanges and option exchanges. The stock exchanges purchased the option exchanges, and then they cut the option exchanges over onto the stock technology platforms. And then over that time, they started to roll out, the stock market has certain business models. One's called the maker-taker system, which is a system of where two individuals trade and one gets a rebate. We'll talk about that maybe later in the interview, but the other guy pays a fee, and you start getting all this. I thought of it as cross-contamination. You got all this stock market high frequency trading tradition started kind of molding into or melding, I guess, into the into the option space. And then you also had some of these HFT firms, which were doing very well, start to set up options operations and compete in the options space. So in this period of transition, I felt that I needed to be ahead of the game, and so I needed to go build a new, an entirely new business model. Originally we were going to go to basically a hedge fund that was affiliated with an investment bank, but then it kind of evolved, and I realized I could go independent. So we set up trading machines, and it was basically a high-frequency trading firm for options. We traded. We hired from all the major operations. We tried to get people who had that kind of expertise. I think at our peak we're about 25 people, and we launched into the market, and we were traded pretty consistently about 0.5% of the U.S. options market over the lifetime of the firm, when it was actively trading.
Yeah, that's really impressive that you were doing such high volume. I mean, 0.5% of all options trading, that's very significant. So that volume, just so we understand, that volume that's spread across lots and lots of small trades, or alternatively spread across a few larger trades.
No, yeah, it's spread across lots and lots of small trades. Because of how the stock market worked, we ended up doing a lot more, many more transactions in the stock market than in the options market. But still, it was, definitely, as far as like high frequency trading options goes, we were the closest thing to it. We specialized in basically operating as an informal market maker, very much the way the high frequency traders now work, where they don't necessarily have market making status or obligations. So we would basically opportunistically provide liquidity or take liquidity in names when we identified mispricings, and we centered a lot of the business over short-term intraday volatility forecasting, and that was kind of our bread and butter.
Okay. Yeah, so to summarize, where was your edge at trading machines? Was it essentially the speed of execution? Was it the number of trades? Or was it the complexity? Because you were running over 1 million lines of code. So I'd love it if you could expand on this, please.
Well, the edge, I mean, I don't really think of speed as an edge in the way people talk about it. Speed is basically used when you have a competitive relationship with other traders out there. So if you guys are both triggered by the same events to try to go after the same trade, then speed matters, because you need to be faster than the other guy. That will tend to occur in the option space. If a stock moves, the options, the theoretical values change, and there'll be a race to kind of hit the quotes that are stale out in the market or resting orders. And then there, the market makers who are, and call it high frequency option traders, everyone's trying to hit the mispriced options, but they're also trying to cancel and update their quotes, which are stale. So there's, that's kind of the arms race that we have. I don't really think in any kind of efficient market that becomes your bread and butter. You have to have something more than that. We focus quite a bit, as I said, on the volatility piece, and this is the implied volatility. In many ways, that can be a surrogate for supply and demand in the options for basically buying pressure or selling pressure. So we tended to develop models where we can get on the right side of that pressure to either buy or sell options. And the other thing that most people don't understand about the options business, which is really absolutely necessary and central to the way we get an edge, is really, we'll call it risk management, but it doesn't mean the same thing it means in, let's say, the stock or futures world. Risk management in options is really about finding the most effective and cheapest hedge for previous trades that you've done, and that tends to mean that every single trade you do has a component of it in which it's either beneficial to you from a risk management perspective, or the opposite, or increases your risk. And options are can change quite dramatically over the day, and if you do not actually manage your portfolio, which will be very complex, with incredible precision, you basically will not be able to lock in or realize any of the alpha that you have in a way that isn't exposed to what we call adverse selection or slippage.
Okay, that's really interesting. Now, the Wall Street Code, the documentary that you were featured in, at one point the voiceover said, and I'm paraphrasing here, you had written an algorithm that would generate a guaranteed income. So I'm really curious to know, how was this possible to guarantee an algorithm would always win?
These, a lot of the stuff that has hit the media, or that's in a documentary, there's always some kind of translation there. Okay, so this guaranteed profit that is talked about in various manner in the let's say the HFT industry, or I was in the high frequency option industry. Even if you have some type of pure arbitrage, you still have execution risk, right? This kind of guaranteed return isn't really the right way to describe the activity. But there are strategies that, if they have very high execution certainty and very aggressive and tight and precise risk management, can basically approximate they will appear to have a very stable return, and the positions that they create are, in our case, we did actually try to target positions that were approximations of what would be riskless portfolios. So there's a tradition to target that doesn't mean you actually can achieve it. As I said, the execution risk, the risk that you cannot actually execute the legs of the strategy effectively and cost effectively. That's one of the main things that's going to stop any strategy that's going after a guaranteed profit. But when you look at these businesses, when they're the types of strategies that that statement may have referred to, they will tend to have very high. I don't know if your listeners are familiar with metrics like the Sharpe ratio, but it's a measure of risk over return versus some type of benchmark, and those metrics for the HFT business will be very, very high, and the P&L distributions, lots and lots of trades. They will look. Many of the businesses will look like literally very close to a straight line in terms of profit. That was the case actually for the portfolio we ran at Trading Machines on a gross basis, but gross P&L looked very, very. The slope of that was pretty straight, but we had a lot of difficulty with fee structure, and the fees had quite a adverse impact on us, especially the fees associated with stock trading and hedging.
Okay, very interesting. That was well said, Haim. Thanks for really explaining that to us. Around 2009, Trading Machines began to lose money. So tell us about this time. I believe it was about 12 months before you even got to the root of the problem. So what was going on? What was that time like for you during those 12 months?
Well, it's interesting. I mean, what happened? So we were basically building the year that Regulation NMS was rolled out, and that body of regulation really restructured how the U.S. stock market operated. I guess it did also apply to the options market, but it had features that were basically problematic for high frequency trading strategies in the stock universe. So what happened is that in 2000, from 2007 to 2009, the exchanges basically started to create features, primarily features that were requested by high frequency trading firms in the stock market. And these, they, in particular, they created order types and what I call order matching engine called practices. They basically modified the order handling of the stock exchanges, and the period of probably some of the most intense modification was over the period of 2009. Now, my firm had launched trading in August of 2008, and we launched a month before the financial crisis struck, and then after that you had just incredible market conditions and volatilities that were 200% volatilities. You had such anomalous markets, and there was a lot of dislocation and a lot of edge. So I did not really appreciate I was not really able to witness the called the nuances and how the stock market had changed. I mean, I do actually remember it was December 2008 was the first time I started seeing odd behavior in my stock executions, and what I did is I started to avoid venues that I thought were just toxic, right? That were the lots of us in the business are trying to trade against order flow that isn't informed, and some venues have a different composition than others, and my initial thought was, hey, these particular trading venues are toxic, and I basically tuned my system to trade on the venues that were that looked better. And what happened is in the end I started having more and more of my trading concentrated in only a few venues. So I had kind of learned that most of the market was toxic. And what had actually happened over that period of time is the exchanges were modifying how their systems worked and introducing features that basically supercharged the profits of these high frequency stock traders. These features were introduced without adequate disclosure, and the exchanges were in no way, they would visit all their clients, but they weren't talking about the high frequency trading features with any, with the firms that looked like they were the counterparty to high frequency traders. So we must have looked like what an exchange would call a customer, right? Whereas certain high frequency trading firms in stock would be thought of as liquidity providers. So customers were basically not really informed about these order types, and the exchanges would come in and give you all this information on how they operated, but just miss, they just kind of skip over anything that had to do with the kind of features of high frequency traders were actually requesting at that time. So what happened, it's kind of a long story here, but what happened in May 2009 is that the last exchange in the US basically modified its order handling to accommodate HFT, and that was direct edge. They introduced an order type called hide not slide, and what I try to explain to people is when you introduce a particular order type, it doesn't just have features in its intrinsic to itself and how it operates, but the code, the actual code in terms of how the electronic exchange works and how its order matching engine works has to be modified and has to define how does that order type interact with the other order types, right? and that's something I've tried to explain in my book, The Problem HFT. It's not just that metaphorically the exchanges are introducing a queen onto the checkerboard. They're also defining how that queen interacts with other pieces. And it turned out that the pieces or the order types I were using were heavily disadvantaged by in the interaction with the hide not slide order type. So really what happened is we just started bleeding, and it looked like my guys rolled out a bug. I was actually at my sister's wedding in late May 2009. I was gone for a week, and I came back, and the stock trading had changed in to a point where we were basically making money in the options and hemorrhaging all of it into the stock market. And it was quite perplexing because a change like that is usually triggered by a software release or a mistake that the trading firm does. So it didn't really, I've been in the business for over a decade at that time, and it just was not clear to me. There wasn't like a circular or any type of information that had been delivered to me specifically that had indicated that exchange should change their market structure. There's somewhat of a paper trail, but it was such an extreme change, and it wasn't really communicated to the client, to the members of the exchange in the way that it should have been. So I'm sitting there, and it just didn't occur to me that this type of what really looked like a bug, hemorrhaging this money, was actually just the exchange redefining how my orders interacted with HFT orders, and literally just rolling out code that changed how my trading operated.
Okay. Yeah, so I appreciate you explaining that for us. That's really insightful. And shortly after you spoke out about this and revealed your concern to the SEC, why did you decide to blow the whistle on these secretive HFT order types?
That's a long story. I didn't really know what I was getting into. First of all, I'll just say there's a tradition. Blair Hull, founder of Hull Trading, he went on the record and called out the NASDAQ market maker collusion and what was known as the Christie Schultz scandal. That was an episode in kind of stock market history where NASDAQ market makers were colluding and keeping spreads artificially wide. And a pair of academic researchers discovered this and wrote a paper, why do these market makers avoid odd prices, really, is what they had discovered. And, where they skipping every other price and keeping the spreads are artificially wide because of that. And turned out that they were colluding, and the industry was actually fined, I think, close to $1 billion in penalties because of this activity. And Blair was one of the first insiders to actually go on the record, and I think it was in the LA Times, and actually note a particular name, and that he basically got a phone call from the market maker telling him to get out of his game, and he went on the record on it. Another example is one of the great kind of leaders in the options industry, Tom Pettifree, for 5 years was lobbying heavily and very vocal about eliminating a loophole that allowed queue jumping, the same kind of stuff I turned in the stock market. There was actually a kind of a queue jumping loophole in the options market where we call them customer market makers or barnacles, but basically professional traders learned that they could masquerade as retail customers and get customer priority and leap ahead of the other market makers. And he was very, very as I said, vocal, and I think deserves a lot of the credit for what eventually happened. Was 2010, the options market basically created a solution for this problem and eliminated it by creating what's known as the professional customer designation. So basically, if you trade too much and you try to take advantage of that loophole too much, the loophole still does exist, you actually have to change your status, and then you no longer can exploit the loophole. So here, the two names, big names in my industry, are both associated with significant market reform. Of course, both of them, were able to do that because they had very, very successful, operations. And I think, what was different about me is I decided to call out these issues, maybe in the same style, I thought, as these other great leaders did, but I called them out after my firm failed. So I wasn't in the same kind of position that they were, and I didn't realize how important it was to, to be. I mean, this has taken up 5 years of my life now, and no way did I think it was going to happen.
Yeah, so I mean, it was a very bold move, and I really want everyone listening to understand how bold of a move that was. I mean, were you at all concerned about your reputation or what the repercussions might have been? I mean, even on a personal safety level, because I imagine there were many people who were upset by you doing this.
Yeah, it's funny. It was bold. I mean, I think, again, I was kind of insulated. I didn't realize how insulated I was from other parts of the industry by getting, that experience in the ivory tower. I didn't really understand, and you've probably seen, the last few years been quite a number of major penalties and fines. I didn't realize how prevalent it was across the industry to exploit the gray and to often cross into the black lines, between unethical behavior and, let's say, illegal behavior. It was not, whole trading was all about being smarter than the other guy. And I kind of grew up on that. There was a former colleague of mine who said to me, he says, "It ruined us. We weren't ready for the real world where it's shadier." So, I guess I didn't actually realize what I was going up against until I, had already disclosed this stuff to Scott Patterson, who started reporting on it in the Wall Street Journal. The information I gave resulted in extensive investigations. That took 4 years. The Direct Edge case. Direct Edge was eventually fined, the largest fine in U.S. history against an exchange, which is $14 million for improperly or inadequately disclosing their order types, right? This long path, which was successul in the end. That case, for example, the Direct Edge case, it was. I was informed that was the most sophisticated case that the SEC had ever done in terms of complexity and sophistication of the abuses. So this whole process and my opponents, it started out as I thought I was going against a small segment of the industry that was, taking advantage of the system, and I was convinced at the time that it would have been discovered, by the regulators. And halfway in, I realized that I didn't go against a small part of the industry. I went against the dominant practices in the industry. So, again, when you do something like this, you take a shot out, and you throw, metaphorically, you're just throwing a fist out there. You don't actually know who you're hitting. And you're right. that as you get feedback, and in my case, I went against some very, very powerful, entrenched people. You look at this and you're like, did I make the right move? Am I doing the right thing? And you get a little bit nervous and anxious, especially when the industry. I mean, you get more heat and more negative feedback. The more significant the issue is, and the more if you're right, you're going to get trapped for 5 years. I didn't realize that, but that's a very common experience for whistleblowers. If you're wrong or it doesn't matter that much, then it just goes. You might report it, but no, it doesn't result in any big action. And in my case, there must have been somewhere between 40 and 50 regulatory filings that exchanges were forced to provide to accurately describe how all of the HFT features operated. It was a war. It was a so anyway, I don't recommend it, but I get it's not something I'd recommend other people to do. But I guess how did I get through it? I just have a property. I guess it helped me out here. It's when I started to get nervous about what I was doing, I kind of doubled down on the trying to prove I was right, and that meant that I kind of outworked a lot of people on the other side. The precision of my information basically put I provided so much detail and accurate information that needed to be looked at carefully by regulators. What I believe happened is that just created so much heat on the practices that they weren't really able to mount any kind of opposition, to me. I mean, other whistleblowers will get heavily smeared. That didn't really happen with me, and it was definitely done, privately. But I didn't have to go through a big, public battle where exchanges were saying statements to kind of disprove me publicly. And I'll give you an example. Let me think. I'm forgetting actually who there's a Nobel laureate. I'm just forgetting his name. But in the Christie Schultz case, NASDAQ hired very, very reputable people to basically attack the opposition. And it was complete. They were completely wrong, but these people that were hired, these experts, but they really made it very painful for people who were trying to turn in those practices. And in my case, I mean, it was very public. There was, let's say, a debate, but I mean, yeah. Sorry. I mean, it's a long, it was a long process, but I survived it.
Oh, that's awesome. So to summarize the investigation, I mean, because this was a huge investigation, what was the outcome? Like, just to summarize it for us, what was the outcome and what's been achieved or changed since?
Well, the main thing that was achieved, you can really think of the investigations, and there were multiple ones because there were multiple targets. When the enforcement division looks at these issues, they need to come to a place where they determine. First of all, they have to look at the accuracy of the allegations, right? But then after that, they have to look at is this unethical behavior or is it illegal behavior, right? And they have to lots of things I work on, with regard to call it regulation of high frequency trading. It's not actually clear, where that line is between unethical and illegal, and that takes a lot of very talented people with securities law background to determine. And the thing is, the SEC Enforcement Division is only going to be pursuing violations of securities law. So if the law is not violated, then or maybe the law is not defined, is not defined well enough to address the issue, then it basically becomes a policy issue. So a lot of the things that I turned in ended up becoming, a policy issue, and everything really kind of revolved around disclosure. So you had the Office of Compliance Inspections and Examinations did an order type audit where they had all the exchanges submit very extensive information on how they made order types, how they disclosed them, the whole process, which ones existed, and that was actually completely a separate initiative from the enforcement investigations. And then about a year ago, Chairman Mary Jo White, she mandated that all of the exchanges use last year, this is 2014, she basically said that the exchanges needed to reassess all the regulatory filings and determine if their order types were accurately disclosed, and also to assess if the order types were operating as intended, and if there weren't unintended consequences. It was a very kind of also very significant initiative, and most of the exchanges were extremely responsive and put out a lot of revisions and clarified how the order types worked, changed certain features. There was many of the issues that I was concerned about were addressed through disclosure. I thought some of them would be ripped out that were approved. I was kind of shocked that, I've been very critical of queue jumping behavior and those that was actually approved. But, what I learned through the process is that the SEC is actually pretty liberal in terms of allowing different types of call it functionality on exchanges. They just demand that there's adequate disclosure, right?
Okay.
So that's so in the case of Direct Edge, that's a case where that exchange basically was not responsive enough and had significant lapses in their disclosure, and I think if they had been had addressed the issues earlier and had been more cooperative, maybe you wouldn't have seen the same result.
Sure. Okay.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So, Haim, let's change gears and bring this back to a retail level. I mean, because I know we're on some time constraints here, but the big question, does HFT affect retail traders?
Yeah, well, HFT in general affects retail traders. I would actually lean on the side of a slight positive effect. And I think what retail traders don't understand, and I really don't like the narrative that's been going on in the market structure debate or the flash boys debate. High frequency traders tend, not to trade on venues where they are able to trade with retail. I mean, retail orders do not retail market orders do not tend to go to the major exchanges. And when I mean that, I mean there are reports that the retail brokers file, 606 reports, and you will see that exchanges often will have a reported zero. Not a single market order was sent to that exchange. And retail traders, they send a lot of market orders. So those market orders, they don't go to the exchange where the HFT is trading. They often do not go to a dark pool. They often go to what we call an internalizer, or a wholesale market maker, or off-exchange market maker. What does that mean? Basically means that those orders are bought and they are traded. These off-exchange market makers will trade against those orders, those retail market orders, really without competition. So how does HFT affect that type of trading? Well, the upstairs market makers have to match the best price on the exchange, right? That's, they're basically sitting on the sidelines and they get to trade at the prices they see that really the high frequency traders are posting. So the more aggressive and the tighter that high frequency traders trade, the more that they tighten markets, they're actually squeezing the margins of the upstairs market makers. So that's why I say there's a little bit of a positive impact. And I know this from experience that when the high frequency traders came in, the upstairs market makers had actually quite a difficult time, and continue to do so, because the high frequency traders tightened the markets and often would tighten them to a point where the upstairs market maker couldn't make that much money if he matched the high frequency trader's price. So that's probably not what you would expect, right? I mean, I've been extremely critical of HFT, but I will say that part of the reason they can trade so tight is they've got all those super advantages that cause me grief, right? So in a way, retail's benefiting from the fact that firms like mine were basically abused.
Okay, so something you mentioned in there, which I just want to dive into a little bit deeper and not skim over it too much, is the how does the payment for order flow works? Could you just explain that to us in a little more detail?
Yeah, it's a very old practice. It's getting a lot of attention now. We actually are seeing some class action lawsuits targeting it. Before I explain how it operates, I'll say that one of the major innovators of payment for order flow is Bernie Madoff. So that's kind of the origin. What he did and other firms in that space is they basically buy retail order, literally buy, through a kickback, payment for order flow, we call it, and from retail brokers. So they say, look, don't send your order to the exchange, send it to me. I'll match the exchange's price, and I'll pay you for it. And if you think about that payment, it's kind of like a profit sharing if you think about it, right? The market maker's giving up part of the profit he would make on the spread and giving it back to the broker as a kickback. Why would a off-exchange market maker do that? Why do they do that? Well, it all has to do with this concept of what we call adverse selection. But basically, when you trade out in the market and you're posting your quotes, you basically are giving all of the sharks in the market, all of the other fast firms, the option to trade you against you when you're wrong. Maybe you're not fast enough updating your quotes. Maybe you're providing liquidity to a huge, let's say a large pension that their order is gonna move the market, and market makers don't want to trade against order flow that moves the price against them, because then they just lose money. So retail is very, very attractive because it tends to be small, and smaller orders don't move the market as frequently as larger orders. But the other thing about it, and I know retail guys probably don't like this, but statistically, it looks uninformed. I mean, you can look at large volume of trades of retail traders, and you can see, what is the, what is the kind of average alpha, or average information that kind of edge information, I just call it, right? That these orders have, and the answer is zero. It's near zero. So when you trade against a retail guy, you make very close to the actual spread. When you trade against a pension or a mutual fund, you actually get a lot of adverse selection or bleed, and that will look like that's basically price movement that erodes your profit. You don't make the full spread when you trade against other types of counterparties. So it's actually quite simple. It sounds complicated, but it's just, I'm going to say it again in a very simple way. It's like, the way I'm actually look kind of down on these guys. It's like there's an upstairs market maker. He can't compete in the regular market that well. So he basically buys orders from, buys dummies. He wants dummies to trade with, and he basically pays brokers to send them the dummies. These firms that have been engaged in this have had, many of them have gone under in the last 15 years, and Madoff's obviously was one of the biggest, and that whole entire business collapsed. It actually was rebranded as surge trading, I think, and still went under. These firms, were really unable to develop market making operations that could compete in the regular exchanges. The HFTs basically were more sophisticated compared to these kind of upstairs market makers. So, I do give credit to the HFTs for, being able to trade, even though I'm very, really against the cheats and the unlevel playing field. They are able to make markets in the exchanges aggressively, and that's good. Otherwise, we just have these other guys just cherry picking off exchange, and then we'd have wide spreads. It'd be worse.
Okay, so just to wrap this up for us, is the retail trader disadvantaged in any way by the way that the payment for order flow works?
Well, disadvantaged. There's definitely arguments to be made that that the order handling is not optimal, and that is really there's certain firms that are now have lawsuits against them because they handled orders to basically maximize the kickbacks, right? Well, the problem with maximizing the kickbacks, I'll give you a very clear, actually, example here. If I go to, if I'm a retail broker and I go to market maker says he's gonna, he's gonna pay me a quarter penny per share for my orders, right? He could actually give me a kickback, or if I was looking to get my customers the best execution, I might say, hey, don't give me the kickback. Just give me a quarter penny price improvement. Give me a better price for every single share you trade, right? So these brokers actually have a choice. They can actually negotiate to get you a better price, or they can just, take the kickback and pocket it. And what they do is they know that the regulators are concerned about the level, the amount of price improvement. So what they'll tend to do is give a de minimis price improvement. They'll basically say, look, give me a little bit of price improvement on average versus what might have been available on exchanges, and then give me all the rest of it as a kickback, right? On top of that, they will basically, as I said, send orders to either trading venues, and it's complicated, I don't want to get to all of it, but basically trading venues also have rebates or kind of a payment for order flow arrangement. When a broker basically maximizes the kickbacks that they get, not only are they not passing on the value of those kickbacks to their traders in the form of price improvement, but the places that have the highest kickbacks tend to be the places, especially if we're talking about trading venues, where which are the most expensive to trade for the liquidity, for the other side of the trade. So what that basically means is you don't get filled as frequently if you try to maximize rebates and kickbacks. So very simply here, retail traders should be getting, significant price improvement. They're not getting it. The way things are routed now are probably dramatically reducing their fill rates for orders that they post. So if you're a retail trader and you post orders and you don't get filled frequently, what you should know is that your broker has a lot of options for trying to get that order done. And if you're not getting filled, maybe your broker is not sending those orders to places where they're likely to get filled because he's trying to maximize kickback. So these are all the details about it. But the other thing I'll point out is the all these payments and kickbacks I'm talking about, they are very significant. Some brokers will get close to like 50% of their net income from these types of payments. But these brokers are basically charging commissions that are ridiculously high when compared to the kickbacks. So, I guess I would say that the commissions are even more egregious for many of the retail brokers than all of the funny business I just spoke about. And there's a deep irony there, because the reason why the SEC permits all the kickbacks is the argument is it's supposed to reduce the commission rates. That's the whole reason they're permitted. And so for a trader to pay high commissions, retail trader, get very little price improvement, and have their their orders have lower fill rates because they're routed incorrectly, and for their broker to be getting 50% of their net income by monetizing that trader's order is basically, from my perspective, the retail broker is basically just stealing money from the trader. And what should he do? There's the answer. The trader should move to there's certain firms that will, some firms charge $8 or $9 for a 100-share order, and others charge $1 or less. And retail traders, I'm just shocked why anybody would go to the traditional retail brokers when there are firms that cater to semi-pro kind of people. If I'm going to open up a retail account, I'm going to open it up at a broker that caters to high volume active traders who are demanding that their costs are less than $1 for every 100 shares.
Absolutely, yeah. Well, Haim, this is a fascinating subject, and I mean, this whole conversation has been really fascinating. I know we could keep going on for much longer yet, but I know you've got to run, so I mean, thank you very much for doing this. I really appreciate you coming on. Before you do go, can you share with listeners where they can go to find out more about you, and where can they connect with you?
Oh yeah, well, the first thing you should do if you're interested in any of this stuff, I tend to tweet quite frequently. I usually tweet about the regulatory developments, firms that are getting hit, and some of the things that are being argued about in the market structure community. But HAIM BODEK, Haim Bodek. That's my handle on Twitter. I have a website, haimbodek.com. There are a lot of resources there. There's also a link there to a research site that I have that has lots of videos, and it's called decimuscapitalmarkets.com, but it's best to just get to it by going to haimbodek.com and then clicking the link. But the Decimus site has videos and white papers, probably 20 videos on there or something. You can sign up for free. There's a little, and I just approve anybody who signs up, so there shouldn't be any issue. And let me do another plug also. Just other things, if you want to hear my story, Scott Patterson wrote, or you want to read about it, Scott Patterson wrote a book called Dark Pools. I'm about a quarter of that book. It tells the whole trading machine story. There's the documentary, The Wall Street Code, which I'm featured in, and that's on YouTube. There's also a documentary, The New Wolves of Wall Street, which I've got my story is also told in that. And lastly, I've got two market structure books. One, The Problem of HFT, that's what a lot of people go to after they read Dark Pools. And then we recently released a new book called The Market Structure Crisis, which really talks about all the issues, not just the high frequency trading issue.
Excellent. Yeah, very cool. And I'll make sure to add links to all of those at chatwithtraders.com. Definitely, guys, read Dark Pools. Awesome book. I've read it. And The Wall Street Code, also highly recommend that. I mean, I've watched that probably 4 or 5 times. Such a great documentary, and you'll really enjoy it. So, Haim, thank you very much for doing this. I hope to have you on again sometime soon, because there's much more we could speak about. But thank you, and let's talk again soon.
Okay, thanks.
You've come to the end of this episode of Chat with Traders, but don't worry, more great episodes are on the way. To stay updated with each great new episode, be sure to subscribe to the podcast in iTunes, and we'd love it if you leave us a rating and review. We'll see you next time on Chat with Traders.